Namaskaram, ladies and gentlemen. This is CS Sudarshan. Hope you are killing it in your studies. So, coming up with the Inter Auditing Marathon for September 2025 and Jan 2026 attempt, basically. So, what can you expect from this marathon, and what are the things that I need to say? First 5 minutes I'll say this, then we'll start going with the marathon. So the thing is that number one thing, written things I'll forget. Okay, I'll show it, I'll write it, and each and every single thing. Number one is that all the files, extra files that I'm using in this marathon, because I, in some areas for better explanation, I'll be using my own notes, all these things for your betterment, for better understanding. Normally I'll be taking the book from the study material. Study material means revise audit. For my students, the book is revise auditing. So even if you're having any book, even if you don't have revise auditing, still it's fine. Okay, any faculty's book, any book you're having, ICS study material, whatever it is, you can use that book and watch the marathon, because I'm taking it in the chapter wise order itself. Chapter number 1, 2, 3, like that same order itself, not taking from here and there. So what happens is that you'll get the structure, because I believe in structured learning, slowly. So number one, that is number one. And all the things, that is number one, is we are going in the structure itself. We are going in the same structure itself. What is the second thing? Second thing, or like, let's write it a bit cleaner. Okay. Anyways, whatever it is. First thing is that we are going in the same order. Okay. Then what is the second thing? Same order of ICAI chapters. So any book you are having, you can follow. Because I teach like this, same order itself, because I believe in that. Then mark, weightage, etc. we'll cover separately. Then during the marathon somewhere we are discussing. Second thing is that all the materials that I am using, all the materials used is freely available, except the revised audit. The complete book is not available. Some chapters, basic things are there. So all the other materials like chart notes, board notes, all these things which you are using are, don't worry bro, 95% of the coverage is directly from the book itself. 5% area I'm just using some charts or something. So any book you are having, keep the book along with you, study it with it. Because I know students keep the book along with you. So all materials used is freely available there on my Telegram channel. The link is there in the description, or in the first comment I'll pin it, description or comment. Just please join there and take all those resources for free. And number 3, the third thing that I need to mention is that there is something called the question sheet, which we have released. Question sheet, some of you would have watched videos on that. Question sheet means, please, this is one technique that I used in my CA final time, where this is one technique that I devised for myself, because to everyone, what is the problem? You are unable to recall auditing, right? So one technique that I'm giving to you, and this normally we used to ask students to make the question sheet, but I know examination is so near, so I made the question sheet for you. This is the question sheet for all the chapters except 1 or 2 chapters. All the essay based chapters, we have made the question sheet. Question sheet means only the questions, all the possible questions from this chapter, all the possible 100% descriptive questions. For a chapter at that chapter, 100% descriptive questions, all the possibilities. No, 100, so let's say 95. Whatever happens, I don't know, but basically 95% or 95%, let's take it. 100 I'm not going to say, because I cannot be that confident. How can I be? When I say can ask something from outside the syllabus or combining 2 chapters, I'll be balled out. I don't want to. So combining both, not combining, around 95% of questions, basically 100% bro, of questions of every chapter. Just the questions I have noted down like this. From chapter number 114 questions, directly I have not asked the case study like that. No, the requirements. This is not a test. It's not a mock test paper. No, 100% questions of essay base. All the chapters are there. Why I am telling you this? Once you finish your revision of any chapter, please understand, guys. This is before marathon. Once you finish your revision of your one chapter number 1 you studied. Okay. Now please don't recall it from your book. When you recall it from your book, moment you are seeing the page. So when you recall it, you can easily get it. Okay, page number, when you see the page, okay, immediately you will remember that. But examination questions are like this. Benefits of planning and auditing. Why planning is necessary? Then you will not remember the page of that book sometimes. That is why when you are revising, recalling, once you finish chapter, recall from this. Recall from this. This is just for recalling purposes. Once you finish off one chapter, close the book completely, keep it. This is just like a question paper. Recall from this. Are you able to get it? Number two, then this is one way to use it. Second thing, just you may be having mnemonics, all these things, right? Just without a side, this area you write the mnemonics and keep. Yeah, all the mnemonics, side to the question, mnemonics or something you write and keep. Then you tear it and stick it onto your wall. So 10 chapters, 10, 12 pages will be there, done. 12 pages and their auditing is done. Now recall from that. Whenever you're going, walking, just the questions are there. Okay, just pick some 5 questions. Okay, other remember panna mudiyuma. Just recall and see. That is another benefit of this. Third benefit, many benefits are there. So recalling on this. That is the second thing is the most useful. Just recalling, studying directly from this. This is why the question sheet is there. And this is completely free. It is there in my Telegram channel. All the things are there. And guys, please don't come and say, ICA will not ask questions like this. ICA is not going to ask questions like this. For this question, if they wanted to ask benefits of planning and auditing, they will give you a case scenario or something. And from that, you have to figure out what is being asked, benefits or whatever it is. This is for recalling purpose only. This is not a mock test paper. I'm saying again and again and again. Because some students will come and say, sir, this is not how ICA asks the question. Bro, this is not a mock test paper. This is all the topics in the paper. Planning process. What are the elements of planning? If they want to ask elements of planning in the paper, they'll ask it in a different way. But recalling purposes, we are using this as recalling it. So we can test ourselves whether we know it or not. Because students, when you're recalling from your book, okay, you recall, okay, you will be confident that everything I'm getting. But when you go to examination, for one answer, you may write for one question, you may write a different answer. You may know the answer, but you may miss the answer. You may wrongly write another answer. That is because your brain, you have to train your brain. Read the question, now you have to close your eyes. Book is not with you, just like question paper. Your brain has to think of that page, open that page, then that page where it is written, what mnemonic you are using. Train, recall, now train like that. That is the benefit of question sheet. Freely available. It is there in the Telegram channel. Please go and take it. That is the thing with marathon. Like question sheet, freely available on Telegram channel. It is there. Then what is the fourth thing that we need to cover? Speed. Speed means marathon will be on speed. It doesn't mean that I will be speaking very fast. I will be speaking fast, okay. Because bro, this is a marathon. This is not an exam-oriented lecture or not a regular lecture. Please go with the flow. Please don't complain that in the marathon video speed is there. Marathon video speed should be there, right? If you want to watch it on slow. No problem. And normal lectures, we don't go this quick. Normal lectures, pace will be reduced, right? So understand that speed will be there. And if you you can put it on 0.75x. And if someone who says I'm speaking slow on this, you put it on 1.25x. Go with it. Okay. So then many things that I had to say. And in this marathon, we will not be taking all the essay based chapters we will be covering. Bank audit we will be covering, because bank audit, I know a lot of students are having issue, because when I talk with the students, the most requested chapters are bank audit, risk assessment and internal, conceptual basis. When AFS and different entity, everyone will ask, but the problem is there. AFS, I have made a structured video for audit of financial statements and uploaded in the channel. You please go and check it out. Structured videos there. AFS, you cannot construct it in 1 hour or something. It's like a fake revision. AFS, if I want to teach you, it will take me at least 2.5 hours. I've done that in video. 2-hour video or something is there. Entire AFS. Please go and take it and watch it. AFS, it will be sorted. This marathon will be around below 10 hours anyways, 9.5 hours or something. Plus that AFS video, you can watch it there. Then chapter number 9, I'll try to put another video on that. Chapter number 9 also. Different entity. All the other things will be there. 9, I'm not going to promise anything, but I'll try to do it, because next week konjam urgency is coming. So yeah. So chapter number 4. So here all the essay chapters, that is chapter number 1, 2, 3, 4, 6, 7, 8, 10 and 11. All the chapters except AFS and different entity will be covered. Bank is also awesomely, we have done it in bank also. So all the things we have to do it. This is a chapter cover. This much coverage I am doing it in 8 hours. So, and please, it's a marathon. Please understand that every 100% topic we cannot touch it, but major topics, at least major topics and concepts we have touched and moved on. Okay, so please don't complain on that. Because understand guys, it's a marathon. When you're requesting a marathon, 10 hours, normal 70, 80 hours lecture, we are giving it to you in 10 hours. So that is there. So please adjust with that. But still, I'll put upon covering everything. So for your benefit, I taught it in the structured chapter order itself. For me, if I'm teaching an essay order, that would be beneficial. But for many students are studying audit in chapter order itself. So it's better be in that same order itself. Then, so basically that's it guys. So let's start with the marathon with the full energy. And one more thing. Use this marathon wisely. I'm a faculty. If you watch this multiple times, that is beneficial for me as well. But let me tell you what is the honest truth behind marathon. Marathon, you have to watch marathon. You have to means I'm not asking you, because auditing is a subject where sitting and revising yourself is what works. Actually, that will only help you pass the paper. But marathon, I'll tell you what is the benefits. Quickly, 10 hours, you watch it one time. When you watch it one time, entire main concepts, again flashing in your brain one time. Okay, done. Now you revise from your book. Now when you revise from your book, now you recall from your book, then it helps. The exam day, sometimes don't sit and watch a 10-hour marathon. For auditing is a paper, but any 5-hour, 3-hour or something, if you want, you watch from this, any tough topics which you need to take and watch. And I'll tell you how to use marathon. Watch it one time. Then now I'm uploading it 1 month before the exam. 1.5 months before the September 12, 13 something is auditing a paper. It's coming on August 1st week. So 1.5 months before the exam. Now you have time, you can listen to it. Like at least second group students basically. Everyone can do it depending upon your time. I don't know. I'm not asking you. So that is one thing. Then another point of view is that once it is done, then some students will watch it 3, 4, 5 times and say I will pass auditing. No. You watch any faculties, any marathon, any lecture, just with the lecture, it's very hard. Except tax paper. Tax paper, you can do it with the lectures at least. But other papers, it's at least like 30-40%. All the other papers, lectures, this marathon, everything is just for your revision purposes. So watch it one time, then you study it yourself. You have to take the pen. Guys, I'm telling you, I want you guys to pass. Be it you are my student or any student. If you're listening to video, I consider you as my student. So I have that love towards you. That is why I'm saying, please watch marathon, understand the concepts. Now it's you have to take the pain to recall. Sometimes you will not be able to get. Okay, still try it, do it. The thing is boring, but do it every single day. Recalling, self-study is what works. I want you to pass. Then I'll say one thing. All the time you are wasting at night or wasting time, it's better to watch a marathon and waste time. So it's not watching, at least you are getting something. For example, students, if you are going to sleep at night, just every day turn on this marathon and sleep. So sometimes some concept will be going through your brain. What are some example when I say, sometimes you can use it in paper. And marathon here, no ads, nothing is coming. So one stretch you can, 10 hours is there. If some ads or something is coming in, or like it's a 10-minute video or a 1-hour video when you're sleeping, if you go to sleep, your brain, some other video will come in and brain will go. So marathon, you watch it on a stretch. So that's it about this. So let's jump right onto business. Marathon with CA Inter, Auditing and Ethics. So chapter number 1, let's go to chapter number 1, Nature, Objective and Scope of Auditing. So a very easy chapter. Users of financial statements, basically the shareholders, employees, government, all these people. Then this one, audit. It is an independent examination of the financial information of an entity. Independent examination. That is, auditor should not be related to the business, that company, client in any way. In any way, he should be independent. His judgment, his decision. See what is independent. His judgment, auditor's judgment, he should not be subordinate to the wishes or directions of another person. That is, if auditor, imagine auditor has borrowed 10 lakh rupee from the client and I am going to audit the client. If I wanted to give an adverse opinion or a qualified opinion, he'll say, no, give me my money back, then you speak. Like that they'll say, right? That is why it is said that auditor should not be related to the company in any way. Imagine auditor is a friend of auditor's friend. I'm auditing my friend's company. In that case, not friend, like take brother. I'm auditing my brother's company. In that case, what will happen? In that case, what will happen if if I identify some fraud or anything? Will I report it? No. No. Obviously, an honest chartered accountant should do that. But obviously, like, how can we do that? Because it's our brother's company. So all these things will be there. That is why it is said that auditor, if I'm auditing a company, I should not be related to that company in any way. So audit, the judgment of a person is not subordinate to the wishes or directions of other person. That is independent. So audit should be an independent examination. I should be independent from the company of financial information. Financial information, sales, purchase, profits, loss, all this. P&L balance sheet, financial information. We are examining financial information of the company. That can be profit oriented or non-profit oriented company, irrespective of its size or legal form. Size, big company, small company, legal form. It can be company, partnership, proprietorship, whatever it is. LLP, all this. When such examination is conducted with a view to express an opinion, why are we doing the examination? We are checking the financial statements with a view to express an opinion, whether it is correct, whether it is not correct, unmodified opinion or a modified opinion. Okay, two things. So what is auditing? The company, management, shareholders will be there, managers will be there below them. So management run the business with the shareholders' money, and at the end of the year, shareholder just need to check whether even proper run pannita illa. So for to do that, what shareholders will do is, shareholders will hire an auditor. This auditor will come, he will check the financial statements made by the management. That is operations of the management. And the last 1 year, how management has run the business. That is financial statements. The result will be in financial statement. Auditor will check that and will report to the shareholders. This is the process. Okay, he should be an independent person, examining the financial information with an opinion to, with a view to express an opinion. Okay, judgment also, his judgment should not be subordinate to the wishes of directions of any other person. Chartered accountant cannot audit if it is with its brother's company. Then if I'm holding any shares in the company, I should not audit that company. Okay, then how the auditor will ensure that the financial statements will not mislead anyone? How the auditor will ensure that the financial statements will not mislead anyone? It's very simple. Accounts have been drawn up with reference to the entries in the books of accounts. That is, he need to check these few things. That's enough. He need to check these few things. First of all, just check, make sure accounts have been drawn up with reference to entries in the books of accounts. That is, all the amount is coming from the proper entries itself, journal entries itself, simple as that. Then financial statement amounts are properly classified, described and disclosed in conformity with accounting standards. See whether it's as per AS. All these are easy. I'm not wasting my time here. Let's focus on objective of audit, because let's focus time on the areas which you don't know, right? This or tough, the risk assessment, internal control, or audit report chapter, audit of banks especially, all this area. Okay, then objectives of auditing. What is objective? These things and all you just read it, get it. Objectives of auditing: to obtain a reasonable assurance whether the financial statements are free from material misstatement due to fraud or error. The game is that free from material misstatement. There is one thing. If the that's my question, does the financial statement, if it has a misstatement, is that a problem? It's obviously a problem, but it's not a serious problem, because our duty is to check whether the financial statement has any material misstatements only. Material, what is materiality, what is material misstatement, everything we'll learn, don't worry, but I'm just saying this straight. Okay, to obtain a reasonable assurance that whether the financial statement as a whole are free from material misstatement due to fraud or error. That is our objective, and report as per applicable financial reporting framework. Then report on the financial statement. This is our objective. Reasonable assurance, absolute assurance, all you know. What is the scope of auditing? Scope of auditing means boundary of auditing. It is basically what we call the boundary. In cricket, there is a boundary. You cannot, if a fielder, batsman, everyone should stay within the boundary. Outside the boundary, you should not go, right? That way, what are the things that it is included in scope of audit? Things coming inside the boundary. What are the things that is coming inside of the boundary? First is coverage of all aspects of the entity. Everything, entire sales, purchase, everything. When you are doing the auditing, you have to cover all aspects of the entity that is relevant to financial statements only. Entity may have a CCTV camera in the car parking area. Why should you go and check that? That is not an internal control. But at the same time, entity has a CCTV camera in the warehouse where the inventory is kept. That may be relevant for financial statement because inventory amount may get affected. Parking is not relevant. So understand one thing, we need to cover all aspects of the entity that are relevant to financial statements being audited only. That is sales, purchase, expense, assets, liability, all those items we are coming. And some information that is related to that. Okay. Then reliability and sufficiency of the financial information. Reliability means, can I trust the financial information? Because management will give financial statements to me for auditing. And when I ask the invoices, sales, bills, all these things, they will give it. Reliability means, can I trust that? Is it genuine that they are giving it? And sufficiency, is it enough? Is it only enough? Like whether everything has been properly entered, all those things. Okay. See, auditor should be satisfied that information contained in the underlying accounting records, like the bills, vouchers, everything is reliable and sufficient. That is 10 lakh sale has happened. Whether 10 lakh has been actually been entered or not. Or whether 10 lakh for bills there is there or not. 10 lakh sale happened. Then sufficiency means, is there actual bill of 10 lakh? Are they giving me bill of 10 lakh also? When I ask them the bill of 10 lakh, they are giving bill of 9 lakh only. So that means it's not sufficient, right? The bill is not sufficient. So reliable means, can I trust on that? Okay, then proper auditor need to make the judgment related to sufficiency and reliability. Then proper disclosure of financial information, everything as per the applicable reporting framework, financial reporting framework, which need disclosure. For example, a related party transaction. Normally, as per your accounting standard, it requires a disclosure, right? Whether a disclosure has been given or not, that is what we are checking. Proper disclosure. As per your accounting standard, related party transaction need a disclosure, right? Whether the disclosure has been given or not, simple. Management will make a lot of judgments about accounting policy, you just need to check that. That's it. Then what it does not include? What is not included? Imagine this is the boundary. These 3 points are coming inside the boundary. Now these are coming outside the boundary. What is not included in auditing? Auditor is not expected to perform duties which are outside his domain. Which fall outside his domain. That is checking the physical condition of an asset, like building. In the balance sheet now, it will be written asset 10 lakh plant and machinery. Okay, going there and see whether the plant and machinery exists or not, that is fine. But how can you evaluate the condition of, you are not an engineer, how can you evaluate the condition of a machinery? No. So all the things that you can perform, that is coming under a chartered accountant's talent or skills, you do it. You know, talent or skills, it's not like chartered accountant's duty, you do it. Other things you don't have to do it. Okay. Auditor is not expected to perform duty which fall outside of his competence. He is not an expert in evaluating all these things. So better don't go with that. Then he is not an expert in authentication of documents. If I ask for a document to management, some bill or some anything, some share certificate or anything, they'll give me the document. But we are not an expert in checking whether that is correct or not. So don't focus on that. We are not an expert on that. Basic checking is enough. Done. Then auditing is not an official investigation. Auditing and audit investigation is completely different. We don't have legal powers. Investigators have the power to kick open the door, take people, arrest people, all this. We don't have any power. We are just checkers of the financial statements, financial information of the entity. Okay, investigation, you know that. It's important. Investigation means a critical examination, deep examination. Like a fraud happened. But a fraud happened. To check that fraud, company will call an investigator. He will come. He will only focus on that fraud only. That is investigation. Auditing means you are auditing the full year's financial statements. Okay. So investigation is a critical examination of the accounts with a special purpose. Just to identify that fraud you are investigating. The objective of audit is to obtain reasonable assurance about whether finance statements are free from material misstatement. Scope of audit is general and broad, whereas scope of investigation is narrow. Because auditing means you are covering everything. It's broad, but fraud means you are focusing only on that one issue. One fraud happened, one employee fraud happened, or 10 lakh rupees missing in from some entry. So just to investigate that, you come and do the fraud, only focus on that. Okay. Then what are the inherent limitations of auditing? It is said auditing can only provide a reasonable assurance. Absolute assurance mudiyadu. We can only give a reasonable assurance. Why? Because of the limitations of auditing. What are the limitations? Nature of financial reporting. That is, financial reporting will have a lot of judgments by the management. In financial statements, we'll have a lot of management judgments in that. And because of that, because judgment, how much can we evaluate? For example, using LIFO method, FIFO method, whichever method for inventory valuation. Management used LIFO. And auditor asked, why LIFO? They are saying because of some reason they are saying. But for auditor's point of view, FIFO can also be better. So it's like no perfect answer is there in that case. Similarly, management will make a lot of judgments like this in the financial statements. When they are doing the financial reporting, they will make these kinds of judgments. And it is because of these judgments, we cannot rely on this. And we cannot, auditors, even after checking, we cannot completely say that it does not have any fraud or error. Just imagine, useful life of a machinery, plant and machinery. Management says useful life is 10 years. Practically, auditor knows that AC will run for 20 years. But if you go to manager and say no, it is our thing, it will run only for 10 years. They'll give some explanation. We cannot do anything on that. But that may actually be a fraud, because they want to take depreciation more, will get more depreciation, right? Like that. But how can we counter that? There is a problem, right? So this kind of lot of judgments will be there in the financial reporting. Preparation of financial statement involves judgment by the management. This judgment may have subjective decision or degree of uncertainty, because this is uncertain. We cannot say anything. How can we say AC will run for 20 years with surety? No. Because of these kinds of judgments, even if we check it completely, there will be a lot of these kinds of small judgments. We cannot say it is correct or wrong or anything. In that case, because of that, we cannot guarantee absolute assurance. See SA 200, auditor is not expected to and cannot reduce the audit risk to zero because of these inherent limitations. Number one is this one. Second, nature of audit procedures. That is, when we are doing the auditing. Imagine I am the auditor of Flipkart. Flipkart has 10,000 transactions, no, not 10,000. In 1 minute, 1,000 transactions is happening. 1,000 sales, purchase, everything is happening in Flipkart. Just think, 1 minute, how many people are buying it? Products. So 1 year, if you take 365 days into, how many crore of transactions will be there? How many lakh crore transactions? Will I be able to check everything? No. It's impossible to go and check all these things one by one. So sales like 10 lakh sales. How can I check 10 lakh sales bills? It is not possible. So I will be using sampling. So when I'm using sampling, how can I say that entire financial statements are free from material misstatement? There may be some bills which I have not checked, which has a problem. So since I am using sampling, I am not checking everything in detail. So I cannot say that financial statements are free from material misstatement 100%. I cannot give an absolute assurance. That is an inherent limitation of auditing. That is, auditor does not test it. That's a testing samples. So this is called a practical limitation. It's an important thing. Then we have something called a legal limitation. Management may not provide complete information as requested by the auditor. Auditor will ask info. Management may not provide that information. Auditor cannot force them. Management, if I need an information, I ask management. They are not providing me. What can I do? I can come report to TCWG, but sometimes they cannot provide me. They'll say, I asked some file. They are saying, that file went through flood. So these kinds of legal limitation will be there. Because of these reasons, we cannot guarantee absolute. Then management itself will do the fraud. Management consists of these kinds of people, and they will do the fraud, and they will do it in a way that it's very hard to detect. We cannot even detect that way. So it's impossible, because we don't know the company. We are just coming and checking for 1 or 2 months. They know the company, like they can hide it in if everyone in the management is jointly doing the fraud, what can we do? Nothing, right? So that is also an inherent limitation. Then transaction with the related parties. I am going to audit a company. That company may have 100 related party. How will I know which party in the books of accounts is related to them? Sometimes that company's owner's brother will be there. How will I know that? Okay, so because of that reason also, we cannot say that financial statements are free from material misstatement. Then not in the nature of investigation. Auditing, I told you, auditing is not investigation. We are not deeply checking everything like an investigation. In investigation, we will 100% check everything. 1,000 bills 1,000 bills will check. But in auditing, 1,000 bills like 100 bill maximum we will check. So that is, because of that, we cannot guarantee. Then timeliness of financial reporting and decrease in relevance of information over time. So here the thing is that timeliness of financial reporting and decrease in relevance of information over time. It simply means that sometimes I am itself auditing the same company for the last 3-4 years. Same person, I am doing the auditing. So imagine I only have like 1 or 2 months to do the auditing properly, right? So what I do is, last year I checked their test of controls, everything. I properly checked their internal controls. So this year, since I don't have time, what I will do, I will use that itself. I'll not do the checking to this year again. Last year I itself do it, right? So that report I'll use it, and okay, internal controls I'll relay, but there will be a problem. Last year that information is not relevant now. Just think, last year I'm auditing a company, boat, or a girls listening to, just imagine the company I'm auditing is Mama Earth. So last year when I did the audit procedure for Mama Earth, Wow was the competitor. Wow face cream, all this, that company was the competitor. So on that context, I audited last year. But this year what happened was, for Mama Earth, Dot & Key, that brand is a new competitor. So that audit procedure that I did in the last year is not relevant this year. But I may not know all these competition mistakes, so I will be using the same audit procedure this year itself. Same things that I used last year this year itself. So because of that, my audit, I cannot guarantee, I'll be using these kinds of things. So I cannot guarantee that financial statements are free from material misstatement. Like I cannot reduce the audit risk to 100%. I can say financial events are free, but I cannot give absolute assurance. Timeliness, decrease in relevance of information over time. Last year, Mama Earth was with other company. This year, Mama Earth. So last year, information, the relevance of this year, it got reduced. The relevance of that information got reduced. Okay. Then timeliness of financial reporting. The relevance of information decreases over time. Last year's info is not relevant this year because competitor married. An auditor cannot verify each and every matter. So balance has to be struck between reliability there. Then future events. Future events or conditions may affect an entity adversely because it ceases to exist in future. So auditor cannot provide a guarantee that because how can we predict future? It's unable for us to predict the future. So we cannot give the guarantee that currently we audited everything. So future this company will go like this. No, we cannot guarantee anything. So because of the above factors, auditor cannot guarantee financial events are free from material misstatement due to fraud or error. Like absolute guarantee we cannot give. Absolute assurance. Cannot provide a guarantee we cannot give. Reasonable assurance we can give. Absolute assurance we cannot give. Engagement means work. External audit engagement means work done by an external auditor. Okay. External audit. Okay. Audit work. Okay. Benefits you read it. Nothing is there. What is the benefit of auditing? First is it will give us high quality information. When the financial statements, when it is checked by the auditor, then the users can easily trust that because it's checked by someone. So high quality information without us checking, financial statements will not be used by the users properly. So they provide high quality checking. Himo here, Deva share, HI. Then it gives confidence to users also. Then MO, moral check on employees. If auditing is not there, employees will do fraud. Since auditing is there, they know if I do fraud, I will get caught. So it acts as a moral check on employees. They will not do the fraud. Himo, HE, helpful to the government authorities because it's based on audited profit, tax is paid. Tax is paid based on that. So since auditing means government can believe, okay, auditor has checked it, so I don't need to check it again. Okay, trust. Then HIMO here, DE, detect fraud and error will detect. Then various controls operating, review the existence and operation of various internal controls. See, during the auditing, we will anyways check the internal controls of the company. So that is also there. Then shareholders. In case of company, shareholders may not be involved in the daily affairs of the company. That is important. Simply means that in a company, the shareholders, they are people who invest their money and go. So they will not come to the company all the time and to check everything. No, that is not going to happen. So what happens is they will hire an, because since they are not in the company, management may do anything with their money. So to check that, the shareholders hire chartered accountants as auditors. So their interest is safeguarded. Audit is mandatory for companies. Companies, as per the Act, companies auditing is mandatory. Other non-corporate entities can do the audit voluntarily. And as per tax, the turnover limit is there. If it is above, then it's mandatory. Else, voluntarily, anybody who wants can do. Then, who appoints all these things are easy. Assurance engagement. Assurance engagement means an engagement in which auditor will give an opinion. That is, we check something. Assurance engagement is not only auditing, many other types of assurance engagements are there. Okay, assurance engagement doesn't mean it's just auditing. You know all these things, right? I'm not gonna focus too much. Assurance means an engagement in which a practitioner, that is auditor, will give a practitioner means CA in practice. CA in practice, what is the difference between practitioner and auditor? Some people will get confused in that. Basically, CA in practice, that he will do audit, he will do consulting, he will do review, he will file taxes, many other things auditor will be doing. In this, if he is only doing the audit, that guy is called an auditor. But a CA in practice do not only audit everything. So that is called a practitioner. Okay. Assurance engagement is an engagement in which the practitioner expresses a conclusion designed to enhance the degree of confidence of intended users. That is, we will examine something and we will say whether it is correct or not correct, how much to rely on that, like qualified opinion, unmodified opinion, all these things we will say. That is what we call assurance. And we are giving some basic guarantee, not an absolute guarantee, anything, just a reasonable assurance. We checked it, as far as our knowledge, it is okay. Like that, we will give an assurance. Non-assurance engagements are also there, where CA will do the work, but we will not give any assurance. No. So engagement, if you say engagement means work done by a CA is divided into two: assurance engagement, non-assurance engagement. Okay, assurance engagement we will give different types of assurance. Reasonable assurance, that is basically for auditing. Then review item is clear. Review will go up limited assurance. All these things are there. Okay. Then what are the elements of assurance engagement? In an assurance engagement, that is a work in which the practitioner, CA, gives some sort of assurance. Assurance means some guarantee. Now, I'll marry you. That kind of a thing we'll say reasonable assurance. Okay. So example, the CA in practice. So practitioner means that person who is providing the assurance. Responsible party means the client. Intended users means the people who are using the financial information, like whatever we are auditing, we are checking, we are reviewing, that who is going to use that. That is this. Then subject matter means the information examined by the practitioner. That is whether financial information. If it is auditing, it is all financial statements. If it's a review, it's like quarterly financial statements are like that. Okay. Then suitable criteria, that are the rules against which we compare. For example, financial statements we are comparing with the standards, right? Accounting standards, whether accounting standards are proper, whether compliance with laws as per Companies Act are proper. That is called suitable criteria. The laws against which we are comparing. Then sufficient audit evidence. Sufficient means quantity, appropriateness means quality. Then written assurance report in the appropriate form. Like I said. Then audit versus review. Simple. Audit is a reasonable assurance engagement. Review is a limited assurance engagement. All these things are mentioned. It provides a lower level of assurance than auditing. What is audit? What is review? You know that, right? Audit is the detailed examination. Review is not like that. In audit is a reasonable assurance, review is a limited assurance. Review involves only fewer procedure. Auditor will be more. Both audit and review are related to financial statements. Then this you know. Then this one, prospective financial information. That is important. What is called a PFI? Prospective financial information. It simply means that what are we auditing? But financial statements finish it. Like imagine an accounting year should finish. 31st March accounting year finished. And we are doing the proper auditing after this. So we are auditing the historical financial information. A financial information of things that happened in our past, previous days, past. But prospective financial information means this is if this is history, this is today, date today. If you are checking something of the future, that is prospective financial information. The today. Normally auditing, review, everything is the past, whatever happened in the past. But PFI means future. That is prospective financial information. That is, today we will make a financial statement. The company will make a financial statement that how our next 1 year will be. With prediction, they will make a financial statement. That is prospective financial statement. Okay. PFI means financial information based on assumptions and events that may occur in the future. That is, current year sales next year level. Or prediction, assumption, they'll assume next year rainy season more. So umbrella, we are having an umbrella company. So umbrella sales will be more. Assumption like that will be there. Expense, next year we are going to buy a property. So rent will not be there. So next year rent is zero. Current year rent is but next year rent is zero. But apanga asset value, asset loan, all this. Like we'll predict and make a future financial statement. Okay. That is assumptions. Current year, the previous year, the future year financial statements. Okay. So that is what we call prospective financial statements. Here, it will be made by the management. Auditor cannot give any assurance like a complete things on all this because like the normal auditing, things has already happened in the past. So we can give some guarantee, like not guarantee, like a reasonable assurance. Okay, it has already happened. Sales sales already happened. Bills is there. But for future thing, how can we give a guarantee? How can we give an assurance? No, it's not possible. So we will also check the prospective financial information. Management prepares and gives it to us. We will just check it once and we will say, we will only, in normal auditing, we are auditing the financial information. Here we are auditing more of the assumptions. What are the assumptions taken by the management? Are they reasonable? They are saying next year sales audited. That is an assumption taken by them. And why? Some reason will be there. Rain Mandalu umbrella company. So are those assumptions reasonable? So on those assumptions, we will give an audit opinion. Like not an audit opinion, we will give an opinion. That is a lowest level of assurance. A limited assurance, we can say, or moderate level of assurance, we will give it here. Okay. We are, understand one thing, in auditing, we are auditing the financial information. Here also, we will check the financial info. But here, More we are focusing on, we are giving audit opinion on the assumptions of the manager, just saying that it is not unreasonable. Only that we are saying here, okay? PFI relates to the future events. See, in assurance report involving PFI, that is, if manager prepare a PFI and give to us and ask it, sir, please check it and give a report, then we say practitioner obtains sufficient audit evidence to the effect that management or assumptions on PFI is based are not unreasonable. That is, they are reasonable. And PFI is properly prepared as per the basis of those assumptions and is properly presented and all the material assumptions are disclosed. This is the only thing we will give guarantee. In auditing, we are giving guarantee that financial statements amount we obtain audit evidence amount free from material misstatement. Here we are not giving that kind of a guarantee. Here this is the assurance we are giving. It's like a moderate level of assurance. We are just saying their assumptions are okay. Then qualities of audit is very easy. What are the different types of standards? Standards are basically nothing. What should I say on this? It's everything. Standards is first of all SA, standards on auditing, obviously. Then SRE. If you want, I'll just see. Statement, scope of audit, engagement. Engagement, if you see assurance engagement and non-assurance engagement. Assurance engagement type reasonably limited. Then these are engagement standards. Standards, like different standards, rules. First of all, for assurance engagement, this one, assurance, where we give some assurance to them. After checking, we are giving some assurance. Inge, no assurance. We will just go through it and we'll say, no, we don't give any assurance. Here we are not giving an assurance. So, assurance engagement, if we are doing the auditing, then follow standards on auditing only. SA. Standards. So, these are standards only for auditing. For review, if you are performing reviews just like auditing, but not that detailed. So, SRE, this is mainly applicable for this reviewing interim financial statements, 3 months financial statement, 6 months financial statement, quarterly financial statement, etc. will be there for these listed companies, bigger companies. So for them, audit plus review, auditing review, but review is separate. So for reviewing, when we are doing the auditing, we are following SA. When we are doing review, we are giving SRE. Here also after review, we will give an assurance. Then for other assurance engagements, other than audit and review, we will follow this standard called SAE, standards on assurance engagement. And for example, prospective financial information, all these things. Okay, then internal control assurance, compliance assurance, all these things. Then non-assurance engagement is there, where we do the work but we don't give any assurance. For example, SRS. In that case, we are using SRS, standards on related services. For example, compilation engagement. Management don't know how to prepare financial statement. They come and ask, sir, please help. We helped them, but we helped them in preparing the financial statement. We are not auditing, checking anything. No, we prepared the financial statement, give it back to them, you take it. We are not giving an opinion. In that case, if you are doing any work like that, then follow this standard. Client comes and asks you to perform any service other than these three, then you need to use this. Agreed upon procedures, it will be called. Okay, this is what we call the assurance. So chapter number 1 is done and dusted. Okay. And we have chapter number 2. Chapter number 2, audit strategy, planning and program, essay 300. And guys, be with me for the next 30 minutes. It's a very quick revision, which you can review 1 or 2 times, whichever you want. And I'll be going quick because it's like a super quick revision. I don't want to waste your time. So if you want to listen slowly, just put 0.75, or if you want to listen it even faster, put 0.75, or normal is fine. I would believe like that, because hopefully you would have studied this chapter 1 time, right? So before we start with this chapter, let me give you the structure of this chapter. This is my approach towards teaching. This is how I teach. Because in auditing, students will forget everything if they don't have the structure of the chapter in their head. Many techniques are there to remember auditing. That is, like, I'll say that. Yeah. First is the chapter audit strategy, audit planning, everything. So chapter is divided into planning. Benefits of planning. First thing we will be studying. Then nature of planning we will study. Then planning process. In planning process, preliminary engagement activity, planning activity, audit strategy, audit plan, all these things. Then audit program. Okay, this is the structure of the chapter. Understand this one thing. So now we'll move revisely directly into the chapter, because I don't want to waste your time. Listen. First is, what are the benefits of planning? You want to plan the audit. Imagine you are having exams in next 1 or 2 months, right? So you want to plan. What are the benefits of planning? Similarly, in auditing also, what are the benefits of planning? It's very simple. It's DO disco. When you plan something, it can help you. It helps the auditor to devote appropriate attention to important audit areas. When you plan something, you can identify, okay, these are the important audit areas. You planned it. Now you can focus on there. It helps to devote appropriate attention to important audit areas. DO disco, DI. Identify and resolve potential problems. When you plan, you can understand, okay, these can be the potential problem areas. You are auditing Zomato, so you will know, okay, this delivery partners payment issue, everything. So that can be a risky area. That is an important area, so devote appropriate attention to that. Then identify and resolve the potential problems. What are the problems that can come? When you are planning, you can know. When you are planning for your CA inter exam, you'll know what are the potential problems will come in the next 2 months. Your brother's marriage will be coming, friend's marriage will be coming. You have to go. Don't go. Focus on exam. So like that. So, organize and manage audit engagement very easily. DO disco. DO disco. Direct and supervise engagement team. These two topics are engagement team members, because when you plan the audit, then you can, because you know what to do in the audit, right? When you are planning the entire audit, how to do the audit, everything. So then when you have a proper plan, you can easily select your engagement team. Engagement team means audit team. Who are the articles that you need along with you to do the audit? Selection of engagement team becomes easier. If it's Zomato, it's a bigger company, so experienced or articles you need. Similarly, selection of engagement team members and direction and supervision of engagement team members and review of their work. It will be very easy when you have properly planned it, because supervising how to direct your articles, your people below you, how to direct them, when to review their work, all these things. DO disco, devote appropriate attention to important audit areas. D, I, identify and resolve potential problems. O, organize audit engagement, manage audit engagement. DO disco, direct and supervise engagement team members. S, selection of engagement team members. Co, coordination of work done. Simple as that. DO disco, keep in mind. Done. Then, what is the nature of audit planning? That is, planning shortly begins after the year-end audit, because imagine you are auditing 22-23. So once you finish 22-23's audits on, imagine August, you finish the audit of this accounting year on August 2023. That moment itself you will start planning the audit for 23-24, because when you finished this audit, you will get a lot of insights about what is wrong with the company, what are the areas where I need to focus everything. So with those experience, you can easily plan the next year's audit. So always keep this thing in mind, and remember this one diagram in your brain. Okay, pictographic memory. And this can be asked as a question. They'll ask this, and the question is this: when you are planning include the need to consider the following matters. When you are planning, you have to consider these matters. Simple as that. Appadi poda, you know, right? Makes A, analytical procedures to be used as. What are the analytical procedure to be used as? Risk assessment procedure. Performance of other procedures. Performance of other risk assessment procedure. When you are planning, you need to consider these things. First, what are the analytical procedure that you are going to use? What are the other risk assessment procedure you are going to use? APO, obtaining a general understanding of the legal and regulatory framework of the entity. When you are planning, you need to know all of this. You need to consider all this. When you are creating a plan, consider all of this. What are the analytical procedure you are going to use? What are the other risk assessment procedures you are going to use? What is the legal and regulatory framework? Obtain an understanding of the legal and regulatory framework of the entity. Do all of this. Then determine the materiality. Determine the materiality, involvement of experts. Materiality we will learn in chapter number 3. Involvement of experts means you are auditing a company like Zomato or a company like Kia, for example, or any company where you need to verify the condition of an asset. Machinery, they have put the machinery as 10 lakhs in the balance sheet. You have to verify the condition of the machinery. Normal verification you can do, but you are not an expert in checking at the condition and saying it is 10 lakhs. But it is very crucial that sometimes they may have some fraud or something. So you need an expert to do that. So determine whether in the planning stage itself, you will determine whether you need an expert on that registered value or anything for checking any value of the land or something. So appadi. So what? When you are planning the audit, you need to consider the following things. Appadi poda. A means analytical procedure. P means performance of other risk assessment procedure. O means Obtaining a general understanding of legal regulatory framework. D means determination of materiality. I means involvement of expert. Keep in your brain. Then, now we'll go with planning process. What are the elements of planning? Elements of planning. Planning is divided into two. We have two activities. First is preliminary engagement activity, then it's planning activity. Keep in mind. Preliminary engagement activity means all the activity that you wanted to do before starting the audit. So today, imagine Zomato, the owner, Deepinder Goyal came to me and said, sir, can you do the audit? I'm a CA. So all the things, so before I'll say yes and we'll sign an agreement, right? So before signing the agreement, these are the things you need to keep in mind. Before starting the audit, preliminary engagement means work. So preliminary engagement before work, these are the things you need to do. First, perform procedure regarding continuance of client relationship. That is, there are three cases for that. Imagine last year and previous year also you was auditor of Zomato. So this year, when they are coming, you are continuing the engagement. Last 2 years you were there. So this year it is a continuance of engagement. So you have to decide whether you need to continue with them or not. That is seeing the integrity of them. Like Zomato, Deepinder Goyal, is there any problem with the company? Imagine it's Byju's. Last 2 years you are auditor of Byju. This year also if you audit Byju, you'll be gone. Like now Byju is not there, but still I'm saying. So see the integrity of the member and decide whether to continue the relationship or not. Should I do audit this year also? That is one area. Then another thing you have to consider is that imagine last 2 years Zomato was a boat. We'll take earphone company boat. Last 2 years boat was a smaller company. So only 10 crore profit, 10 crore turnover, think. And your firm was a normal firm. But this year boat suddenly became a very big company. And the turnover is 100 crore. But you are only having a small audit firm. So you may not have the competence, the level of articles, everything to audit that, right? So this year you need to think whether should I continue with the engagement or not. So these kind of decisions you need to check here. Discuss, think whether you need to continue with the client relationship or not. That is, last 2 years you are the auditor. This year should I continue auditing? First case. That is certainly before accepting the engagement, the firm need to obtain. Firm means us, audit firm, me, chartered accountant, need to obtain necessary information before accepting an engagement from a new client. Imagine a new client is coming. So before accepting audit work from him, that saying that I will do the audit work, think, check his integrity, check whether we are competent, everything. Check whether we can do the work. Check whether he is a fraud or not, everything. Then when deciding whether to continue an existing engagement, I told you last 2 years we were the auditor of Zomato. This year also should I continue or not? This is we are accepting a new work. This is we are continuing with the old work. This is we are accepting a new work from an old client, existing client. Zomato told me, okay, 2 years you were doing the audit, but this year do some other work also for me. That is a new engagement other than auditing. So when you are accepting any work in format, think preliminary engagement activity. Before accepting any work, make sure you check this. Perform procedures regarding continuance of client relationship. Make sure the integrity of principal owner, competence of our team, everything is okay. Okay. Second thing you have to do before auditing is that once you decide, yeah, I am gonna continue with the client relationship or I am gonna accept the engagement, then see the independent requirements regarding ethical requirements regarding independence, including independence. Make sure now you accepted the audit of Zomato. Now make sure whether your team is independent. In first chapter we learned, right, what is independence. So I'm not discussing. You are not related to the company in any way. You are not the brother of Deepinder Goyal. You are not owning any shares in Zomato. Like you are your audit team members, like the main core members, auditors. You are, make sure first you decide and accept whether you want to do the audit. Once you decide that, then decide the independence requirement. Are you independent to do the work? Then sign, establish an understanding of the terms of engagement. That is that audit engagement letter where your responsibility, their responsibility, everything will be mentioned and you have to sign and give. So establish an understanding of that also. So 3 things we covered. Preliminary engagement activity. Now it is planning activity. So these are the things which we need to do before we start auditing. Now planning activity. What are the planning activities? Establishing the overall audit strategy. Let me tell you, audit strategy means 2 things are there: audit strategy, audit plan. Before we do the audit strategy means an overall approach to the audit. Audit plan means what, like even more detailed than audit strategy, but not very detailed. That what are the things we need to do? For example, India is having a cricket match with Pakistan tomorrow. So tonight, our captain Rohit Sharma and our vice captain and plus the coach will be sitting in the room. We'll make a plan, right? Okay, tomorrow the pitch is batting pitch. So we need to get the toss and get the batting. And once we get the batting, that is a strategy you have. You need to batting everything. So you'll formulate the strategy at the day before. That is what we call audit strategy. What is audit plan? I mean, cricket strategy I told. In cricket plan means if we get the toss, we need a batting order, right? Who will bat first? Who will bat second? Who will bat the third? That is the audit strategy is this much. Audit plan is this much. A bigger level than audit strategy. That is audit strategy and audit plan. In auditing, you are auditing Zomato. So first day you will decide a strategy. Okay, we will analyze Zomato. What are the risky areas in Zomato? Everything you will plan. That basic how to approach Zomato, all these things, the timing it will take, nature of Zomato, understand the business, everything. Strategy will formulate. Then plan means what are the risk assessment procedure that I am going to use? What are the further audit procedures that I am to use here? All these things will be coming under audit plan. Okay. So you are establishing audit strategy. First thing, what are the benefits of establishing audit? And audit strategy, overall audit strategy is set the scope, timing and direction of audit and guides in the development of audit plans. Scope means, first chapter I told you, scope means boundary. Boundaries of audit. Scope of audit is there in the first chapter, right? So when you are doing an audit strategy, make sure it is within that scope and within the limitations and within the timing also. Like if you have got only 2 months to do the auditing, so strategy should be according to that. So this strategy sets the scope, timing and direction of the audit, and it develops and it helps in the development of an audit plan. What are the benefits of strategy that you get? First is you will understand. Now you have the strategy, right? Now you will understand what are the resources to deploy. Resources means article assistance, all the resources you need to do the audit. So when you have a strategy, you can understand what are the resources to deploy, what are the resources to be given to specific audit areas, which like how many articles should be applied there, all these things. Now amount of resources, how many articles etc should be applied on that one audit area. For that is a risky audit area, so we need 3 experienced articles. Then that is a less risky audit area, so 1 article is enough. That is amount of resources. Resources means what are those resources? Articles, all the resources which we need to do the auditing. Amount of resource, and when these resources are deployed, that is in the first stage, first 2 weeks of the auditing. Let inexperienced member do the auditing or experienced member do the auditing. Then the second week onwards, experienced team members, let them come and do the auditing. That is when these resources are deployed, at what time, what resources to be deployed, you can understand. So here you'll understand what are the resources needed, then amount of resources needed, then when they are needed, then how they are MDS, managed, directed and supervised. You have article assistants. How are you planning to manage them? How are you planning to supervise them? How are you planning to direct them? This is what you have to discuss. All these things. Okay. All these things. So these are the benefits of strategy. When you formulate an audit strategy, you will get an idea about what are the resources we needed, what are the amount of resources we needed to do the audit, what are the when these resources are required to be deployed, and how they can be managed. So when you have an audit strategy, you can have an idea of all these things. Got it? Then what are the factors to be taken into consideration by auditor for establishing the audit strategy? You want to establish audit strategy. What are the things you need to consider in your brain? Things you need to consider as an auditor. First, identify the characteristics of engagement. What are the characteristics of engagement? Identify these characteristics. Annie. What is the applicable financial reporting framework to the entity? Like Ind AS, Schedule 3. What is the financial reporting framework to the entity? Identify that first. Then, what is the nature of business segment to be audited? ANI. What are the industry specific requirements? Is there any industry specific reporting requirement? Imagine that is a MRF tires, manufacturing tire, right? So they will have this emission of smoke. So sometimes what will happen? Government will suddenly say, okay, if you are emitting more than this amount of smoke, you need to do a reporting, this kind of reporting. So depending upon the industry, make sure whether there are any industry specific reporting requirement. Before you do the audit, first understand applicable financial reporting framework of the entity. Then understand what is the nature of the business to be audited. Do we need any specialized knowledge regarding that, etc. You are going to audit boat. Boat is a technological company, like lot of tech items are there. So do we need someone who is specialized knowledge on that? Decide that first. First understand boat's financial reporting framework, then nature of business, then is there any industry specific requirements, reporting requirement, then expected use of audit evidence obtained in previous audit. Last year I did the audit, I have got a lot of evidence regarding many things, so can I use it in this year also? Make sure that. So first do ANI before you start the audit. Then what you need to do, what are the reporting objectives? You need to ascertain the reporting objectives to plan the timing of auditing, timing and nature of communication. Don't overthink on that, just listen to this. Why do you want to ascertain the reporting objectives? Because of these kinds of instances. Reporting objectives means why are you doing the audit? What is the objective behind reporting that? What is our objective? What is the thought process behind reporting? Simple, just memorize this very easily, very easy, very easy. Just listen to me. Just this is a pictographic memorization, not a mnemonic. Here we are memorizing pictographic way. First TT, what is in it is timetable for reporting. TT means timetable. OM means organization of meetings to discuss nature, timing and extent of work of management. OM means organization of meetings to discuss the nature, timing and extent of audit work with the management. When you are doing timetable means what is the timing to do finish off the auditing? You'll know, right? In 2 months, in 3 months. What are the timing of reporting? Timetable of in between that. Which all times I need to report. In second week, do I need to report? In like I need to give the audit report by the end of this date. All these things, timetable. Then organize meeting, OM, organize meeting. Organize meeting with the management. When you are doing the audit, you need to meet management once in a while and tell them what we are doing, all these things. If you want to discuss anything about auditing, everything. Then TNT, type and timing of reports. You are doing the audit. So sometimes you will be doing the internal control checking also in detail. So sometimes management will say, sir, can you, anyways you are doing the internal control checking, can you give an assurance report on internal control checking? So these kinds of report also sometimes you will give along with auditing. So discuss with the management regarding the expected type and timing of reports to be issued, including the audit report. All the reports that we are going to issue, discuss with the manager. What is the type of report you are expecting? What is the type of report you are expecting? Management is expecting. And at what time you are expecting? Discuss this with the management. Type and timing of reports. Timetable of reporting. Organization of meetings. Type and timing of reports. Then this is communication. Discuss with the management regarding expected communication on status of audit work. Like when you are auditing in a company, you need to update the management once in a while. Like, okay, I have audited this much. The status of your work, you have to update them. This much we have completed, this much we have completed, all this. So discuss with the management regarding the expected communication. How are we planning to communicate? When are we planning to communicate? Discuss this with the management on the status of audit work throughout the engagement. Okay, then nature and timing of communication. Expected nature and timing of communication among engagement team members. That is, your auditing members are there, right? Weekly once you are everyone. Now everyone will be in different department doing different auditing of one company itself. But there should be a timing of communication between the engagement team members. They should all come together, sit and discuss what we identified this 1 week, right? So you have to discuss what is the nature and timing of communication among engagement team members. Don't overthink on this. Just pick this, have the pick of this one thing in your head. Screenshot, take it. If you don't have the revised audit book. If you have the revised audit book, well and good. Lot of things like this will be there in the book. Okay. I'm not promoting, leave it. Okay. Then, this is very simple thing. What are the significant, consider the factors that in the auditor's judgment are significant in directing the engagement team efforts. Sometimes the auditor may feel there are certain factors during the audit where our team need to focus, engagement team need to focus on. Many factors will be there where auditor wants his team to focus on. So how will auditor find those factors? That is a question. Auditor, I am the auditor. I look at Zomato and I identify, okay, imagine I'm identifying, okay, these are the areas. I'll identify 2-3 areas. For example, verification of assets or like assets area, debtors area. I picked 2-3 areas and said, okay, these are the areas where I want my audit team to focus more on. Why? These are the areas what I want my audit team to focus more on. Okay. So how do the auditors say that is debtors, these assets are the areas? How he has determined these are the significant areas? So what are the factors? Keep in mind, what are the factors auditor will consider in determining significant areas where engagement team needs to focus. What are the, as per auditor's professional judgment, areas in which engagement team need to focus? These are the areas. First, VIX. If there are lots of, like, volume of transaction may determine whether it is more efficient to rely on internal control. If there are high volume of transaction and auditor, then he can determine whether should I rely on internal control or not. So depending upon that, he will determine should I focus there or should I focus not. Simple. Should I mean whether that is a significant factor or not. Simple as that. Sorry. Then significant I means industry developments. If there are a lot of industry developments happening, such a changes in the industry, everything is happening, then that is an area, that's a significant area we need to focus on. One more time, if the volume of transaction is high somewhere, lot of transactions are happening, then there is a chance of risk. Then relying on an internal control, there is like a risky area. So depending upon that, he will determine whether should I focus there or not. Then significant industry developments such as changes in the industry regulations and new reporting requirements, all these things. If there are a lot of industry developments happening, so that is an area where chance of, it's a high risky area, so focus there. It's a significant area. Then if there is any significant change in the financial reporting framework, such as accounting standards, imagine a new accounting standard came which is applicable for the company. So that means what is that area? That is a risky area for them. Then other significant relevant developments such as change in the legal environment affecting the entity, all these things. Okay. Then two things are, these are very easy areas. Then development of an audit plan. What are the contents of an audit plan? Contents of an audit plan: nature, timing, and risk. I told you, audit plan will contain risk assessment procedure, further audit procedure, other planned audit procedure, nature, timing, and action of all this. Then audit plan, then simple. What is the relationship between audit plan and audit strategy? I told you audit strategy is small, audit plan is even more bigger. So audit strategy sets the broad overall, it gives an overall approach. Audit plan address various matters identified in the strategy. I identified, okay, these are the high risk areas. So in strategy, so in audit plan, we will discuss, okay, how to address those areas. Then audit plan is more detailed, changes in one result, a change in another, everything. Then changes in audit plan and audit strategy. So when you prepared an audit plan and audit strategy and you are doing the audit, so what are the circumstances which will create a change in them? Unexpected events, change in conditions, audit evidence obtained from the result of audit procedure. Because of these three circumstances, audit strategy or audit plan can be changed. You can change it because you fixed an audit strategy and audit plan and you are doing the audit. Suddenly some event happened in the company. Some CEO changed, or CEO was caught doing a fraud. CEO or the top management, someone was caught doing a fraud. So you were believing that guy was a good guy and you prepared the audit plan, audit strategy, everything related to that. But suddenly he was being caught for fraud. Now what is your option? Now you have to revise the audit strategy and audit plan. Yes. Then change in conditions. Earlier you discussed with the management that inventory verification will be happening on this date. And suddenly they are having some negative use against that. So condition, that is inventory verification condition changed. So then you can revise the audit strategy, audit plan. Audit evidence obtained from the result of audit procedure. Initially you were believing company was going good, everything, but you did the audit, you got audit evidence that company has a lot of fraud or something happening. So now you want to revise the audit strategy and audit plan. So in these three cases you will revise. Then planning, supervision, review of work of engagement team members. When will, like, planning, supervision and review of work of engagement team members. Audit, we have a team, right? So these teams work, they will be doing work every single day. So as an auditor, as a partner, engagement partner, how will I review their work? What are the factors that affects my review? Size and complexity of the entity, area of audit, assess risk of material misstatement, capability. These are the four factors that may affect my, as an engagement partner, my planning of supervising and reviewing their work. Because imagine the size of the entity. Imagine this one. Zomato is a very complex entity to audit. And I have, say, this is me. And I have three article assistants below me, A, B, C. And Mr. A is auditing in an area. A is auditing in an area where it is a very risky, high risky area. Imagine area of audit. He is auditing in a high risky area. And B and C is in a small, low risky area. Since he is auditing in a high risky area, I need to supervise and review his work more often. Because it's a risky area. If I don't check it regularly, sometimes he may commit a big mistake. But these two people are operating in a small area, like not risky area. So I don't need to review it weekly. I'll do it weekly or monthly or something. But here I'll do. So my review depends upon area of audit, size of complexity of entity, risk of material misstatement, and capability and competence. Imagine another case, A, B, and C. A is a new article. You don't know any work. Whereas B and C is a superb article. So their work I don't want to review because they are experienced. But A is a new article. I'll frequently review his work. So that is how it's affected. Got it, right? The point. Documentation, all the audit strategy, audit plan, and changes you make to audit strategy, audit plan, you need to document. You need to put it in a piece of paper, staple it, and put it in the document. Now it is electronic format, but I'm just saying. Then audit program. What do you mean by audit program? Audit program is a series of verification. I'll leave the definition. It's a set of instructions given to the audits, articles. This will be a set of instructions given to the articles. This is how you need to do the audit. Everyone. The seniors will give, okay, imagine for your understanding, it's a piece of paper in which definition, like each and every step, instructions, what you need to do in auditing, everything will be mentioned. Okay, do the risk assessment, then do this procedure, then do this procedure, everything will be mentioned. It's a set of instructions. That is what is audit program. How to learn the definition? Wait. Audit program consists of what does it consist of? Series of verification procedure. Okay. Why do we have this series of verification? To be applied to financial statements and accounts of the entity. What is audit program? It's a series of verification procedure, SVP. And why is it that for? Why is this series of verification procedures? Series one by one, series of verification procedures, checking procedures one by one written. Why do we have it? Because to be applied to the financial statements and accounts of the entity. Financial statements and accounts. It is applied. Okay, it is applied to financial statements and accounts. And for what purpose? For obtaining sufficient evidence. You're having that for obtaining sufficient evidence. Okay, why do we need that sufficient evidence? To enable the auditor to express an informed opinion. Simple as that. So break it down like this and learn it like that. It's a series of verification procedure. For what? Why? For what purpose? To be applied on financial statements and accounts of the entity. Okay, for what? For obtaining a sufficient evidence. And why do you want sufficient evidence? To enable the auditor to express an opinion. Simple. One audit program is not practicable for all business. Keep in mind. I am the auditor of Zomato and I am the auditor of Boat. Boat is a manufacturing company. So the audit program of Boat may not be suitable for Zomato. So always keep this thing in mind. One audit, what the problem is that these bigger firms, these chartered accountants, they'll fix one audit program and will give it to every company. They are lazy to make different audit programs for different company. So that is why it is said, evolving one audit program that is applicable to all business is not practicable. So depending upon business to business, study the business and make audit program accordingly. That would be better. If similar industry, if a Boat and JBL are my clients, at least I can use the same audit program with slight modifications. But Boat and Zomato, completely different business. One is a manufacturing, one is a service business. Different, right? Assistant to keep an open mind. So when starting the audit program, in the first week of starting the audit, give a base audit program. Don't give a perfect audit program. Give a base audit program. Let the audit happen. Like that is what we call give a minimum essential work. Like a standard program. To start with, give a standard program. Don't give a detailed, very big program. Give a standard program to do the audit. Let the audit do. So as experience is gained by 1 or 2 weeks we do the audit, we'll get experience. As experience is gained, then we'll understand a lot of things regarding the company. Now we'll know what are the things that are needed in the company, what are the areas where we need to focus more, everything. Now alter that audit program and make it a detailed program. First give a standard program with a minimum essential work. Then as experience is gained by, then slowly revise the audit program to make it a good program. Keep in mind. And always remember, in the first audit program you gave, lot of work was there. But after 1 week you understand some verification work is not needed. You can easily remove it, make a better program. That's it. Then the assistant who is doing the audit work, tell him, I have given you an audit program. Set of instruction is there. Please follow that blindly, follow that correctly. Along with that, don't just follow that blindly and say, okay, I've done everything. Don't do that. You have to follow that correctly. Plus, you have to keep your mind open to identify any fraud or error. Just don't simply like a robot following instruction and coming. Don't do that. Do it correctly. Plus, you have to use your own logic also to identify whether there is any problem or something in the company. You need to use your own logic. Keep your mind open. The auditor need to engage their article, promote them to keep their brain open to identify new mistakes. And if they identify something, Keep an open mind beyond program given to him. Then if he should be instructed to note and report any matters that come to his notice and tell his to seniors or partners. Don't just blindly follow the audit program, follow it, plus keep your mind open. If you notice any fraud or error or something, report it to your seniors. Done and dusted. Then periodic review of audit program. Periodic review means audit, what they do is that sometimes last year's audit program may be followed in this year also. Last year I audited board. This year also sometimes I may be auditing board. So I'll follow the same audit program. Don't do it. Because last year boat was a 10 crore company. This year boat is a 30 crore company. Some business policy, something may have changed in boat this year. If you follow the same audit program, you may not know this business policy change anything. So and your entire audit is gone because you are trusting a bad audit program. It's an obsolete audit program. So what you need to do, you need to do a periodic review of audit program. I'm just set this example, but this is not how it works. In current year also, if you are doing the audit, in periods, do a periodic review of the audit program you have. Just review it once in a while. Doing the current year audit. Okay, first you had an audit program. After like 2 weeks, just review it once, whether it is okay, whether everything is fine. Because I started auditing on today. 3 weeks I did the audit. Okay, sit. Just you have the audit program for the 1-2 months it is there, right? Okay, 3 weeks I did the audit. I got this much experience, everything. Should I need to review the audit program? Think in your brain. If you need to review. Should I need to alter the audit program? You sit and do a review. All this periodic review is needed. Otherwise, you will be carrying on audit on an obsolete audit program and your entire audit will be gone. So there should be a periodic review of audit program to assess whether the same continues to be adequate. Is it okay for now also? If it is not done, any change in the business policy may not be adequately known and whole audit may be negligently conducted. All these things, it's very easy. Just understand. Then constructing an audit program. When developing an audit program, what are the things you need to do? Always stay within the scope and limitation of audit. Scope and limitation, which is studied in chapter number 1. When you are framing an audit program, stay within that scope and limitation. In scope, there are things that which we don't need to do. For example, auditor is not an expert in authentication of documents. All these things are there, right? So when you are making an audit program, make sure it is within the scope. Don't put anything that is outside our scope. We cannot do investigation. So in audit program, don't mention like something regarding investigation. We cannot do that. And limitation also, our limitation also keep in mind. So just read it is very easy. Prepare a written audit program, which we written program we need, and like steps and procedures. It's very easy stuff. You can read it. Then this is also not that important. Then how auditor will collect the evidence through documentary examination, physical examination, statements, arithmetical calculation, minutes, all this simple stuff. Then what are the advantages and disadvantages of audit program? Advantage, swift SPA. Swift selection of assistant becomes easy. You have an audit program, you know what are the steps to be done. Now you know it's a serious step. Okay, select experienced articles. If it's like easy step, select unexperienced articles. So selection of assistants becomes very easy. If you don't have a written audit program, without a written audit program, you will be following steps in a mental plan, right? How can you follow a mental plan? Tell me, you are having 1 or 2 months down the line, you are having exams. Can you follow a mental plan? Can you plan mentally? No, right? We'll plan and put in a piece of paper. That only will work. Mentally planning and studying something will not work. So without a written audit program, work will be carried on a mental plan and we'll ignore something, we'll miss something, all these things. Swift SPA, selection of assistant becomes easy. Without a predetermined written audit program, work will be carried out on a mental plan. In such a situation, there is a chance of danger of ignoring and overlooking books and records. SWI. Audit program provides a clear set of instructions. I told you. F. It is a guide for future audits because we did what is audit program followed this year. We can next year when we are doing the audit, we can refer and make a new program next year, right? So guide for future audit. Then T. Total. It gives a total perspective of work to be performed. If you are sitting at day 1, you will know if you are sitting at day 1 and doing the step number 1. In the program, step number 10 will be there. So you will know what are the steps you need to do till the next like 1 or 2 months. So it gives a total perspective. So swift SPA. S means selection of assistants becomes easier. Selection of assistants depending upon program. W. Without a written audit program, work will be carried out without a predetermined written audit program. Work will be carried out on the basis of mental plan. So there is a danger of overlooking books and records. S. Selection of assistants. Without a written audit program. I. It provides a clear set of instructions. F. guide for future audits. T, total perspective. Then fifth, SPA. S means by putting the signature, article assistance, when I give the program, I'll tell them, okay, when you do this, finish it, give it a signature and give it to me. Or when I give the program itself, sign, like you are taking the responsibility for doing this. Once I finish it and give it to me, now, if any problem happens, I can scold him. You told this is a program, you did, and you signed and gave it to me that you finished it. Now tell me what is wrong with this. So it puts an accountability on them. It puts a responsibility. When article assistant signs audit program, then they become responsible for that program. Then SPA, principal can control everything because instructions are given like 3 days after the audit. Like audit is going on for 1 month. So second week I can call all the articles. Come. Give me your audit program. How much have you done work depending upon the program? Only 30%. Why are you not doing it? I can, like, principal can control the progress, whether they're doing good or doing bad, everything, because I have given them instructions. Then a properly drawn up audit program serves as a evidence in the event of charge of negligence being brought against the auditor. I did the audit today, 2 years after some case came against boat. I did the audit of boat. So, and they suddenly told auditor was the problem. Auditor did the auditing. He was the fraud. Suddenly they put the blame on me. I can say this was my audit program. I documented it. This was my audit program. These steps I have already done. You guys have hidden the fraud in a bad manner. I was not. I only gave reasonable assurance. You can give the audit program and say I have done all these steps. You can get excused. Advantages of audit program. Then what are the disadvantages? Hurry is mine. In the hard and fast audit program will kill the efficiency of articles. Some articles will be there. They are so good. They want to explore more. They want to use their brain. But when they are given this set of instructions, it will kill their initiative, right? They have to blindly follow that. Hard and fast. Hurry is mine. Hard and fast audit program. RI becomes the program often tends to be rigid and inflexible. That is it. Hurry is mine. The work may become mechanical. Every day doing the same thing. It may become mechanical, and sometimes the articles may not even understand what are the objectives of work that they are doing. Why they are doing this work? They may not even understand that. Why they are doing this work? They may not even understand. They will simply follow the steps and go. Why are they doing that? So the work may become mechanical. Articles may not understand the work. That is another problem. Hurry is mine. Hard and fast audit program. HA, RI, rigid and inflexible, is mine. Work may become mechanical. INE. Inefficient articles may take the shelter behind audit program. Means there may be an article. I told him follow the audit program and use your own brain also identify something. And this guy, he simply follows the audit program and some basic things, some vouching etc. was not written in program. Imagine some basic vouching procedure was not written in the audit program and he did not do that. In a common sense, a first year foundation student will do that, but that stupid guy don't do that. And when I caught him, why didn't you do the normal vouching? He told, sir, I did everything in the audit program. It was not mentioned in the audit program. He'll wash off his hands and go like that. So these kinds of inefficient articles will say, I have done everything in the audit. They'll hide behind, they'll take a shelter behind audit program. That should also be removed. I mean, that is also a disadvantage of audit program. In a common sense, he should have done that work, but he'll say, no, I followed audit program. I did everything. He'll take shelter behind that. So these are the advantages and disadvantages of audit program, and this chapter is done. And if you like the content and if you want to watch the video slowly, if you don't understand anything, watch it one more in 0.75x, you will understand everything. That is why it's a revision video. I have to make it below 1 hour. That is my pressure on handling this. I touched every points in this book. I touched every points in this chapter. So done, understood. If you like the content, give it a thumbs up and just write in the comment box whether you like the, just to support me. If you want, you can just put an emoji and how you felt about the chapter. That's it. So, and just write it in the comment box. Don't write in the comment box. If you are new to this channel, kindly consider subscribing to this page, and see you with chapter number 3. So chapter number 3, that is risk assessment and internal control, one of the most technical chapters in CA Inter. And so let's see, this is the chart of the the structure of the chapter. That is chapter number 3. First we'll learn about what is audit risk, then we'll learn about 315, then immediately we'll learn about 330, 320, internal controls and automated environment. Okay, this is what we are going to learn. What is audit risk? It's a risk that the auditor gives an inappropriate audit opinion when the financial statements are materially misstated. Financial statement has material misstatements, and auditor telling that financial statements are free from material misstatement. He is saying that he is giving an unmodified opinion. That is what we call audit risk. Okay, then Risk of material misstatement basically exists at two levels. Risk of material misstatement that affects the overall financial statement level, and one that affects the assertions. An example for this would be an accountant is inexperienced. Imagine an accountant in the company is inexperienced. He don't know how to put a proper journal entry. So at least around 10 to 20% of entries he is putting is wrong. Management makes financial statements from this journal entries, right? From this journal ledger to financial statements. So whatever happens, that at least 5 to 10% of the mistakes will be there. Since the journal entry is wrong, the financial statements may be wrong. So what happens here, when he is putting the journal entry, some expenses may get affected, some asset or liabilities, most of these entries can go wrong. So because of one small problem, that is accountant is inexperienced, because of one problem, the many entries, many amounts in the financial statement is getting misstated. Because accountant is inexperienced. What does that mean? The entire financial statement may be wrong. So it is that risk, the risk that the accountant is inexperienced. That is a risk. That risk affects many assertions. The entire financial statement items are getting affected. Expenses, there may be mistakes. Assets, there may be mistake. Liability, there may be mistake. That is what we call a risk of material misstatement that affects the overall financial statement level. Many assertions in the financial statements are getting affected. Many items. And this one we call risk of material misstatement at assertion level means a risk that affects assertions only. A few assertions. For example, a plant and machinery amount was wrong. You put an amount in the plant and machinery, that amount was wrong. It basically affects only the plant and machinery, that one assertion, the valuation assertion of plant and machinery. Or imagine your any other mistake that affects only few assertions is what we call risk of material misstatement at assertion level. And assertion level for class of transaction, it means group of transactions, basically P&L items. AB, account balances, that means basically balance sheet items. Okay, then other disclosures. A risk that affects many assertions, that affects the entire financial statements. A risk that affects only assertions. Okay, and this one is divided into two, that is, one is inherent risk and the other one is control risk. Inherent risk means whatever you do, there is a chance of risk. That is what we call inherent risk. Imagine you are driving a car, then that car is the best, safest car in the world, say Volvo, BMW or something like that, Rolls Royce. Imagine your car has 35 airbags and you have constructed a road for yourself. The road is yours. No other vehicle, no pedestrian, nothing is there. And you have the best driver in the world also. But still, can you say you are safe? No. Because your tire may burst. And still there is an accident possible. Or the driver may feel sleepy. Right, like he sleeps off, the accident possible. Even if not like that, in Ahmedabad we saw an airplane can come and crash onto your car. That is also possible. Earthquake can happen. So whatever can happen. So whatever you do, there is a chance of risk. This risk is inherent in a car. When you're traveling in a car, that risk is inherent. Whatever you do, still there is a 0.1 chance of risk. Similarly, in the financial statements, whatever you do, there is a chance of risk. That is what we call inherent risk. It is susceptibility of an assertion about a class of transaction, account balance or a disclosure that could be material. That could be material before considering any related controls. Even before you put any control, like in the car I told you, you are putting airbag, best driver, best thing. Similarly, in financial statements, to avoid mistakes, to avoid accidents, you are putting lot of controls, internal controls. But still there is before you even consider this control, there is a chance of risk. That is what we call inherent risk. Okay, then what is called control risk? You put lot of internal controls in financial statements, and this control is unable to prevent, detect or correct a material misstatement. Why are you putting control? You put you know what is internal control? It's something that is put by the management to prevent a fraud or error happening, to prevent from a fraud or error happening. 3, 4, 5 accountants are there. Management put a supervisor. The supervisor will check whether the entries put by accountants are correct. So he is an internal control. The company has a warehouse where a lot of inventories are kept. Imagine it's a company like a bottle or anything. All those companies. So imagine like a Vicks company, this inhaler company. So inhaler is a small item. So people may easily steal it. So company put a 3, 4, 5 CCTV cameras there. So that camera is an internal control which is preventing the people from stealing it. That is an internal control. So company is putting lot of controls like this to prevent, detect or correct. So to prevent, detect or correct a material misstatement. But when these kinds of control are ineffective, a risk coming from that is called control risk. You put a CCTV camera, the CCTV camera was not working properly, so some people stole the things. So the inventory figure got affected. So in the inventory amount in the balance sheet got affected. So that risk is what we call control risk. You put a supervisor to check 5 accountants, but that supervisor one day took off, and in that day some fake entries were came by these people. So that risk, he is a control, but he is not functioning properly. That is called control risk. What is detection risk? Detection risk means auditor unable to the risk from the auditor side. Auditor is unable to detect. Auditors procedures are unable to detect a material misstatement. Because why? What is our duty? We are the auditors. The company hires us. We come, we check the financial statements, and we will need to detect the material misstatements in the error in that, right? That is our duty. But we are unable to do that. We performed a lot of audit procedures, but we were unable to identify the actual risk. That is what we were unable to detect it. That is detection risk. Risk that the audit procedure performed by the auditor to reduce the risk will not detect a misstatement that could be material. That is auditor's procedures unable to detect a material misstatement. Detection risk is divided into 2, sampling risk and non-sampling risk. Sampling risk means you have 30 invoices are there. Imagine just a calculation, like imagine 3000 invoices are there. You cannot go and check these 3000 bills properly, right? You means auditor. So you picked 50 from them as a sample. And when you checked the 50, entire 50 was correct. Everything was correct. So you concluded that the entire 3000 bills are correct. Because when you do sampling, you do like that, right? For example, you are cooking a rice, or 1 kg rice on a pot. You are not going to eat all the rice and see whether it is cooked, right? No, right? What will you do? You will take 1 spoon, scoop 1 spoon and eat it and see whether it is cooked or not. If that spoon is cooked, you believe the entire rice is cooked. Similarly, 3000 invoices. From that you picked 50. When you checked the 50 whether it is correct, you believed, okay, entire invoices are correct. But what happened? That 50 may be correct, but there may be other many bills, many other 300 or 100 or 500 bills may be there which are actually fake. But because of their luck, it could not come in your bills, the bills you took. You checked 1 spoon of rice, but there are other areas in the pot rice where it is not cooked properly. That risk is what we call sampling risk. That is the risk that the auditor's conclusion based on the sample. I checked 50 invoices, and since 50 was correct, I believed the entire financial statement is correct. That was my conclusion based on the sample, may be different from the actual conclusion if the entire population was tested. If the entire 3000 bill was tested, the 100 or 200 fake bills would have been revealed. So your conclusion, you concluded everything is correct. Your conclusion was wrong. That is what we call sampling risk. Your conclusion was wrong if entire item was tested, entire item was checked. Non-sampling risk, any other risk other than things not coming from sampling. Auditor reaches erroneous conclusion for any reason not related to sampling risk. And now let me tell you, this inherent risk and control risk, both of these things are belonging to the entity. It is entity's risk. Auditors, this is detection risk is what? We are auditor, we are an independent person, we are coming from outside. So detection risk is basically auditor's risk. It's in auditor's head. It is auditor's responsibility. Inherent risk and control risk is management's responsibility. Got it? Okay. Then what is not included in audit risk? Auditor's business risk. Auditor will have his own business risk. Auditor, this is the company. Imagine this is the company and this is the auditor. Company is a separate entity. Auditor is also a separate person. So company, we are coming to audit this company's financial statement. The auditor will have his own personal risk, right? His own personal risk. Another 300 chartered accountants opening CA firms near to his city. That is his personal risk, competition. And that is not included in the audit risk of the firm. When we talk about audit risk, it is audit risk of the firm. Audit risk of the client, the company. So auditor's business risk, his personal risk. That is not included in this. So that is not included in company's audit risk. Audit risk means company's audit risk. Then auditor giving auditor expressing that financial statements are materially misstated when they are not. He is saying that when he checked the financial statements are actually correct, but he is saying that financial statements are wrong. That is what we call this one, but that is ordinarily insignificant. No auditor will say like that. Okay. Then audit risk is divided into 2: risk of material misstatement, risk detection risk. Because Risk of material misstatement is basically divided into at the financial statement level, at the assertion level. At the assertion level, it is inherent risk plus control risk. So risk of material misstatement is like this, and detection risk means auditor sampling risk, non-sampling risk. You have to keep this formula in your head. Okay. Then SA 315. Before we learn SA 315, let me show you the concept of audit procedures. The entire audit procedure, you learn, right? Audit procedures is basically divided into two. Number one is called risk assessment procedure. Number two is called further audit procedure. This risk assessment procedure comes under SA 315. This is a core concept. Please be with me. This further audit procedure comes in SA 330. Got it? This risk assessment procedure, basically inquiry is there, inspection is there. What is inquiry, inspection? Observation is there, analytical procedure is there. Further audit procedure is divided into two: substantive procedures and test of controls. Substantive procedures are divided into two. What was a test of details and substantive analytical procedure. Here I'll only say this one time because this is a marathon. I cannot repeat it multiple times like we do in class. Here you have to keep this in mind. This is what we call the entire audit procedures. So this is audit procedure. So auditor uses this analytic risk assessment procedure. Let me say what is the difference between all this. Let me ask you, tell me what is the difference between test of details and substantive analytical procedure. Or tell me the difference between this substantive analytical procedure and this procedure. Tell me what is actually substantive procedures. 99, not 90, like 80% of the CA inter students don't know the exact meaning and things of this. Marathon I cannot explain too much, but still will touch upon this so that you will get an idea. Okay. Risk assessment procedures means before we start the auditing, all the agreement, everything was entered between me and the client. So what I am the auditor. I will have an audit team, right? So our team will either go to the company or sit at the company. Basically, hypothetically imagine for your study purposes. We will go to the company, client company. We will sit, we will inquire to the management, all these people, talk to them. Okay, how is your company performing this year? How it was last year? What are the risks your company is having? Just we'll talk only, inquiry. Then we'll inspect some documents. Basically, we have not started the exact, this is basically not the audit. We are here just identifying on the risk. Risk assessment procedure means we are actually inquiring the people, inspecting them. We are observing how the company is happening. We'll go to their factory, how it is happening, how the accountant is entering the journal entry, how the purchase is actually happening, how the sales are actually happening. When the order comes, how the shipping is done. All those things we'll see. We'll also perform analytical procedure, that is comparison. We'll compare current year financial statements with the last year financial statements. And from items, for example, sales and sales. Okay, sales this year 10% improved. All these things. That is what we call analytical procedure. I'll explain more in SA 520. So here actually what we are doing is that we are just with these four procedures. We are just identifying, we are understanding the entity. If you wanted to get into a relationship with a girl or a boy, immediately you are not going to go and say I love you, right? You'll first spend at least 1 week dating them. I don't know how the modern world works, but at least you'll spend 1 week dating them. So in that period, you will understand that other person. Similarly, before starting the audit, don't go and say I love you in the auditing time. Before that, you understand the business, understand the client first, and identify what are the risks of that client. If you wanted to go, for example, you are going to approach a girl or vice versa, a boy, whatever it is, your gender, you think accordingly. So when you are going to approach a girl, first 1 or 2 weeks, at least minimum, you will date that girl and just see how the person is. You will understand them. You will understand what are the risks associated with that girl. Is that girl having another boyfriend? That is a risky thing for you, right? Is that girl coming from a rich or like a Gunda family like that, a whole powerful family? So if you go and approach her, sometimes you will get beaten up. So all those risks are there. Is she a good girl? All these risks are there, right? So first you will spend some time, at least a week or a month, analyzing. First you will identify those risks. Okay, she belonged to a rich family. That is called identification. She belonged to a rich family. Her parents are very like in a gunda type people, and she had like 3 or 5 boyfriends before, like vice versa. If it's boys, girls, okay, opposite, please. Okay, so that you'll identify all the risk. Then you will assess those risks. Her family is a rich family, identified. Now you are assessing the risk. Okay, since her family is a rich family, will they come and beat me? Do they have a history of beating the girls' boyfriends? No. That is called assessing the risk, how deep the risk is. So you will assess all this risk. First you will identify the risk. Then how will you do that? You will inquire to her friends. You will inspect other places wherever she is going. You will observe what is happening around her daily. Without her knowing, you will go behind her and observe. You will perform analytical procedure. Sometimes you will compare her with your previous girlfriend and see who is better. Comparison is what we call analytical procedure. So the process of this is what we call risk assessment procedure. You are identifying the risks and you are assessing how deep the risk is, how risky it is. Similarly, you are going to a company, you identified all those risks. What are the accountant is inexperienced? The internal controls in that company is weak. All those risks you identified. That is, you do that through risk assessment procedure. Here you are not performing any detailed checking. Here you are, that girl's risk only you identified. Now you don't, in the risk identification, you don't go and talk to the girl and do all these things. No, you'll just observe her and identify the risks. Okay. Once you identify the risk, then you'll write it in a piece of paper. Sir, these are the risks that we identified. All the risk of that girl or the company, you identify all the risk. Whatever risk you identified the risk, you write. Then you analyzed how deep the risk is. All these things you will write. Then what you do? Then you will check. Then you will test that risk. Whether that, for example, that girl had 2-3 boyfriends. You know that. And that you identified and assessing from that, this area you identified girl had 2-3-4 boyfriends in the past, or the boys had 2-3-4 girl in the past. Now you know the risk. Now what are you doing? Now you need to check. Okay, is that a serious risk? Should I go and approach her? Risk you identified. Now you need to check whether it's actually a risk or not. Having 2-3-4 girlfriends or boyfriends, it's a risk. But if like she was a good girl or he was a good boy, then actually what is the problem? Loving happens. That's not a problem. Having multiple relationships in the past is not a problem. But now how she is, so we need to check her, right? So check her or him. We go and deeply check her. That is like we go to her friends, inquire her, we talk to her, we go for a coffee outing, we go for a drive. At time when we are talking to her, we understood. This time we thought, when we are inquiring, inspection, all these things, when her friends and our friends told us, oh no, please don't go with that girl, all these things. You are auditing a company at that time, you identified the risk. Now you are testing whether it is actually a risk or not. Whether to see whether she is actually good, actually good or bad. The deep checking, that is happening in further audit procedure. In risk assessment procedure, you identify the risk related to the company, and the further audit procedure, you will check that in detail. Test of control means you will check the internal controls. This process, test of control, means you are checking the internal controls in detail. Substantive procedures means you are using some procedures. Substantive means checking the substance, checking the deep. Here you noticed accountant is inexperienced. Now through substantive procedure, you are going to each and every single journal entry, every item, taking it, vouching it to the invoice and doing the detailed checking. That is what we call test of details. Taking a bill, a test of details is also divided into two. You can say number one is vouching and the other one is verification. Vouching and verification, you do the detailed checking. And substantive analytical procedure means it's basically a comparison procedure. We learned that in SA 520. Okay. So this is first, through risk assessment procedure, we'll identify and evaluate the risk and just keep it. We are not testing it. Through further audit, then we will, based on our identification, we will design our testing process, how our testing process should be, how our checking process should be. And that checking is what we call further audit procedure, FAP. Okay. Okay, this is the core concept. Now let's move quickly. For the purpose of identifying and analyzing the risk, what should the auditor do? That is risk assessment procedure. What will the auditor do? He will first identify the risk. What are the risks, chances? Identify and keep it. Then he will assess the risk. Whether that risk is an actual risk or not, he will just assess it. Okay, assess the impact of that risk. How tougher it will be. If you identified accountant is inexperienced, identified. What is the impact? How much journal entries will be mistaked? What is the amount that will be misstatement? That is assessing the identified risk. Then relate to the identified risk to what can go wrong at assertion level. Because of that risk, how our assertions will get affected. Then consider the likelihood of a misstatement. That is, yeah, you identified the accountant is not working properly. He's inexperienced. Because of that, what is the chance of misstatement, and when that misstatement happens, what is the potential magnitude of impact? Accountant is inexperienced. So what is the likelihood of misstatement? We can say if he is putting 10 journal entries, at least one will be wrong. So likelihood of misstatement is 10%. 10 out of 1, 10% we can say. And what is the impact of the mistake? Impact means the mistake, he'll be creating that one mistake, right? What is the amount of that mistake and what is the impact, the percentage you can say. Say for example, he don't know how to put the, he is very bad in recording journal entries related to sales. Imagine purchase and expenses he knows. Sales he is very bad, like the debtors, creditors, he don't know in all these things. Then trade receivables, bills receivable, all these things he don't know. Journal entry, bill discounting, all these things he don't know. So what happens? That is a bigger bill. So all the error he is creating is actually bigger errors. So the potential, the magnitude of misstatement, the size of the misstatement is huge. You can say. So that is this one. Okay. Then understanding the entity and its environment. That is here essay 315. As per this, identifying and assessing the risk of material misstatement through understanding the entity and environment. We are understanding that girl and identifying the risk. Okay, keep this example in mind. You will never forget. Okay. Then how you will understand, what are the things you are understanding? That is, auditor shall obtain an understanding of these following. When you are going to understand a girl, you have to obtain an understanding of this. So when you are going to understand an entity, business, before auditing, understand these things. That is, what is a relevant industry? Let's take a company like Mama Earth. Relevant industry is skincare or skincare like shampoo, all this. What is the industry? Then what are the regulatory rules, what the laws and regulations applicable to them? Safety laws, all these things will be there because Mama Earth products we are applying on face and all. So detailed laboratory checking, all these regulations, rules will be there. Then what is the applicable financial reporting framework? It is a company. So Companies Act is applicable. Then if it is listed in the stock market, then some SEBI regulations will get applicable, all these things. The nature of the entity. Nature of the entity means what is the operations. You can say what are the operations, how Mama Earth's operation is happening. They are basically how they are actually producing the goods, how they are selling it, and through which channel. So it is basically D2C brand, B2C brand, no B2B is happening. All these things is what we come under operations. Then we can say ownership. So who owns Mama Earth? Varun Alag and Ghazal Alag on Mama Earth. That is ownership. Then the governance structure. Who is the CEO? Who is the CFO? Who are the board of directors? Who are the management? That. Then what are the type of investments company will be planning to make and how the entity is financed. All these things you will learn it in nature of the entity. That we learn deeper. So see, nature of the entity. That we learn. Then what is the entity selection and application of accounting policies? All the related to inventory valuation, revenue recognition, all the accounting policies related to entity, you need to understand that. Okay. Then what are entities' objectives and strategies? Objective means a goal. What is your goal? To become a chartered accountant. That is your goal. Okay. That is your objective. Strategy means how to reach that goal. That is strategy. Approaches you take to reach that goal. Objective to become a CA. What is strategy? First, study this one subject, auditing, finish it. Then next subject, finish it. So first step you are crossing is CA inter. Then you have to do the GMCS, then coaching, then articleship, then you need to clear CA final. That is the steps you need. CA final is the end goal. That is objective. Strategy means the step you are taking. Then measurement and review of entities' financial performance. How entity is measuring their financial performance. You are reviewing that. No, you are not going to measure entities' financial performance. No. You directly going and measuring their financial performance is there, but that is not, this is not that. This is means entity will have a tool to measure their own financial performance and you are checking that. The measurement and review of entity's financial performance. How entity is measuring the financial performance, you are coming and reviewing that, how entity is doing it. Entity eppadi pannittu. Okay. Then relevant. So first relevant industry regulatory, you just read it, nothing is industry conditions, you need to understand market and competitions, you need to understand what if the seasonal activities or product technology, all these things. Then Nature of operations, nature of entity, we learned operations of the entity, ownership and governance structure, type of investment entity is planning to make, how the entity is structured and finance. Okay, this thing is okay. This same thing, they have written it in a different same line. Okay, then entity select accounting policies, all these things. Then this one, how entities measuring their financial performance. We need to understand this one. How entity is doing that. Okay. An understanding of the entity's entity's performance measure assist the auditor in considering whether the pressure to achieve performance target may result in management actions that increase risk of material misstatement due to fraud. Which means that we'll take a company like Byju. Be with me. This topic is important. It's not like you'll sometimes you may not get it properly. That is why. Okay, let's take a company like Byju. You would have all heard the rumors that, I don't know whether it is rumors, but I think it's a bit truth on that. You would have all heard that Byju telling that Byju company salary is huge, but lot of pressure will be there. Pressure to the people, to giving them sales target. That is, you have to complete 100 sales this month. And that kind of lot of pressure target will be there. So what happens at the end of the month, say for example 30th of the month, 100 is target. Imagine one salesperson, he was only able to complete 95 or 93. What will he do? If 100 is not completed, his job is gone, and they are paying huge salary also. So he don't want the job to lose that job. But he was able to practically complete only 93. So what will he do is that 7 transactions, he'll put some fake invoice and put some fake entries and say that he completed 100. And why? So fake entry, 7 fake entries he is putting, that salesman. Salesman saying 7 sales also happened. Something like that, some fake entry or some fake things he'll put. So what happens? He put 7. Another salesman also put some entries like this. And all this affects the sales figure of Byju. Sales figure of Byju is getting affected. So it creates a very big misstatement. And why is this happening? The entity, the Byju is measuring the performance of their employees, their financial performance, by giving sales target. If an employee is able to achieve sales target, then this is it. Just understand the hypothetical example. So because of the performance measure, because of their performance measure, measuring the performance of an employee or measuring the performance of sales, financial performance, they were using pressure tactics. Because of the pressure tactics, employees were committing fraud. So their performance measure was not that good. Hope you got it. So as an auditor, the first thing you need to understand is how entity is measuring the performance. Byju was measuring the performance through this. How entity is measuring the performance, what is the tool and strategy they are using, and whether that tool and strategy is leading to is causing, because of the pressure, is it causing a fraud in the company, management to commit the fraud. Okay, so company may be using many performance measures. Number one will be key performance indicators. They will be looking at the revenue rate, revenue growth rate, or some return on equity, return on capital employed. Any things they may be looking at. Many key performance indicators are revenue growth rate. Last year's what was the revenue growth rate? This year what is the revenue growth rate? And if the revenue growth rate is not good, shareholders will start bullying, harassing the management. And what happens? Management next year will put some fake entries, right? Because they don't want to get the harassment. So what as a performance measure company is using, and you are just checking that whether because of that performance measure any fraud is happening, any pressure is there, so that manager will commit the fraud. So key performance index, some revenue growth rate, all these things. On key ratios they will be using, some current ratio, debt equity ratio, some net profit margin ratio, something like that, all the ratios. Then period on period financial performance analysis will be there. Credit rating agency reports, this CRISIL, CIBIL, all these credit rating agencies are there, they'll give reports. Then looking at the budget, forecast, variance analysis, all this. So company will be using these types of measures to measure their own performance, and you are coming and just checking whether these measures, you are just understanding these measures and seeing whether this measure creates any fraud or any issue in the, because of this measure any fraud or error or issue happens in the company because of the pressure. Okay. Then understanding that it is a continuous process, it's easy. Then risk assessment procedures we learned, inquiry, analytical procedure, observation. Inquiry, so inquiry means Enquiry means what? Enquiry. You are just talking, asking questions. That's it. Enquiry. Information obtained by the auditor's inquiry is obtained from management and those charged with the financial reporting. You go to the management, you ask the questions you wanted, they'll give the reply. That is enquiry. Got it? Okay. Then, what are the examples of some of the enquiries? Examples means how the enquiries is happening. Enquiry of employees. You are going and talking to the employees. Enquiry to the employees will be there. Enquiring to the in-house legal counsel. You talk to the legal team inside the office. Some company secretaries or advocates will be there. So they will give you idea about what are the cases against the company, cases in favor of the company. See whether company has complied with all the laws and regulations. If any fraud is there, they will give you information related to that all. Then you will inquiry directed towards marketing and salesperson. You will talk to the marketing team. So you will get what is a sale trend happening. So last year, what was the marketing trend for the company? What is the marketing expenditure for the company? You look at the sale trend. What is entity's current marketing strategy? All this you will understand. Then entity internal audit personnel. When you talk to the entity's internal audit team, you will get an idea about how entity's internal controls, is it satisfactory, how they have designed that, the effectiveness of internal controls, all this. Then inquiries directed to risk management function. Bigger entities will have a risk management team. When you talk to them, you will identify what are the risks company may be having, what are the operational and regulatory risk company is having, all this. Then inquiry directed towards information systems, IT system. What is system of control failure, all these things you will get an idea. Got it? Okay. Then what are analytical procedures? We'll learn analytical procedures more detail in essay 520. Okay, because it requires a bit of explanation. Analytical procedures, basically it means comparing two information. Last year's financial information, financial statements with this year's statements. You compare last year's sale, current year sale. What is the growth rate? And from that, okay, only 20% has been grown. Okay, 20% is a good number. Yes, company is performing well. Or when you compare current year growth, last year's financial statements and this year, you looked at the assets. Then you understood a lot of assets got sold this year. Why was that? Whether company is having an issue. When you compare this to you got an info. You compare last year asset with the current year assets. And when you understand that, you understood this year many assets were sold. So because of that selling, why was that selling happening? Whether the company is having any fund shortage, and you will go and inquire to the management. Then management will say, then you can have company is having a lot of fund shortage, and because of that reason, a lot of issues will be there. So chance of fraud is there. They may do it. So that way, when you compare two things, when you compare a financial info with a financial info or a financial info with a non-financial information, you'll get and comparing two things and identifying a relationship from that. That is analytical procedure. Okay. You see, another example I can say it, or I'll say it in 520. That is better. Okay. So just from here, analytical, it's identify the aspects of the entity which auditor was unaware. Auditor was unaware about company sold the assets, all these things. When he compared the 2 years assets only, he became aware of that aspect. Company has a financial shortage. He never knew that. But when he compared two things, he found out the asset got sold this year more. When he talked to them, they told because of the fund shortage. So if he have not compared, he would have not got that company is having a fund shortage issue. So analytical procedure. So because of analytical procedure, he identified the fund shortage, identified the aspect which he was unaware. Got it? Okay. Then comparing financial and non-financial information, relationship between sales and square footage selling space. This is financial, this is non-financial. Current year sales, 10 lakh. Okay, just see. I'll see. This is previous year. This is current year. Previous year sales was 10 lakh. And previous year selling space. That is space where these goods are kept. Just think. Selling space was say, so 1,000 square feet. Just example. Or just say, don't look at the space. Let's look at, this is finance. Sales is a financial information. It's mentioned in rupees. So financial. We look at the quantity sold last year. Quantity sold was 1,000 units. So with 1,000 units, company got 10 lakh profit. But this year, company got a 20 lakh of sales. Company got a 20 lakh rupee sales. This is rupees, so financial info. But the company sold only 1,700 units. So what does this mean? Last year from 1000 units, so company got 10 lakh. But this year from just 1700 units itself, the company got double the double 20 lakhs. So to get 20 lakh profit in the last year's case, this year we would have sold 2,000 units. But with just 1700, we got this. So that means company is performing really good this year. Here, this was a financial info, non-financial info. You took this and you took this. You compared both financial info, non-financial with another financial, non-financial. You identified company is performing really well. Okay, so this is all analytical procedure. Got it? Then observation and inspection. You sit and observe. You go to the company's factory and observe how the goods are produced. So you'll get an idea how a fraud can happen at this place or how an error can happen. You go to their accounting team, finance team and sit at one day. See how the journal entry is happening or talk to them. How the entries are happening. So you will get an idea what errors they may make. Okay. That is observation and inspection. Then materiality. How many of you know actually what is materiality? I'm not going to explain too much. We'll just explain what is needed and we'll move. Okay. Okay, this is essay 320, materiality. I'll just explain from this quickly, then we'll go to other areas. Okay. Essay 320, risk assessment, internal control. Essay 320, materiality. It's not materiality, it is materiality in planning and performing an audit. Okay, you have to say like that. Materiality, for your understanding, now exam is happening, it's a marathon. Okay, so it's basically a prioritization tool, how to give priority. For example, if God comes and asks you, who are the people who loves you the most or who you love the most, you'll have a priority, right? Mom, dad, your girlfriend, boyfriend, some cousin, brother, all these things. You'll have a priority. Prioritization. Similarly, materiality is a prioritization. It means when in the financial statements, what is that amount of mistake? What is the amount of misstatement because of which users' decisions get affected? That is materiality. It simply means that an example. We'll draw and show it you. So I think that would be better. A mistake in the, you know who are the users. So let's take one users as a bank or not bank. Let's put it as or else let's take it bank itself. Bank is a user. Bank or creditors are users of our financial statements. They uses our financial statements. In the inventory figure, there was a material mistake. There was a not a material, I'm saying. There was a misstatement of, say, the actual figure is 10 lakh. This is the original correct figure. But because of some mistake, you wrote it as 15 lakh is the amount in the financial statement. And this is a mistake. So 5 lakh difference is there. Okay. And with this financial statement, if you go to a bank and ask for a overdraft or a cash credit loan, they look at your inventory figures and they give you loan based on that. So when they see 10 lakh, they would give you a 7 lakh loan. So this should be the actual loan you should be getting. But when they see 15 lakh, this is actually a wrong figure, but they don't know that this is wrong. When they see 15 lakh, they'll give you at least a 12 lakh loan. So if this was the actual figure, instead of 12 lakh, you would have only got 7 lakh. So their decision, this is the decision, that is seeing the 15 lakh, they gave you 12 lakh. That is their decision, right? But this was a misstatement. So actual amount of inventory is only 10 lakh. So the amount that should be given to you is only 7 lakh. So just think what happened. Because of one mistake, a user's decision, bank was a user, his decision got affected. Actual loan which is eligible for you is only 7 lakh. But seeing the fake 15 lakh, they gave you 12 lakh. So 5 lakh, almost 5 to 6 lakh rupees. Not 5 to or 5, just say they gave you 13 lakh. So 6 lakh rupee it's actually a wrong thing for them. Their decision got affected. Or seeing your profit figure, this is one example. Another example, your actual profit is a 10 lakh, or actual profit is a 1 crore. But there was a mistake in the expense because of which your profit is shown as 1.5 crore. And an investor, imagine I am having some fund with me, but when I see, okay, 1.5 crore, a company is really good, let me invest in money. I put my money there, seeing the profit, seeing the financial statements. I'm a user, investor. I put my money in, but the actual profit is only 1 crore. If I see the profit as only 1 crore, I would have never invested. But only when I saw the profit as 1.5 crore, I invested. So 1 crore, if it was actual the profit, I would have not invested. So my decision got affected. In two cases, my decision would be different. If the profit was 1 crore, my decision, I'm not going to invest. But seeing the fake amount of 1.5 crore, my decision became, I will invest. So my decision got affected. And what is the amount of misstatement that is creating this? In that case, imagine, like the case I told you, say 1 crore, 1.5 crore. This is 1 crore, this is 1.5 crore. See, 1.5 crore I invested. If it was 1 crore, I would have not invested. If it was 1.1 crore also, I would have not invested. If it was 1.2 crore, sometimes I would have invested. So the difference is, just imagine, this is the hypothetical, just the difference is, say, imagine a 30 lakh. If it was 1.2 crore also, I would have invested. So 1.2 crore is a problem. Just imagine. So what is the difference? So this amount, example, you leave it. Just, you got the idea, right? How users' decision is getting affected because of this. Just understand that much. That much is enough. That is materiality. What is the difference in the amount or mistake? What is a mistake that will cause the user's decision to change? That is material mistake, big mistake. Okay. Now I'll say what this is. Calculation, everything will come to. Wait. Then it is not based on, it is based on nature, that is fraud, or size, that is amount of misstatement, size, materiality. If it is a fraud, then basically it is a material misstatement. For fraud, because that is something people are doing it on intentionally, so we can call it as a material misstatement. Okay. Then based on size means based on the size of the amount. Okay. Then let's see. Then another thing I can say to you, imagine, let's take the company's profit, actual profit of the company is a 25 crore. This is the actual profit of the company. It's 25 crore. Okay. Seeing this 25 crore, what will the auditor do? Materiality is basically a prioritization basis. Now I'll say one thing. Wait. Let's take a 1 second pause. Now understand. Materiality. Financial statements will have many amounts. Lot of journal entries, lot of entries, not journal entries, lot of entries, lot of items are there. One company's 365 days transaction is summarized in a financial statement. An auditor is doing the audit in just 1 or 2 months. So he cannot go and check all the transactions. So he cannot do the checking. So what he will do, he will fix an amount called a materiality amount. Materiality amount, just imagine, understand, come with me. He will fix an amount called a materiality amount. And all the mistakes that are above that level are considered as serious mistakes. Or not all the mistakes, all the amounts above that level, he will do deep checking. Because if any mistake comes above this level, that is considered as a significant, important mistake. Okay, so he'll fix an amount, all the mistake above this, all the items above this level, he will do the deep checking. Because if in that items, if there was an error, that would have created a material misstatement. So he will do the deep checking. That is what we call materiality level. Don't worry, I know you are getting confused, so don't worry. Let's see. This is the profit of the company. Here profit is a term that you call it as benchmark. I'll say what is benchmark, don't worry. Here profit was a term, 25 crore. From the profit, auditor will make a professional judgment. It is his judgment. He say, okay, he'll put some 10% of profit is the materiality level. He'll fix an amount like that. That is his judgment. He may say 5%, 1%, 2%, 20%. It's his judgment. So he said 10% of profit is materiality level. So that is 2.5 crore is materiality level. So auditor, when doing the auditing, all the items, items with amount more than 2.5 crore, items with amounts of more than 2.5 crore, he will do detailed checking of that. Because if there is a misstatement in that bigger item, that will create a material misstatement that will affect users. Misstatement that is below that will not affect users, so he will not check that detailed. So I'm not saying not check, we'll come down to that. Wait. So that is materiality level. So all the mistakes that are above, all the items that are above this level, he will do detailed checking, because if any mistake comes in that, all the misstatements above the materiality level, above this, are material misstatement because it affects users. So all the amount above this 2.5 crore, he will do detailed checking. That is high priority, he will give to that. Then another term is there called performance materiality. Performance materiality means all the items that are coming below 2.5 crore, because there is a chance, say in a P&L, there is a rent expense of say 2.7 crore. So it's about 2.5 crore. Auditor will open the rent expense and see everything properly, detailed checking, an issue will be there. Okay. But sometimes in the P&L, the management also know that auditor will use materiality. So some smaller amounts, sometimes they can do a fraud with the smaller amounts. So to avoid the risk of that, what is auditor is doing? He will fix another level called performance materiality. That is a percentage of this amount. Around 60% of this amount they fixed as performance. This percentage is also auditor's discretion. Auditor will say 60% of materiality is performance materiality. So it comes to 1.5 crore. So all the amount that is coming in this range, P&L, all the amounts. In that case, those amounts also auditor will do the deep checking. Not like that deep. Here it was, if it was 100% checking here, it is like a moderate checking here. If 30 items are there, he'll sometimes open and sees around 20-25 items. Here, if 30 items are there, he'll do open and see every 30 items. Here it's like a moderate checking. He'll check and see whether aggregate of misstatements, some 1.2 crore, not 1.5 crore. So 1.8 crore, one bill is there with 1.8 crore, another bill is there with the 1.7 crore. So all those things are below materiality. But when this 1.7 plus 1.5 totaled, it is above materiality. It is above materiality level, right? So those kinds of bills he will do open and do the detailed checking. All the bills that are falling in this category, not all the bills, all the amounts that are in this range also he will open and see whether the total of the, he will open and see all those amounts, and in that if there are any misstatements, some 30-40 items are there, he open and see all the items, and in that some 2-3 items are having misstatements. So he will total that 2-3 items, 1.8 crore plus 1.2 crore, not 1.7 crore plus 1.9 crore. The total of that is exceeding 2.5 crore. So that 3 misstatements together is over materiality level. So that is what we call performance materiality. I think limit that in between this range. Then all the items that are coming below the performance materiality, that also it's like he won't 100%, he won't ignore it. He will check that too, but in a very limited checking only. If 30 bills are there, he will check some 5 bills. If the amounts are amount below 1.5 crore, he will check them 3, 4, 5 bills. If 30 bills are there in this range, he will check amount, say amount of 15 to 20 bills, he will check in this range. If the bill amount is from 1.5 crore to 2.5 crore, if it is in that range. I'm just taking example as a bill. Bill is not only bill checking, everything like asset disclosure, anywhere, if it is above 2.5 crore, it comes under materiality. If it is below 2.5 crore, it is not materiality. So just to reduce the risk, sometimes they will combine some smaller amounts and do the fraud. So because to catch that, auditors put a limit just below the materiality level. That is what we call performance materiality level. These items are individually material because it's above 2.5 crore. So one bill that is about 2.5, if it is misstatement, that bill is individually misstated, right? And here you can say one bill is not having a misstatement because it's in this range, 1.5 crore, 2.5 crore. But when 2, 3, 4 bills are totaled together, not individually, in aggregate when they are done together, it becomes a material misstatement here. And here it is below. And why are we classifying this like this? Bro, I'll say one example. If we are not doing like this, we only have 1 month. We cannot sit and do the detailed checking of all these things, and we cannot identify what is the materiality level, all these things. When we fix the materiality level like this, we know, okay, if a mistake is there in the financial statement above 2.5 crore, 2.5 crore is a golden amount. If a mistake of 2.5 crore is there, then that mistake it's a big mistake, and because of that mistake, user will take a different decision. So I need to check all those items that are above the 2.5 crore, so that those kinds of mistakes, if anything is there, I can identify and I can write about that in the audit report, so that users will not get affected. All those misstatements that are below that, like around 10 lakh, 20 lakh, 30 lakh, or the smaller mistakes, all those misstatements that are below 1.5 crore, say, all below 2.5 crore, say 2 crore mistake, 1 crore mistake, all these mistakes. If it is individually all those mistakes, any mistake is there, okay, audit people are not bothered about that. If it is above 2.5 crore, their decision will change. If it is below 2.5 crore, their decision will not change. So I'm least bothered about that. But if it's above 2.5 crore, their decision will change. Because of that, I need to put the limit like this and do the detailed checking. That is why I'm putting materiality level. If you have any confusion, just write a message to me. I'll try to help you out on this. Okay. Okay. Materiality. Okay. Materiality in planning and performing the audit. Misstatements including omissions are considered material if they exceed, if they individually or in aggregate reasonably be expected to influence the economic decisions of users. In that case also, 2.5 crore above mistakes will affect the user. So I put the level as 2.5 crore as materiality, right? And one thing that I need to tell to you is that sometimes some smaller misstatements will be there, but when the total there will be over 2.5 crore, so user's decision will change, right? For two expenses, there is a misstatement. One is 1.8 crore and one is 1.7 crore. The total is about 2 crore, 2.5 crore. So user's decision will change. So auditor will check that. That is performance materiality. That range, he fixes that range also. So all the items that are above this range, he'll do the detailed checking. Or this range, he'll do the sample based checking, like not sample based, like around for 70-80% moderate checking, and the items that are below 1.5 crore less checking, because other mistakes to exceed 2.5 crore, the chance is less, but in this case it's more. Okay. Auditor has to obtain a reasonable assurance that financial statements are free from material mistake due to fraud or error. All these things you just study it, then nothing is. Then determination of materiality is a matter of professional judgment. That is auditor. One thing. I forgot. What do you mean by a benchmark? Benchmark means normally it can be either turnover, profit, or assets. Benchmark, that is here what we did. We took one amount profit, and from this we put the percentage. So on what item you are putting the percentage, that is what we call a benchmark. You can take turnover or 20%. You can take, say, imagine turnover is say 50 crore. Turnover, okay, then materiality is at 10 or 20% of turnover, you can say like that. So in that case, turnover is the benchmark. Or you can take assets and say like that. So here what we are taking, instead of profit, if you take assets, it is a benchmark. If you are taking turnover, then that is a benchmark, like that. Okay. Then determination of materiality is a matter of professional judgment. Determination of materiality is a matter of professional judgment. Here, that is auditor decides that percentage, 10%, 5%, 2%, all these things are decided by the auditor itself. We are not going to decide anything. Okay. Auditor is deciding. So auditor, when calculating this materiality, he can assume that the users will have a reasonable knowledge of the business and economic activities, because auditor will think that users know these things. Because that is when I am preparing a financial statement, I am simply assuming that the user knows how to read English, right? At least how to read English. I'm just checking that, right? When I'm making a financial statement, so the user who is reading that, when I'm making, for example, when I'm making the revised audit book, I'll simply assume that you guys know English. You guys love this kind of font, all these things. That is my assumption. Similarly, when doing the auditing, auditor can also assume that the user of the financial statement, that is those people, banker, lender, all these people all these people have a reasonable knowledge of the business. If they are reading Infosys financial statement, they have a reasonable knowledge of business of Infosys, then economic activities of their company. Then users understand that the financial statements are prepared with a level of materiality. Users recognize uncertainties, inherent uncertainties they are understanding. Then make a reasonable economic decision. So the auditor can assume that users know all of these things. That is, I can assume that when I'm making a book, you know how to read English, how is a basic idea about auditing, all this. Similarly, auditor will assume that the users of financial statement know this. RK understands REMA. RK understand REMA. Okay. Then performance materiality, we told it is a level that is, this is materiality level. It is a level that is below the materiality level, which the auditor will set so that smaller mistakes or aggregate will not be over materiality level. Okay. As an amount set by the auditor less than materiality for financial statement, that is material amount set by the auditor below less than materiality. Materiality is say 2.5 crore. So amount set by the auditor below less than materiality is 1.5 crore. So in this range, this is performance materiality range. For the financial statement as a whole, to reduce the probability that the aggregate of uncorrected and undetected misstatements for aggregate of uncorrected and undetected misstatements exceeds the materiality level. That is, those amounts that are in between the range 1.5 to 2.5 crore, 2-3 bills, aggregate of some bills will exceed the materiality level. Okay. Then you can say what is important. Then usage of benchmark, that is profit, turnover or figure. So that is benchmark means benchmark into percentage is what we call as a materiality level. We are getting this benchmark. It can be either profit or assets or turnover normally. So how should an auditor fix a benchmark? That is, 3 options are there, not 3, many things will be there. So basically these 3 are taken. So then auditor can say, okay, auditor can either pick a profit figure or asset figure or turnover. Which figure he should pick? Profit venama, asset venama, which figure he need to pick? That is what we call which benchmark he need to pick and what percentage he need to apply. That is factor that may affect the identification of an appropriate benchmark input. So based on this factor, auditor will look at these factors and then he will decide whether I should pick profit, asset or turnover. Factor number 1, where is the attention of the users focused on? Attention of the users means, imagine I am a startup company. Just understand this concept. Startups like Baiju, Oyo, Mamaearth, Boat, all this company. Startups won't be having profit in the initial years of their operation. Startups are 5-6 years. After that only they will start making profits. In the initial years, they will be spending money to gain the market share. So for startups, the financial statement, who are the users of startups financial statement? The bank, users, investor, all these people. So when imagine I am an investor and I wanted to invest my money in a startup like Mamaearth. I won't be looking at the profit of Mamaearth because profit I know it will come after 3-4 years only because it's a startup. So I will be looking at their turnover figure. How, like last year's turnover, this year turnover, 2 years back's turnover, how quickly the company is growing. Profit will not come in the initial year. A lot of expenses will be there. It will come only in the last years. So for startups, you as a user, investor, I am focusing on the turnover figure more than profit. So my attention is focused on those areas. So if the auditor is auditing such kind of a startup, for that startup to prepare the materiality level, he'll take turnover. Got it? Then if it is a company, if it's an established company like a Reliance, there everyone, if I want to put my money in Reliance, I will not look at the turnover, I will look at their profit figure. So my attention is focused there. So auditor will pick a profit as the benchmark there. Okay. Then relative volatility of the benchmark, how volatile it is, how quickly it can change. Then elements of the finance, you look at the assets liability, all these things, the nature of the entity, where the entity is at its life cycle. That is it is a startup, like first 3, 4, 5 years, or it's like an established business. At the life cycle means that is a like 15th year or 16th year, or in the early stage of which business, or in the last stage, all that. Okay. All these things you look and decide the factors. Then things you look at the materiality level for level of particular class of transactions. Then another thing, when we are whatever materiality I told it to you till now, we'll prepare materiality for 2 cases. Number one is for the entire financial statement, and the other thing is for some like 2.5 crore was a materiality level for the whole financial statement. Any amount of item that is above 2.5 crore we'll consider as material, and we'll check it detailed, and if there is any misstatement in that, it is considered as a material misstatement, because 2.5 crore is a materiality amount. So all the items above 2.5 crore we'll do the detailed checking, and we will see whether it has any misstatements. If it has a misstatement, it is a material misstatement because it is above 2.5 crore. And the items in this range, in the mid range, 1.5 crore, 2.5 crore, that also we will take and check, and we will see any of the items has a misstatement, and we will total up the amounts, items having misstatement, one or two more, some three items may have misstatement. We will total up that and see whether it is exceeding 2.5 crore, because 2.5 crore is a materiality level. If the total is exceeding 2.5 crore, those three is also called a material misstatement. Okay, got it. Here the materiality is for the entire financial statement. This 2.5 crore is for all the amounts in the financial statement. All amount we'll see with this 2.5 crore. But sometimes some expense area, some expenses, you take like the miscellaneous, not the indirect expenses category. This expenses may be like smaller amounts, like food, refreshment, all these things. The total will be say 10 lakh, 20 lakh only in the year. So like I'm talking about a bigger company. So there this 2.5 crore will not work. So the auditor need to put a separate materiality level for those class of transactions. That is for indirect expenses, I will put a separate materiality level. Entire financial statements I have 2.5 crore. But for checking the direct expenses, entire direct expenses, let me put a materiality level as say 50 lakh, because their amounts are smaller amounts, right? So risk is there, like if 2.5, if I keep 2.5 crore and check, nothing will be material, but a lot of mistakes will be there. So that is why I'll put a separate materiality level for class of transactions, like a group of transactions. For example, sales, I'll put a separate materiality level, or assets, I'll put a separate materiality level. Okay. So what are those cases? See, what are those cases in which auditor puts a separate materiality level for class of transaction, account balance, and disclosure? What are the cases? Number one, when law or financial reporting framework says that one amount or that one thing is very significant for the company. That is one situation. See whether law, regulation, or financial reporting framework affect the user's expectation regarding the measurement or disclosure. Where is it? Measurement or disclosure of certain items like a related party transaction remuneration. That is, if law says related party transaction is very important for that company, if law is focusing more on that, then for related party items we'll put a separate materiality level. Okay. Then key disclosures, then whether attention is focused on a particular aspect of entity's business, that area we'll put a separate material. So separately disclose the financial statement like a case of a newly acquired business. So in these three cases, they will put a separate materiality level. Then revision of materiality as the audit progresses. It simply means that you put the materiality at the planning stage of auditing. In the risk assessment, all those stage we went, right? Before even starting the audit properly, you will understand the entity first, SA 315, then you will fix the materiality. In the initial stage itself, you put a materiality as a 2.5. But when you are doing the auditing, like 15 days into the auditing, you understand that, oh my God, company is having lot of errors and frauds or something in like a smaller amount. 2.5 crore is a bigger amount. Like let me put the materiality as say 1.5 crore or 1.8 or 2 crore. Let me make it down a bit, or let me put it up a bit. That is revising the materiality. When you are doing the audit, you identified some situations, some circumstances or situation because of which you decided to revise the materiality. You had a plan to score exemption in your exam paper, but when you go there, you had a plan before entering the hall, but suddenly when the exam questions are like a complicated paper, your plan will change, right? You will revise the plan now. Okay, this way I cannot attempt, let me do it this way. Similarly, with the 2.5 crore, you decided first, but because of during the auditing, you found out certain situations because of which you changed it, revised it. Materiality for the financial statement may need to be revised as a result of a change in the circumstances during the auditing. Then you identified a new information or a change in the auditor's understanding of the entity. Imagine before starting the audit, I'm the auditor, I was thinking company is a good company, no fraud, nothing is there. But during 15 days of auditing, I understood. My understanding changed. I identified they are basically fraud people. So I need to keep down my materiality. Now got it. Yes. Then if during the audit it appears that actual financial results are likely to be substantially different from the anticipated period in the financial statement. That is, when you are preparing the materiality, sometimes financial year end may not have happened because when are you appointed as the auditor? Just say before the financial year end, like the AGM, that AGM, for example, 23-24 is the financial year. You will be appointed in the September 23, that time, before even the financial year end it closes. So you have so you don't have the actual financial statements at that point of time with you. But when you are putting the materiality, you will expect, okay, since 6 months financial statements you will get. Based on that, you will predict this will be the complete sales of all this. The entire financial statements you will predict, and you will put a materiality level like at September time when you are appointed. Entire year is not over. So, but 6 months is over. Based on 6 months, you will predict, okay, this will be the entire sales for the next 6 months, so total 1 year. This will be the expenses. All that you will predict, and you will put a materiality level at that time. And based on that, you may be just continuing the process of auditing. But when the financial year end happens, end finishes, the actual financial statement comes. So it's completely different from what you expected. So you will change the materiality. See, if during the audit, the actual financial statements, actual financial result, that is the thing you will get after the financial year end has happened, are likely to be different, substantially different, not smaller changes is not that, substantially different, bigger changes from the anticipated period end financial result. You were appointed, the financial year end is 31st March. This is 1st April. And you were appointed around like this way, around September time you were appointed. And you started the auditing at this point of time, you predicted the financial statements end, and based on that you put a materiality, but actual financial statement was different. So you will revise it. Okay. Documenting materiality, you need to document all these things, and materiality and audit risk, it's very easy, nothing. Then internal controls. Internal control is a very easy thing. What is internal control? Like we told you, the definition. The process DIM, designed, implemented and maintained by the TCWJ management to provide reasonable assurance about achievement of objectives. So materiality is an important area. We focused our time more there. Now let's quickly, these are all easy areas. The memorization is only difficult, but because of the technicality. I'll touch upon the tougher points for you in this. Okay. Limitations of internal control. That is an important area. Internal control can only provide a reasonable assurance, because I said whatever you put as a control, still there is a chance of a fraud in the company, fraud or error in the company. This is a warehouse. You put so you have like some of your employees have already stolen your goods. So to prevent that, you put 100 CCTV camera. Still someday the power can go off, or some lightning comes and CCTV goes off. Some people can come and steal it. You cannot say it will not happen. Whatever you do, there is a chance of risk. So obviously you can only give a reasonable assurance only. You cannot give absolute assurance that internal control will protect everyone. No. Then human judgment and decision making. I have I'm the company. I have my valuable documents of the company and some gold and some diamonds and some cash with me. I'm the company. I'm the CEO of the company. What happened? I put it in a locker, locked it, and I gave the key to one employee. I was thinking he will be a good guy. That was my judgment. But then I went for a trip. 1 week, 1 year after, 1 month after, when I came back, the employee himself is gone with the locker. So my judgment and decision making got changed. This locker was an internal control. Putting the documents inside, locking it. The locker was a control that was preventing something fraud from happening. That document, preventing someone from stealing. Locker was an internal control. And over that, I kept I gave the key only to that person. So he was an internal control. He would have protected the locker, but he itself stole that. Okay. Breakdowns in internal control can occur because of some human error. Then lack of understanding the purpose. This is something. Exception report. Exception report means okay. Lack of understanding the purpose. It's very easy. Lack of understanding the purpose means some softwares will be there. Just the hypothetical examples I'm giving you. Okay, please don't consider this as real stuff. Hypothetically, I'll say things so it will be easy for you to understand. Okay. Please don't come and say, sir, in real company it will not happen like this. Oh, bro, I am a faculty. I'm not going to teach you how. I'm now not teaching you how to do the audit in real life. That I teach in the ARP course. You finish your articleship, finish your intern, come to me for ARP. Then I'll say, before articleship, I'll teach you how to do the auditing properly. That is different case. Okay, that is a separate thing. This is different. Okay, that you reach me once you clear CA enter. So here, understand this. Exception report means some softwares in the company. Imagine there is a software, that software will identify the fraud in the company. If any error, any amount error or something is there, imagine that software will identify all those errors and will give a report. Okay, this 1000 entries, these 3 are the errors. It will give a report like this. Imagine. That report is what we call the exception report. This hypothetical example, imagine. So, there is a company employed one person and said, it's a chartered accountant. Imagine he's a chartered accountant, but he has done dummy articleship. So, company told the CA, bro, this software itself, you don't have to do anything. The software itself will find out the error and will give you a report. Just look at that and find out the people who are doing that and understand all these things and make it like all the evidence, collect all the evidence, everything. So what happened was, okay, he said everything, okay, done. Then he started sitting there. Software gave him the report. The moment he got the report, what is this? What format is this? He is not understanding anything. Because he has done dummy articleship. Okay, just understand. And what is this? Here company put him to do some task and he is unable to even understand the purpose, what to do. He is an internal control, right? Software already will give it. So he is just checking whether the software doing everything is correct or not and just making a report out of it. So he is an internal control. Company put him as an internal control, but he don't even know the purpose of his job because he did the dummy articleship. That is lack of understanding the purpose. Operation of a control, that is operation of the chartered accountant, may not be effective such that where the information produced for the purpose of internal control, that is this information produced for him to check, that report is not effectively used. He don't know how to use it because individual responsible, that is that person, for reviewing that information don't understand the purpose and fail to take the appropriate action. Okay. Then collusion among people. 2 people combined together and doing the fraud, because you put someone is doing a fraud in the company, or how can I say that? In a company, you have a doubt that the accountant is doing a fraud. So you put some other person over the accountant to check the accountant. Some supervisor to check the accountant. Okay. But after 1 month, they became friends and they together colluded. They became friends together and they together started doing the fraud. That is collusion. Then judgment by the manager. It's almost similar to manager made a judgment like locker and key, all this, or employed one person thinking that he will do everything correct, but it went wrong. Or bought a software to catch all the fraud and error, but it was unable. Management judgment got wrong. Then limitation of, in case of smaller entities. In smaller companies, one accountant will be there. To check him another accountant, it is not possible for the smaller company to hire a separate accountant. One accountant will be doing the accounting, carrying everything he will be doing. So whether he is doing correct or not, to check him, we cannot come with another person. So this segregation of duty is not there. Segregation of duty means duties in allotting duties in different hierarchy. One person to check this person, one person senior to him, like that. That is segregation of duty. All duty will not be performed by one person. That is segregation of duty. For financial reporting, one person will be putting the journal entry. Another person will be making into the ledger and proper accounts. Another person will be making it into the trial balance. So when this happens, at least if he did any mistake, he will identify it at least. So here duties are segregated to different people. But in smaller companies, it will not be there. One person will be doing all these things. So even if they cannot even put the internal control, that is a problem. Okay. Then what are the components of internal control? Control environment. This is important. All the other things are easy. Control environment means the attitude and awareness of internal controls to the employees. That is what is the attitude of employee? Because company has put a lot of internal controls in the company. Just imagine. But what is the attitude of employees towards that internal controls? Company put a lot of things, but if our employees following that, company put a fingerprint scanner to get the payroll, all these things. Our company is actually using that. What is the attitude of employees towards them? Are company liking? Are the employees liking that? And what is the awareness about them? Imagine company put a lot of internal controls inside the company. Company put a fingerprint scanner so that employees' attendance will be easily marked. So based on that, company can give a salary. So like the attendance thing. But our employees, first of all, company put all these things, but company has not talked about this attendance scanner to all the employees. So some of the employees don't even know that it is like this. They are still going and putting the signature. So the awareness of internal control is not there. Awareness and attitude. In a company like Baiju, even if you put an internal control, employees are fighting against management. If you put any internal control, they don't even care. They won't even mind. Control environment is the attitude and awareness of employees towards the internal control application. Internal control. See, that is, auditor need to obtain an understanding of the control environment. Are employees liking the control? Are they aware about the controls? Then only, if all the company put a control, if all the employees are properly following it, then only it is of use. Else it is not of use. So if a company is good control environment means employees, everyone knows about the control, everyone is following everything properly. So everything, that is a good control environment. Bad control environment means company, no one is bothering about anything. So auditor need to first understand how good the control environment is. Okay, auditor shall evaluate whether management has created a culture of honesty, ethical behavior, all these things. That is control environment. Overall attitude of the employee. Then entities risk assessment process, how entities assessing the risk, all these things are easy. Then control activities, elements of control environment, you will get it. Then that's an important question, right? This is easy, so that is why I'm not focusing on that. Then satisfactory, existence of satisfactory control environment is not an absolute deterrent to fraud. Even if the company is having a really good control environment, but that doesn't mean fraud will not happen. It's not an absolute deterrent to fraud. Okay. Then this one. Okay. Then control activities. Control activities means the things that the management does to make sure that controls are their whatever they say, their directions are carried out. I'll see what it is. Auditor need to understand the control activities related to the audit, which auditor consider necessary to assess the risk of material misstatement. It means the policies. This is policies and procedures that will help to ensure that management's directives are carried out. That is, whatever management is saying is carried. They are giving directions. Okay, do this, do that. Like to employees, they will be speaking. So these activities, management, imagine you go to articleship, your boss will be giving you, bro, do this task today, do this task today. I need to complete this report. I need you to come give me this report in 2 days. Like that, they'll give you. That is their directives they are giving. And sometimes the company will also have some activities to check whether you are doing it properly or not. Just to control you. That is control activities. Those are policies. What are the policies and procedures that chartered accountant is doing to make sure that his directions are carried out? Whatever he say, that person is doing that. To make sure whether that is done, he will have some policies and procedures. That is called control activities. Performance review. He will, he told you tomorrow evening I need to get this. He'll just review your performance. Okay, are you doing it properly or not? Whether is my directions carried out? Are they following my direction? Then he'll look at information processing, physical control, segregation of duties, PIPs. Okay. Then monitoring of control is easy. Are all the controls relevant to audit? Then risk that require special audit consider. It's also easy. If it's a risk related to fraud, risk related to significant economic, accounting, development, complexity of transaction. If the complexity of transaction is huge, transactions are highly complex. One person sell to this person, that person to related party. We don't know what is happening. The transaction is complex, then the risk will increase. The more the complexity, the more the risk. The more the fraud, the more the risk. The risk of fraud is always a significant risk. That is the risk that requires special consideration. These risks we need to do detailed checking, more consideration. Then what are the significant risks? Non-routine transactions and judgmental matters. Non-routine transaction means transaction that happens only once in a while. That will not happen daily in the company. For a company like Jio, their daily transaction is this telecom, all these things. But imagine they bought Hotstar. That will only happen once in a while, right? Once in 2 years or 3 years, they will buy a new company. So that is a non-routine transaction. Routine means the things you do daily. The daily operation. So non-routine transactions that are unusual and occurs infrequently. That will create a significant risk. So you have, first of all, identify all the non-routine transactions. Then identify all the judgmental matters. And in that, go and see what are the risks there. Those will be significant risks. Judgmental matters means matters where the management will make a judgment. Okay, there are no fixed rules for that. It's just their judgment that is working. They'll say, okay, let's use this inventory valuation method. They can use LIFO and FIFO, but they may simply sit and they'll have their judgment and they'll say, let's use LIFO method. That is a judgmental matter. Then accounting estimate. You bought an asset. So normal useful life is 10 years, but management is assessing and saying 7 years useful life. That is their estimate. So these kinds of things, risk will be more. So as an auditor, I need to identify the non-routine transaction, judgmental matters, and then I need to identify whether there are risks in that. That are significant risks. Significant risks are inherent risks that have a higher likelihood of occurrence. That the chance of risk is huge in that, and higher magnitude. That is, if the risk occurs, the impact will be huge. Okay. Then evaluation of system of internal control is very easy. Then method of evaluation of internal control, narrative record. Narrative record means written record. Here the internal control will be evaluated, and internal control, you are saying one. Here he will come and check the internal control completely, auditor. He will come and check the internal control, see what are the internal controls in the company, everything. Then he will write it in a piece of paper. Okay, CCTV, how CCTV is about the, is it working properly, good, all these things. Narration, written record, that is, he'll write about the internal control. How is it efficient, is it working properly, all these things. That is narrative record. And he does the narration and keep it as a record, narrative record. Okay, then checklist. Checklist means here auditor will prepare a checklist, like the list of questions. This is method of evaluation of internal control. How auditor evaluates a control. A lot of internal control will be there. Are they operating properly? Are they not operating properly? Any issue is there? That to identify that is what we call evaluation. How do the auditor do the evaluation? Through narrative record. A written description of the document will be there. He will go through it. This is a complete and exhaustive description of the system as found in operation by the auditor. He will do the complete and exhaustive description of the system as found in operation by the auditor. But there is a problem in this. The thing, what are the disadvantages? These three. To write, you are sitting and writing about all these things, description. To comprehend the system is quite difficult. Even if you write it to someone to read and understand is difficult, all these things are difficult. Then identify the weakness and gaps in the system is difficult, because if you want to understand one internal control, you have to read one page. It's tough. That to incorporate changes is also different, because you have written paragraph like this. Otherwise, change where that's difficult. Then checklist. You will prepare checklist like this. How auditor evaluate control. Imagine auditor cannot go to the company and see all the controls and do all. He don't have time for that. So whatever doubt he have, he'll prepare it like a checklist and give the checklist to his article or staff. The staff will go and do, okay, purchase. See, our tenders called before placing order. He'll ask the manager, tenders called before placing order. He'll apply all this. Then he'll tick. Whatever things he got, he will tick. That is tick or put yes or all this. That is checklist. Then here, only thing is here the auditor is giving it to his staff, article or people. An article is doing this. An article will give back the report to the auditor, and based on, he will read that report, and then he will evaluate the internal control, because the questions will be related to internal control. Article will go and check the internal control and put the tick and come. When auditor reads the ticking, he will understand, okay, this is good, this is bad, etc. That is evaluation. Then internal control questionnaire. All the doubts the auditor has about internal control, not the doubts, all the things he need to know, he will write it in a piece of paper similar to this, and he will give it to the management here, to the client, not to the article. Here auditor will give it to the client. Management will look at it. Management will look at it and they will evaluate, and management will fill the questionnaire and will give to the auditor. Auditor will see it and evaluate the control. Flow chart, everything in a flow state. Okay. Then, what is automated environment? The key features of all this thing. Automated environment means an environment in which all the transactions are properly automated. Everything is automated. You just take Amazon US. In Amazon US, if an order comes, okay, if you placed an order in Amazon US, you placed an order in Amazon US, what is actually happening? The moment you place an order, everything is automated. Immediately the order will go from the system to one computer or all this thing, where suddenly the order will be known in the factory. Immediately some robot will pack the product, put everything in, then seal, everything happens. Then automatically in the conveyor belt it will go to the delivery place, and it will be put in a packet and it will be given to the delivery thing. So all the things are automated. No human is there. No manual, nothing is there. The moment you place order, everything is automated, immediately it will come. This is called automated environment. Everything is automated, and from that, your order is there. One software will be there which will recognize all the orders. So, and that software will put all the accounting entry, everything. No person is sitting there and doing the entry. That software will do the accounting. If any issue is there, one other software is there which will identify any issue is there, that will flag the issue. Everything is automated. Automatically it's happening. That is automated with the robots or with the technology. That is automated environment. Or entire business process. A business environment where the process, operation, accounting, and even decisions are taken by the computer system. Why are we learning about automated environment? Because students don't know this. Tomorrow you are going to audit a company like Amazon. At that time, you need to know what is an automated environment, right? Else you go there, you will be like, what is this? So to understand that, we are learning about automated environment here. Okay, what are the key features? Everything will be faster because everything will be faster. Accuracy will be more. You can easily process a large volume of transaction because if it's not automated, one person is sitting there and doing all this, 100 people, still it will take time. Since it's automatic, how many at night also you can work this automated. Anytime it can work. It will be quicker. So large volume of large number of transactions they can process. Better security will be there. Less prone to human errors will not be there. All this, it's very easy. Then, so you just read nothing is there. Then risk arising from the use also very easy. Then impact of IT related risk on substantive checking, controls and reporting. That is also not there. This one is the toughest thing, right? I know. What is general IT control, application control, dependent control, IT dependent control? General IT control, because if you understand it, then you learn all these things alone. But if you don't understand it, you are gone. General IT control means when you open a mobile, this is hypothetical example, okay, for your understanding. This is my mobile. This is my mobile. The moment I open my mobile, one face lock will come, right? So the moment that face ID is scanned or the password is entered, then only I can get access to the system phone. That face lock is what we call general IT control. So that one lock is generally applicable to my entire phone. If I only have that phone, then only I can access to my mobile. But if that face lock is what we call, that the front lock is what we call general IT control. The moment you open that, then you can access the system. What is application control? WhatsApp will be having a lock. Instagram will be having a lock. Lock for that particular application. That is application control. Simple. General IT control means in an office, say. Now I'll give you a simple. Now, phone lock is what the entire phone's lock is general IT. The particular application's lock is application control. Let's imagine this is a company. And the company has, say, this is a company's finance division, say finance division. Company's finance division. Finance division has 6 computers. So these 6 computers will have a same password. And only the employees who are sitting in these chairs, this system, they only will have access to that password. So same password, though computer, if they enter that password only, they can access the computer. That control, that password is a general IT control here. It is generally applicable to the entire IT system. Entire IT system, one password is there. It is generally applicable to all the system inside IT. You are putting one antivirus software in all the system. So that if that same software, you bought one software, you installed it in 100 systems. So general IT control, generally applicable to every control. But that is general IT control. Only these people who have access to the password can enter the password and access the system. Others cannot do that. Generally applicable only to the entire financial division. Application control means inside this computer, if you take a computer from here and inside this computer, you entered the password, general IT control, you got the access. Now you are entering. Like password, many controls are there. Not only password is just one general IT control. Many controls will be there that is generally applicable to all the systems in the IT. Application system means it's applicable only for that one application. It's particularly applicable only for that one application. Okay. Okay. Control that is generally applicable to only that one application. Imagine you take Tally or a software like that. If in Tally, if you enter and you try to put a journal entry, debit and credit, all this, then amount, and if you forget to put the this one, the GST number or the GST figures, sometimes, or if you forget to put the debtor's name or invoice number, you cannot save the entry. They'll automatically say, put the red, like a red thing, it will come. Put that entry, that is a mandatory field, you fill that. That is application control. A control inside the application which will prevent from fraud or error happening. General IT control and application, both are internal control, right? General IT control is like an internal control that is applicable to the entire organization, that entire division or entire system. Application control is a control, like an internal control that will prevent a fraud or error from happening in a particular application. WhatsApp application lock is there. That lock will protect a person from accessing my WhatsApp. That app. Okay. Got it. Application and then IT dependent control means here both manual, that is automation, and human, both are there. The software will give us a report, and I am a human, I will check the report. These two things. So software will give me something and I am checking something. Here I am IT dependent. I cannot do the things alone. First I need software to give me the report. For example, Amazon, all the sales are happening. All the sales are automatically recorded in the software. So at the month end, I will go there. I am a control. Software will do all the checking. Here I am the control. I will go there. I will click at the entry, everything. I will look, just open the software and click report. Immediately I will get the report of the entire sale. Here I am not doing the accounting entry anything. I already got the report from the software. I am just checking it. So I am the control. I am just checking it. But I am dependent on the software for that report. IT dependent. I am dependent on IT. That is IT dependent. Human plus manual. Human plus automated. Okay. Got it. And the general IT control will have control over all this data center, network operation, then program change, access, security, application system, acquisition, development. Data center and network operation means here, if you want, you just write for it easy. And general IT controls will have controls over data center network operations. Company, for example, a bigger IT system, they will have server, some network operation, all these connections, all these things, cloud based, all these things, data center network operation. So general IT control means internal controls over these things. For example, in server room, we will keep an AC, all these things to protect the server, or antivirus, all these things. If the server is damaged, the entire data is gone. Financial reporting data is gone. All the financial reporting data is in the server. So to protect that, one control will be there. Then program change. We will have general IT controls will have controls over program change. Like from here till here, you write it above so you will get the meaning correctly. Program change means general IT controls will have controls over program change. If any modification happened, if any program is modified, any change, a software update, like that, if any program is modified, this controls, that imagine this controls we put, this controls will cross check whether that modified software is working properly. You had a, so just hypothetical example, you had a software update in your phone. After software update, immediately you are the control, you are itself operating and checking how, at least software update, even if the new updation nothing is there, at least before updating how my phone was like that, at least it should be there, right? You will be checking, right? A program change happened and you are an internal control, you are just checking whether all okay. So you are a general IT control there. After program change, whether after modification, what happened? Program change. Okay, then access security, a control which will, internal control which will check the access security. Only the authorized person has access to that. Only the person having the password can only enter. So one internal control will be there. That control will check only the 6 people, 6 computers are there. 6 people will only know the password. They should only enter. And control to just cross check whether sometimes some other people may also know the password, just to check that. Ensure that access to a program or system or data is authenticated and authorized to meet financial reporting objectives. On ensuring that only the authorized person has access to the system. Okay. Then, like for example, putting fingerprint on control. I put a fingerprint. So only the people with the fingerprint, that fingerprint which is inside the machine, they can only enter that room. I have all the valuable documents in this room. I put a fingerprint scanner, only 3 people has access to that. That is a control security. Then application system acquisition, development and maintenance. It is acquisition, development and maintenance. That is for developing each and every application, like a software, anything when you're developing, there will be controls over its acquisition, development and maintenance. You will have internal controls to protect all these things. Okay. Then application will automated and manual controls, and it is embedded in the automated application controls are embedded into IT applications. WhatsApp lock is embedded in mobile phone. It's embedded inside mobile phone, right? Same. It is embedded in IT applications. It's inside IT applications. Okay. Then IT dependent controls, these are basically manual controls. Even though the control is performed manually, I am dependent on the software for report. Even though I am performing I am checking it manually. Even though I am checking it manually, the effectiveness and reliability of the app control and IT dependent control require the general IT controls to be effective. One second. Sorry. This is the game. Okay. Even though the control is performed manually, the design and effectiveness of the control depend on the reliability of source data. Means, even though I am doing the checking, the reliability of that will depend upon the document, how it is. If the document, the data given by the software is wrong, that is not reliable. If the data given by the software is not reliable, how much ever I check, will I become reliable? No. So to become internal control. So me to become reliable or me to become better, I need that software data given by the software to be better. So basically I am dependent on them. That's it. Simple as that. Just understand that much. General IT, these are all these things. Testing methods, how it is done, inquiry. If you read, you'll get it. Then manual versus automated. Data analytics, data analytics means a tool which will analyze large amount of data. Simple as that. Huge amount of data will be there. Imagine you are going to audit Flipkart. 1 day, 1 minute. 1 minute in India, at least minimum 5,000 transactions is happening in Flipkart in 1 minute in India. 1 minute, 5,000 or 1,000 at least minimum you take. 1,000 transactions. So in 1 minute, so 365 days, how many transactions will be happening? How many data will be there? How many sales? How can an auditor go and manually do the auditing of all this? Some crores of sales will be there, lakhs of sales. How can you do that? So for that is what we call data analytics. Data analytics means it is a software or a tool. If you give large amount of data, this tool will go through all these things and will summarize and give some idea. Like understand hypothetically like this. That is data analytics. This tool can analyze the data easily. And that is called data analytics. And auditor will use these kinds of tools to do the auditing. That is called data analytics in auditing, because to check a large amount of data, we cannot do it manually. So we will use softwares which can do this. That is data analytics in auditing. The combination of process, tools and techniques, PTT, process, tools and techniques that are used to tap a vast amount of data to obtain a meaningful information is called data analytics. That process using the software to understand, to get meaningful information from a large data. So to get that process is called data analytics, and auditor using that data analytics in audit is called data analytics in auditing. And in auditing, he will use softwares like tools like that. Technique is what we call computer assisted auditing technique, CAT. That is data analytics for auditing. You can, in other words, you can say it as CAT. Okay. The tools and techniques that we use for data analytics in auditing is what we call CAT. Okay, then this you read, you'll get it. Nothing. Easy points. Then digitally auditing using AI. Basically, you understand using ChatGPT for auditing. Like that. Using AI for auditing. Then documenting the risk, all the risk you need to document. Then this is important. Please don't leave it. This is important. This means this one topic, one question is there. If you have the revised audit book and question bank, just see this question number. Because the problem is that this is a very simple topic. It means once you finish the auditing, the idea I'm giving you, once you finish the auditing, you have audited that, you have been associated with that company for 1 or 2 months, right? So you would have already checked all the internal controls, all these things. So all the deficiencies, all the issues you identified, you should tell it to the management. You should tell it to the management TCWG. Sir, the last 2 months of auditing, I found this, all this issue. So you need to report it to the management. And that is a question. At the conclusion of each audit, there will be certain findings or exceptions in the IT environment and IT control that need to be assessed and reported to the relevant stakeholders, including management, TCWG. The issues in the IT environment, internal control, all the internal, it's not about internal control, the issues in the IT environment and IT control only. IT internal like controls, like the general IT control, application control, all this, those things you need to tell it to the management after the auditing. Okay, after the auditing. So what are the points to consider? Are there any weakness in IT? What is the impact of the weakness? Are there any issues? And if yes, what are the impact of this? Then tell the deficiencies to the management, communicate in writing only. Simple answer. But they may give you complicated, this question means they'll give you, okay, after auditing, after conclusion of auditing, is there any responsibility for auditing? Then say what it is, like that they'll say. You will think about audit reporting and go like that. This is one area. They'll say after the conclusion of auditing, what is auditor's responsibility relating to IT environment and IT control? You will not remember that. You will not, that time you may not get this. So they may ask you, see, what is auditor's responsibility relating to exceptions and findings in IT environment and IT control? You may not remember. This is the answer. You may write about some reporting requirements or something. No. Okay, so this question you keep in mind. Then SA 330 auditor's response to assessed risk. That first chart I showed you. This is very easy. Substantive procedures. See this one chart. Another thing is there. This is what we call further audit procedure. Risk assessment procedure is also there. Audit procedure like this. This is 330. This is 315. Here we identify all the risk. Here we will go on detail and check whether these risks are actually risk. Risk means it doesn't mean 100% it is a fraud or error. No. Risk just means there is a chance of a fraud or error. We are just identifying the chances here. That chance is called risk. And now we will check whether the chance actually is a fraud or error. Whether it's a material misstatement through further audit procedure. So first is test of controls, testing the internal controls. Next is substantive procedure. Substantive procedure is divided into test of details, that is detailed checking of transactions. Detailed checking of transaction is called test of transactions, and test of balances, that is verification. This is vouching. Transactions means the P&L items, sales, purchase, expense, all these are called transactions, right? Transactions. So checking of that is called vouching. You will have a bill, purchase another bill, and you will check the books whether these are correct. Compare. That is book vouching. Then balance means verification. That is basically balance sheet items. Asset 10 lakh is written. You will go and verify whether 10 lakh asset is correct or not. That way. Mostly. That is test of details. Detailed checking. Here you will identify the risk and we are detailed checking through here. Then substantive analytical procedure is also like that. We will talk about this in 520. Okay. Then here what is important? Let's see. SA 330. Auditor's response to assessed risk deals with auditor's responsibility relating to designing and implementing response to the risk. The response to the risk, see, this is a point. Auditor's response deals with auditor's responsibility to design and implement a response to the risk identified and assessed by the auditor as per SA 315. This is the main point. You identify and assess the risk there. You see whether that risk is creating an actual issue, fraud or error or material misstatement here through 330. Okay. Then 330, these are the responsibilities. You just go through it. It's easy. First is design and implement overall response, then further audit procedures. Then in designing the further audit procedure, you will see what is the likelihood of material misstatement. What is the chance of mistake that can happen? What is the likelihood? What is the likelihood of the misstatement due to the particular characteristics of this? You see a risk. Now you will decide, okay, because of accountant is inexperienced, that is a risk. But that doesn't mean there is an error. Accountant is inexperienced. Sometimes there may not be an error. Okay, accountant is inexperienced is a risk. We identified and assessed that in there. 315. Now we know that. Now what is the likelihood of misstatement? Because of that risk, there is a chance of a error in the sales, expense, all these things. That is a likelihood, and that is a likelihood. At least 50% chances there that error will be there because he is that fool, that kind of a fool. Then what are the reasons for assessment? Why you gave, like you said, you are saying accounting entry will be misstated. That is a risk you are considering. And what is the reason for that? Accountant is inexperienced. So what are the reasons for assessment given to risk of material misstatement assertion level. Risk identification time, you are saying there may be a chance of error in the sales. That is a risk you identified. What is the reason? Because accountant is inexperienced. Okay, then what is the likelihood to be told? Then what are the relevant controls to see that? That is, are there anyone above the accountant who will check his daily transactions, daily entry done by him? Are there any relevant controls like that? Or at least weekly, monthly, so next we'll look at, are those controls operating effectively? Also we'll check. Then obtain more persuasive audit evidence, detailed audit evidence, higher the auditor's assessment of risk. If the risk is higher, you need better audit evidences, more audit evidences. Okay. Then auditors shall design and perform test of controls to obtain audit evidence to the, so you read nothing. Then what is matter that the auditor may consider in determining the extent of test of controls. That is, how deeply I should test. Extent of control, extent of checking. That is how deeply, how much I should go and check. That is called extent of test of control. When you are testing a CCTV, how deeply I need to go and check it. Should I full 1 year, the whole transaction, all video footage, should I go and watch it? Or should I go it on a sample basis and watch it? Or should I watch one whole day at least once to see whether there is any tampering? Like that. What is the extent of checking? One senior accountant is there, he checks other 5 junior accountants. So he is the internal control. So extent of checking means how deep should I check this guy, senior guy? He may have done thousands of transactions in that year, like thousands of journal entry, entering everything, like journal entry, everything done by the junior accountant. He may have checked that. He is the one who is preparing the reconciliation statements, all this. So he may have made 500 reconciliation statement. How much should I check? Extent of checking. Should I check entire 500, or should I check 300, or should I check 100? How much should I check him for testing him? That is testing him. He is a control. Testing him is called test of control. How much should I do that? That is, first you look at the expected rate of deviation from a control. Expected rate. What before checking, what you'll be thinking? Okay, this guy may not be correct. If he is doing 500 statements, 500 reports, or 200 will be wrong, right? The expected rate of deviation. Or when he is doing 500 reports, 100 may be wrong. So 20% deviation, chance of deviation means difference. Chance of cause of mistake is there. Expected rate of deviation from a control. I'm saying hypothetical examples only, right, for you. Expected rate of deviation from a control. If the expected rate of deviation is high, that is, you are thinking, okay, lot of mistakes or lot of deviation may happen, then you need to do more testing. If you are expecting this much will come, then do more. If that is high, then do more checking. Then length of time during the period auditor is relying on the operating effectiveness of control. He is there. Under him 5 accountant is there. I have 2 options to check all the accounting entry whether it is correct or not. Either I can check all the 5 accountants, but that will be huge to check 5 people. Or I can just check the control, the senior guy. If he is good, obviously he would have checked others good. So if I test this control, and if this guy is good, no entry, everything checked by, everything done by him is good, then I can say that I don't have to check the other 5 below people me. I may do some sample checking, but I don't do the detail checking because I tested him. He is a good guy. That means he would have taken the responsibility to take care of them. That is length of time. For in this kind of case, I'm saying, so my plan is I will check that control, and if the control, that guy is working properly, then I'm not going to check the others. Okay, I'm going to rely on him. And I'm going to rely on him for my entire auditing. Whatever work he has done, I'm not going to check again because he is a good guy. Whoever people is under him, I'm not going to check that. Okay, because he will do the checking properly. I'll just check him first. That is length of time. That is entire auditing. I'm planning to rely on him, rely on the operating effectiveness of him because he's a good guy. If you are planning to rely on him more, like the entire auditing you are planning to rely, then that means length of time is more. So that means you need to do more testing, That is here. What is the question? How much deep you need to test? If you are relying more, test more. Then frequency of the performance of the control, frequency is more, test more. The extent to which audit evidence obtained from the control related to the assertion. If you are planning more audit evidence, test more. Relevance and reliability. All these things. Okay, then evaluating the operating effectiveness of a control. When auditor shall evaluate whether misstatements are simple. Then what are the specific inquiries when deviations from controls are detected? If you find out in a deviation, do the test of control, additional test of control, potential risk of misstatement. Then this we learned it through the chart, right? Chart. So understand, audit procedure is divided into two: risk assessment procedure, further audit procedure. It is divided into two: test of controls. All this we will learn it in fourth chapter, 520. Okay. So this chapter is also done. Now let's move on to the fourth. So chapter number 4, audit evidence. Meaning of audit evidence as per SA 500. Audit evidence is SA 500. Okay. Audit evidence. What is evidence? A person killed another person. So police will come to investigate the case. Police will need evidences to submit in court, right? To get the reasonable assurance at least. Police need basically absolute assurance that this guy has killed that guy. Court needs the absolute assurance. For that, evidence is needed. Okay? Somebody, it's like DNA things or some other CCTV visuals or something. In our case, auditing, we are checking the financial statements. So for each and basically, how do we check it? One entire financial statement is given to you. You will check each line item, every item you will be checking. So you need to get audit evidences that if you identified a misstatement or some doubt, you need to get an evidence to make sure that that mistake is not a big mistake, or that's not a mistake, like that, to get a reasonable assurance to you. Okay, this is not a very big thing. I can go with it. For getting that reasonable assurance to you, auditor itself first. To get that, you need audit evidence. If you yourself get the reasonable assurance, then only you can give the reasonable assurance to outside. Okay. So evidences, that is information used by the auditor in arriving at the conclusions on which audit opinion is based. It is divided into two, depending upon nature, depending upon source. Nature. For human beings, depending upon our nature, it is divided into two, male and female. Like that, audit evidence is divided into nature, based on which it's divided into visual audit evidences. Some CCTV things, or like all these are visual audit evidences, which are observing physical inventory counting. You observe a physical verification of asset. Auditor is directly going in balance sheet, it is written 10 lakh asset. You go and see whether that asset is there, existence assertion. You can go and watch it. That is visual evidence. So when you watch it, you get it as an evidence, got as an evidence. That is visual evidence. Oral evidence, when you inquire with the manager or someone, you talk to them, they give you response. That is orally, words. Documentary, like certificate bill or all these things. Then depending upon the source, internal evidence, audit evidence that is generated internally. For example, sales bill. Sales bill is something that is generated by the company itself. And auditor, for vouching sales, he can use sales bill as an evidence. That is an internal audit evidence, sales invoice. So external evidences auditor collects from outside, like external confirmation. All these things. Or purchase bills. Purchase bill is basically coming from outside. Because when we purchase something, that seller is the one who is creating the bill. It's not us. Okay. Then relevance and reliability of audit evidence. Relevance means the logical connection with the purpose of the audit procedure. Logical connection with the purpose of the audit procedure. That is relevant. This is relevant. For example, ICAI asked you a question about essay 315 in the question paper. You wrote about essay 450 in the paper. They asked about 315. You wrote about essay 450 in the paper. Is that answer relevant there? 315 asked, you need to write about 315. For that is why this is the relevance in audit evidence means logical connection with the purpose of the audit procedure. You wanted to check some assertion, some existence assertion. So for that, what is a relevant audit procedure? Relevant audit evidence. Basically, you need to go and view it. Asset fee, plant and machinery 10 lakh asset is there. You need to check whether that plant and machinery actually exists or not. That is existence assertion. You're going there, and the moment you see that is the audit procedure for checking that assertion, right? For plant and machinery, for existence verification, can you verify it through external confirmation? No. To verify that, you need for some audit procedure to check something, you need the same relevant thing to do that, right? That is what we call relevance. It's a logical connection with the purpose of the audit procedure and the assertion under consideration. To check this assertion, you need this procedure, the relevant procedure. Existence check, to check existence, you need to go and do the thing. That is, existence is assertion, go and doing it is the audit procedure, go and seeing it. Or in that case, sending other audit procedure like external confirmation is not relevant. In that, which procedure is relevant for which assertion? Simple as that. Which procedure is relevant for which assertion? Okay. Then reliability. Can you rely on the documents you get? You got an audit evidence. You ask the management, okay, sales, I doubt some things. So can you send me the sales bill? They gave you a sales bill, and you are planning to use it as audit evidence. But before that, can you just think? Can you rely on that audit evidence? Do you think is it fake? Or is there any manipulation in the statement? That is relevant. There is reliability. Reliability refers to the source. It is influenced by the source and nature and circumstances under which it is obtained. If audit evidence that you are receiving, if it is obtained from outside the entity, inside the entity, they can easily manipulate something and give to you. So it is not that reliable. But if it's from outside the entity, purchase bill that is generated by some other person, why should he do some fake things? No, right? So purchase bill is more reliable than getting sales bill. Sales bill is generated internally, right? So the reliability means can you trust it more? So these are the generalizations about reliability. Very important. Very important means they can ask this question. First is reliability of audit evidence is increased if it is obtained from independent sources outside the entity. So from outside, more reliability will be there. Then audit evidence that is generated internally is increased when the related controls are efficient. Sales bill is an audit evidence that is generated internally. That's reliability of that will increase if there are many controls, internal controls over sales, because there is someone to check whether everything is happening properly, right? Then audit evidence obtained directly by the auditor is more reliable, obviously. Then documentary form is better than like an oral form or something. Documentary evidence is it's a document, certificate or something. That's more reliable. Is more reliable than evidence obtained orally. Documented is more reliable than. Just let me ask you. Someone saying something to you by words, or same thing they're writing it and with a sign and giving it to you. The second one is more reliable, right? More trustworthy for you. Audit evidence is obtained as an original document is more reliable than photocopy, obviously. Then sufficiency. Sufficiency refers to the quantity of audit evidence required, and appropriateness refers to the quality of audit evidence. Sufficiency means quantity. How much audit evidence do you need? If it is a very big risk, just imagine if it's a very big risk, some sort of a very big risk. You will watch the chapter number 3, right? There I told you what is a risk. A risk of error or risk of fraud. You suspect that this plant and machinery amount is having a very big fraud. Or a simple example, a 1 acre land in Nagar. Just imagine the property value is say 10 crore. Just the hypothetical value I'm saying, not 10 crore. You will not get 10 crore, nothing here. So you will not get 1 crore for 1 acre for 10 crore. Understand this. 1 acre land is 10 crore. You know normally you know the figure. But in the balance sheet, they have written the 1 acre land for just say 5 crore or just say 50 crore. They have written some extra amount. You itself know that it is bad, it is wrong. But you need to get audit evidences for that. That's a very big misstatement. So for that, just one audit evidence is not enough. Sometimes you need 2, 3, 4 audit evidences. Sufficiency, because the risk is high, you need better audit evidences to make sure it is correct or wrong, whatever it is. Okay, sufficiency measures the quantity of audit evidence. How much audit evidences you need? If, for example, one person killed another person, and that both of them are some local, like in a local village or something, it is not a very sensational case. So sometimes 1 or 2 audit evidences, police will conclude that this person killed that person. Okay, done. But imagine that's a very big some celebrity superstar or something. One celebrity got killed by some person. Just imagine in that case. In that case, what is actually happening? It's a sensational case. Or police cannot just conclude with one audit evidence because media is there, everyone is watching. So police, before catching the culprit, police has to get like as many audit evidence, some DNA, some CCTV, all these things. But for a local case, will they do that? No. So if the risk is high, more audit evidence is needed. That is a quantity. Okay. Then one more thing is there, look at the quality is also there. In some cases, just a thing, let me ask you, quality of audit evidence. One celebrity got killed by another celebrity. Not by another celebrity, by some other person. Quality means you got, first case, you got many audit evidences. Someone is saying, someone has seen that killer going there. Like he is 6 feet tall. Like that one person is giving you the oath. Then the other person is coming and telling you some other small, many evidences are. Okay. But you may need some 100 small evidences to satisfy that this is the killer. But at the same time, imagine there is just a CCTV where the killer killing, the exact shot is captured on a CCTV or via mobile camera. You don't need any other audit evidences, any evidence, because that's just one evidence. The quality of that evidence is so huge. But evidence in that case. This 100 small evidences you don't need. So if the quality of the evidence is high, then like only 1 or 2 evidences you may require, because the quality of that evidence is just high. So that is appropriateness refers to the quality. So quantity and quality. Okay. Then factors affecting the auditor's judgment as related to the sufficiency. What are the factors affecting sufficiency? That is, when will the auditor decide how much audit evidence I needed? Like sufficient. How will the auditor decide that? And what are the factors he would consider? Materiality. If the materiality is high, then more audit evidence is needed. If you are checking a thing that is a material amount, above 2.5 crore, like we learned, 2.5 crore just an amount, above any material level, you've identified some, you are suspecting some misstatement which is above the material level. So that's a high risk. If it is mistake, it is material misstatement. So you need to get more audit evidences. See, less evidence would be required if the assertions are less material. More required, more material, risk of material misstatement. See, same. Inherent risk, control risk, what we learned, same thing. Then if the risk is high, more audit evidence we needed. Same. Then the size and characteristics of a population, number of items included in the population. Less evidence would be required in case of smaller homogeneous population. More evidence would be required in case of larger heterogeneous population. Heterogeneous means very different kinds of population. Homogeneous means almost similar. And what are the factors? Appropriateness is this much. This is other points regarding audit evidence. Just read it simple. Then what are the audit procedures we learned in chapter number 3? Inspection, observation. Nothing to say. You read it, you will get it. There is nothing complicated. Let's focus on important areas. Time is valuable, right? Because exam is very close. I know that. I don't want to waste your time on topics which you already know. Inspection obviously means you are going and inspecting something. I am taking this is my mobile phone. I am inspecting it. Before buying, imagine if I bought this on a second hand basis. I will go and inspect it. Then only I will buy it. That is inspection. Examining the records, documents, whether internal or external. In auditing case, it is different. Going and checking all the documents, all the certificates, all the reports, all these things. That is inspection. Inspection of tangible assets may provide reliable audit evidence with respect to their existence, but not necessarily. One more thing. Inspection, you may not get audit evidence relating to all the assertions with inspection. For example, I am inspecting this mobile phone. Just by inspecting this mobile phone, I can say whether there are any scratches or anything. Or like opening and checking the camera, I can say whether this is original or not. And whether this mobile phone exists. Existence assertion I can understand from inspection. Okay. Imagine this mobile phone is an asset in the company's balance sheet. This mobile phone is company's mobile phone and it is an asset in the balance sheet. So now you are the auditor, you have to check the asset and the amount is 1 lakh is written. You have to check it, right? So first you will go look at the existence assertion. You will go and ask the manager, okay, management, you are saying balance sheet, one phone is there, show me that phone. So management will give you the phone. Okay, when you look at it, okay, phone exists. Existence assertion is done. Now second, what is a valuation assertion? Valuation or accuracy, say amount written is 1 lakh. By inspecting this, how can I say this is actually worth 1 lakh? Sometimes this may be 2 years old, no scratch, nothing is there. But sometimes this may be 2 years old, the value may have been just like this, right? So by inspection, I can only sometimes get, or rights and obligation. Rights and obligation also, it's say about the entity, not rights and obligation. By seeing the asset, how can I make sure this is entity's phone? Entity owns this phone. That is, rights of this phone is over entity. How can I say that? Sometimes this may be phone of an employee. How will I know? Only thing I can do is existence assertions I can understand. So inspection of tangible asset may provide reliable audit evidence with respect to existence. When you inspect, you get an evidence whether it's actually exist or not. But not necessarily the rights and obligation or the valuation also you will not get. Just by seeing it, how will you know what is the price of that? No. That is one important sentence I told. Observation means observing. External confirmation means you know that, right? Like one debtor amount is there, you are sending a confirmation to that debtor, and like for example, debtor amount of 10 lakh RAM is written. You will send, you are the auditor, you need to check that. You will send a confirmation letter to RAM. RAM will look at that, in that it will be written, okay, I am the auditor of in a company, and in this company it is, your name is there as RAM, the 10 lakh debtor is there, is it correct? So RAM will say, yes, it correct or not. If he says it is correct, when you get that, when he sends the mail back, that thing is your audit evidence, because you saw the amount, you asked that same guy itself, and that same guy confirmed. Okay. External evidence, obtaining direct written response to the auditor from a third party. Then recalculation, checking the mathematical accuracy of documents and calculation. Just do the rechecking. In the Excel, balance sheet amount will be there. It will be total. You can just do it once more. Just recalculate and see whether it is coming correct. Whether the provision amount, they are saying 10% provision. You just put the calculator and see whether 10% is correct, coming is correct. Calculation mistakes may be there. Because nowadays computer is doing this, so some small mistake in the bracket or some equation would change the game completely. So do the recalculation. Reperformance means whatever audit procedures, whatever things they have done, management have done, you may reperform it and see. For example, bank reconciliation, GST reconciliation, those things would have been done by management itself. You can reperform that and see. You do the whether management, whatever they did is correct or not. It involves auditors' independent execution of the procedures or controls that were originally performed by entities' internal control. Then analytical procedure we learn. Then inquiry, seeking information of a knowledgeable person who knows something. We'll go and ask him. He'll say. That is inquiry. Then nothing is collaboration. That not needed. Not explained now. Then risk assessment procedure. We learned the same process. Same. Audit procedure, risk assessment procedure, these three. Analytical procedure is also there. Further audit procedure, we learned all this till now. Then assertions, you know, right? Why should I explain? Okay, then audit trial. What is audit trial? It's a documented flow of transaction to investigate how a source documented was translated into an entity, into an accounting entry. This is basically this accounting softwares. For example, this SAP or Tally Prime, all this bigger softwares, they will have a feature called audit trial. Audit trial, say what it is. Wait. That feature will be there. If you turn that feature on, audit feature on, the feature on, what happens is that if someone, you are already put a journal entry, you have already put a journal entry in that account. I'm hypothetically saying for your understanding. Audit trial means this, like in your school days, in your kids' time, when these magazines, all these kids' magazines were there was something called like you have to draw the route. A house will be kept, a person or someone, a kid will be kept here, and some like this will be there. You have to, and many routes will be shown like this. You have to, with your pencil, you have to draw the exact route like this, right? Here, what are you drawing? Here, you are drawing a trial. Trial means route, road. Trial from here to here, from Chennai to Bangalore. Trial you are drawing. How to reach from Chennai to Bangalore. Trial. Similarly, when you are doing the auditing, imagine here a sale happened. So when a sale happened, till here the financial statements are prepared. So in between many things are there, right? Sale happened, journal entry is there. Then accounting, some other checking or something, or not checking, you say, some trial balance preparation is there. Then only we will reach financial statement. Right? So all this happens in one software. So in Tally, all this happens in one software, Tally itself. So Tally will have a trial, like from an invoice, one sale happened, from invoice, looking at the invoice, the accountant will put the journal entry. Journal entry to it will go to the ledger entry automatically. Then from ledger to it will go to the trial balance. From that, it will go to the financial statements. So this entries will be put by an accountant. This one may be prepared by management, but till here an entry will be put by the accountant. So if the company is having an audit trial feature, in the software in which they are putting this entry, if the company is having the audit trial feature, what happens is, sometimes in between, if someone comes and alter it, someone comes and deletes this entry, or someone comes and, like I have already put the entry, if someone comes and deleted the entry, or someone comes and change the amount was 1000, someone came to do some fraud, they put the amount as say 700. If the company is having audit trial feature, where's the one thing? Immediately we can know who is that person who did that. The software will have that kind of a system. Who did it, when they did it, how they did it, all these things will be mentioned in the software if audit trial feature is on. If someone changes anything in the document, in the accounting system, whoever done that will be flagged out with the time, date, everything. That is audit trial feature. It's a documented flow of transactions. A transaction is flowing, say, and every transaction from the invoice, the journal entry, that will be documented. Who did the work, who did it, at what date, at what time, it will be documented. Who did this? And if this is done by a second person, that will also be documented. If this is done by a third person, that will also be documented. So who changes anything, error or something, it will be immediately shown. So documented flow of transaction is used to investigate how a source document, that is invoice, source document, was translated into an accounting entry, that is general accounting entry, and from there how it was inserted in the financial statements. Got it? Okay. Then all these things are easy. It's used as audit evidence in maintaining a recording system, all the audit evidence, record keepers, then enhance internal controls and data security, all these things with that. Then how audit trail helps auditors? When this feature is there, it inspires the confidence. How? Audit trail feature, when the feature is there, what is happening? Think. Imagine our accountant. Accountant knows that, accountant or any person in the company know that accounting software has audit trail feature. So will they ever think of doing any fraud? No. If they come and do some fake journal entry or something, they do, immediately they will itself get caught, because audit trail is there. When auditor is auditing, he will get to understand who did it at what time. So audit trail irukkiradhanaala they will not commit a fraud, because if a CCTV is kept, why CCTVs are kept in jewelry? So no one will take a ring and put it in the pocket, because it is an evidence there. Right? So audit trail is basically an internal control, like an internal control, act like an internal control. Adu paakumbodhu they will not do the fraud. Okay. So because of that, fraud chance, error chance will get less. So not error, fraud chance will get less. So auditors, if they are auditing something, some company where some companies books where audit trail feature is there, chance of fraud is less. So if a audit trail feature is the auditor confidence inspired. Then help auditor to verify whether controls are devised by the management are operating effectively or not. Then all these things simple. Then relying on management expert work is easy. You just go through it. It's nothing. They're selecting all items specific. One thing. What is selecting specific item mean? Selecting all item means 100 bills are there. You are selecting all the 100 bills and detailed checking. That is selecting all item. Selecting specific item. What does that mean? Then sampling is also there. So 3 options are there. Number 1 is if you have 1000 bills. Number 1, selecting 1000 bills and checking it detailed. That is selecting all items. 100% examination. And from that is one case. Second case, what is selecting specific item, or what is sampling? You will just close eyes and pick 10 bills from the 1000 bills. That is sampling. Then what is the specific items? What is the difference between this and this? Simple as that. Specific item means you are knowingly picking something from the 1000 bills. Sampling means you are unknowingly, you don't know which item you are going to pick. You are closing your eyes and pick. That is sampling. Specific item means you are picking the things which you know. For example, 1000 bills are there. You will pick 50 bills that are above 500, or all the bills that are above 500 rupees. You will fix that in mind and pick specifically. You have a target in mind. That is picking specific item. Here you pick everything. Here you pick something randomly even without knowing what it is. Here you know what you are picking and picks only like a sample. Like for example, 1000 is there, you are picking only 100 or 500 or 200 something. Selecting everything easy. This standard is also easy. Using the work of internal auditors. It's also easy. It's nothing too complicated is there. What is there? Internal auditing. You know, right? Internal auditor means someone who does the internal auditing, and in that case, it's not a very, like if you read it, you will easily get it. It's easy standard. Let's see where something. Yeah. Let's go with sampling. Sampling, like one of the toughest standard, because we cannot waste time on easy things. Let's focus on tough things. Let me see if there are anything important. 2-3 things you'll have. You read it, you'll get it. Internal auditor basically 2 things. Internal auditor is I'll just explain the concept. Someone who's watching audit lectures for the first time. Normally you shouldn't do marathon. Is basically for someone who has already done the revision. Just to refresh the concept. Internal audit is something. Internal auditor, statutory auditor. 2 types of auditors are there. Many types are there. Just 2. Internal auditor means someone who is employed by the company and it is done. He does not have any independence. Statutory auditor will have the independence. Internal auditor will come and do the detailed checking, all these things. And one thing, internal auditor have many time, length of time is more. Like he may be doing the internal audit with taking 1 year. April and March on the time he will be doing the internal audit. He has 1 year to do and finish the internal auditing. Or sometimes I'll have 6 months or 3 months, he'll come and do the auditing. So he had like he can deeply check the data because he have time. But statutory auditor, it is not like that. We don't have that much amount of time to do the checking, and we cannot do that much. So what is happening is that sometimes we cannot do some audit procedures or something. So what we will do, internal auditors would have done those audit procedures while they were doing. So what we will do, we are also CA, they are also CA. So what we will do is we will take the report of what they did. They would have tested one control. Since we don't have time to test the control, we will ask them, given the report that you checked. Then when we get the report, we will go through it and we will use that report for our audit evidence things. Okay, that is using the work of internal auditor. Internal auditor has already done the work. You don't have time, you are using it. That is one thing you are doing. Second thing is called direct assistance. Here it is called direct assistance. It means you are using internal auditor as your employee, because during the audit of the company, you don't know about the company too much, but the internal auditor knows everything about the company. So, and you can use him as an employee, using him for direct assistance for doing the auditing. That's all. Then sampling I'll explain at the end, because it's from a different file. File is different. Not this file I'm using a different file for sampling. Then now we'll go to audit evidences and all those things. SF501 audit evidence. Audit evidence specific consideration for selected items. That is audit. 500 we learned about audit evidences. SF501 is completely different. Okay. This is basically specific consideration for these three only. Audit, when you are obtaining audit evidence related to inventory, litigation and claim and segment information, then only you will use SA501. All the other audit evidences comes under SA500. So what is auditor's objective relating to audit of SA501? Number one is inventory. Relating to inventory, how he is doing. First is he only need to check the existence and condition of inventory. We are auditing the financial statements. At the time, what are we doing? We are checking financial statement items. In that items, inventory will be there. Inventory is one item, right? So we need to obtain the evidence about, objective of auditor is to obtain audit evidence regarding existence and condition of the inventory. In the P and in the balance sheet, it is written as inventory is equal to say 10 lakh. First thing you will go to the company at the physical inventory verification, wherever it is, you will check the existence of the inventory. In the 10 lakh inventory, is it actually existing there? If it was mobile phone, is it mobile phone is actually there? Go and see it. Existence. By inspection, by observing, by inspection, you can understand that. Existence you checked. Then you look at the condition of the inventory. Condition means, if a company is written 10 boxes of inventory company has, and the value is 10 lakh, one box 1 lakh, okay. When you are going existence, 10 boxes is there, you opened inventory is there, but only 8 boxes is in good condition. Other 2 boxes, the rain would have, like water would have fallen that thing, and 2 boxes got completely destroyed. So can you actually sell that item? No. So instead of 10 lakh, the actual inventory value should be 8 lakh, right? 2 lakh boxes gone. The condition of inventory is not good, or they should be put at a local, like a scrap price. For example, some 50,000 or something. So first you need to look at these two things, existence and condition of inventory. Okay, then about inventory only need to obtain audit evidence about these two. Then about the litigation and claims. Litigation, cases against the company, cases by the company, all these things, cases. Not only cases, the compliance with the different tax laws, all these things, all these and cases based on that appeal, assessment, all these things comes under litigation. Warranty claims, all these things. So you need to check the completeness. What is completeness assertion mean? Completeness means all the transaction that should have been recorded have been recorded. 1,000 sales happened. So 1,000 sales should be recorded, complete. Yeah. So litigation and claim means all the litigations and claims involving the entity. Actually, if there are 100 litigations and claims and you have only recorded like 95, so it's not complete. 100 is the 100 record one. That is completeness. Check that whether everything is completely recorded. Then presentation and disclosure of segment information. Whether segment information, lot of laws are there, like you have learned it in accounting standard, all this. So whether the presentation is as per the proper standard, all these things. Whether presentation disclosure is as per financial reporting framework. So to check the inventory, what is this, man? So how will the auditor obtain sufficient appropriate audit evidence regarding the existence of inventory? That is his question. When the inventory is material to the financial statement, auditor shall obtain sufficient appropriate audit evidence regarding the existence and condition by. That is, how will the auditor obtain? First is attend the physical inventory counting. Go and attend the physical inventory counting. Simple. Then evaluate and at that time, when you are attending the physical inventory counting, what are you doing? To evaluate management's instructions and count procedure. That is, management says, okay, count from left to right. Imagine they are saying that. Whether are the employees following that? What is management's count procedure? How they are doing it? You are observing that. Observe the performance of count procedure. Inspect the inventory. Perform test account. No problem. Then once this counting is done, counting then they'll have a record of everything that they counted, right? That is, you have to audit that final inventory records once after counting is done. Then attendance at physical inventory counting involves inspecting the inventory, observing compliance, or simple. Then what are the matters relevant in planning the attendance? This is important. This is not matters relevant at inventory counting. No. The question is not that. This means the matters relevant at planning the attendance at physical inventory counting. Before you go to inventory, attendance, planning the attendance. Before you plan the attendance, you have to look at these matters. Matters relevant in planning the attendance. So you are deciding, okay, next week physical inventory counting is happening. I need to go. At the planning time, you have not gone. At the planning time, you need to consider these things. What are they? First, nature square. See, nature of the inventory. Then nature of the internal control system. Internal controls related to the inventory. Then stages of the work in progress. Timing of the physical inventory counting. Look, then PALR and CC, perpetual inventory system. What is perpetual inventory system? See whether the stock is updated on a real-time basis. If Flipkart, like we purchase something, 10 stocks left. The moment you place the order, immediately it becomes 9 stock, right? Real time it is updated. That is perpetual inventory system. See whether entity is maintaining those kind of system. But if you go to a local nearby shop, there this kind of system is not there. You asked for one kurkure, you got the kurkure. But no one is updating in the computer or anything, no, right? So all these things. Then physical inventory counting conducted at a date other than the date of financial statements. Physical inventory counting conducted at a date other than the date of financial statement. Normally it should be conducted at date of financial statements, 31st March. But if it is conducted at some other date, what should the auditor do? Perform audit procedure to obtain audit evidence about whether the change in inventory between the count date and the date of financial statements are properly recorded. Simple. Normally, the audit thing should be calculated on 31st March. End date, physical inventory counting happens. Auditor gets, this is first. Imagine this is 1st April, accounting year started. Auditor or almost in the September time, the auditor will get appointed. So at this date, he can come and see the physical inventory verification. But sometimes if the counting happens at this date, any date before that, for example, say 15th March, counting happened. 31st March, because some busy of the company, they were unable. So as an auditor, now it is your duty to check whether, so the closing balance of 15th March we got, because they did the counting at physical inventory. So the closing balance is 1,000. So the closing balance at 31st March, you need to perform audit procedure regarding this transactions to see the balance here coming here. The 15 days later procedure you need to see to check whether the balance coming here is correct. That is all the intervening transaction that occurred between these two dates, you need to do the audit procedure, and so finally you will get this amount, which is correct. If physical inventory counting conducted at a date other than date of financial statement, that is this date conducted, auditor, in addition to the procedures required above, that is all these things he need to do, everything which we mentioned he need to do, plus perform audit procedure to obtain audit evidence about whether change in the inventory between these two dates, change in the inventory between count date to this date and date of financial statements, that is this dates, are properly recorded. Then what is, if auditor is unable to attend the physical inventory counting due to unforeseen circumstances, any unforeseen circumstances. Imagine if physical inventory counting is happening at Pahalgam, Kashmir. You have an apple company, an apple a day, like the eating apple. that company is there, and Apple's production is there in the Kashmir, right? Apple warehouse is there at Pahalgam, where the attack happened, terrorist attack. And it was that month, imagine. Will any auditor go to do the physical inventory counting there? No. So it's a very risky thing. Or imagine another situation, auditor is having wheezing, very big wheezing. It's because of some unpractical situations, it was unable. Auditor is having health condition, because of which he cannot come to a godown and where the dust, everything is there. Any situation like that is there. Auditor shall make and observe the physical counts on an alternative date. If it is unable to attend because of some unforeseen circumstances, sorry, what I said was this one, impractical. Sorry. Got mind. Okay, what I said, the example, it is at Pahalgam. This one you forget, this one we'll learn later. I'm talking about this one, impractical. That is Pahalgam, he cannot go, it's impractical. Or imagine he's having a wheezing lungs problem, he cannot go to and do the verification. So his attendance, physical inventory counting, it becomes impractical. It's not possible in any way. Pahalgam is warehouse is there. For the next 6 months, the government has stopped the tourists to Pahalgam. So how can auditor go and audit it? Not possible. Only businesses can do the things. Auditor cannot go. In that case, auditor shall perform alternative audit procedure. Some other procedure way he need to try. Just some comparing with the stock, sales, cost of goods sold, all these things. He can compare quantity, then he'll get the quantity. That way he can do if he want. Comparing with some GST return, all these things. Perform alternate audit procedure to obtain audit evidence regarding the existence and condition of inventory. If that is not possible, then auditor need to modify the opinion. Because normal procedure is impracticable. Alternate procedure he tried, but it is not possible. So modify the opinion. Say in your audit opinion that you are unable to obtain the audit evidence, so you are modifying, giving a qualified opinion, whatever. In some cases, attendance at physical inventory counting because of the nature and location. Pahalgam's case I told you, nature and location. Then in that case, it's okay, no problem. Perform other audit procedure. Then matter of general inconvenience is not sufficient to avoid an inventory counting for which no other opinion is there. That is, you cannot say, oh, sir, Kerala to Kashmir, it's a 5,000 flight ticket, I cannot come. Or I don't have time to come, I'm too busy. Like this, you cannot say, you cannot, matter of difficulty or time taking for being or cost involved is not a valid reason to omit physical inventory counting for which there is no other alternative. If no alternate audit procedure is there and you are saying these kinds of excuses and not attending the counting, then it is not a sufficient evidence. It is not sufficient. You have to do it. You cannot come up with these kinds of petty excuses. No. Then these are the alternate audit procedure inspecting the subsequent documents. Then for example, 31st March inventory is a 10 lakh. Inventory is a 10 lakh. And it is written as 10 lakh. A quantity is a 100 quantity. The inventory total is 10 lakh. And to check this, if nothing is possible, just check the sale in April. Sale in April, that is in the next year, April. So what happens? If the sale in April is around 70 to 80 quantities have been sold. So what do you understand from that? They can sell the 70 to 80 quantity only if it is there in the inventory in the 31st March, right? Then only they can sell it in April. So if the quantity sold is like 70 to 100 quantities has been sold on April, that means almost 100 quantity was in stock on 31st March. Then only they can, that quantity only they can sell it in April, right? So that way is a way to check the quantity or the price of inventory, subsequent sale, inspecting the documents of subsequent sale. Then if inventory is under the control of the third party, what will the auditor do? I needed some money and I'm the company, I need some money. So since it was unable to get a loan, what I did, I gave some of my inventory with some party and I pledged this inventory and took a loan from them. So now the year end comes, auditor is coming to do the inventory. My inventory is with some other party and he has given me loan. So I cannot go and take it. My inventory is with him. In that case, how will the auditor? Because in my financial statement, the price of that inventory will be included because anyways it is my inventory. I'm just given this as security only. So in this case, auditor cannot go there and see the existence. It's tough because it may be in some other person's premise. You cannot go there. So how will the auditor obtain audit evidence? First, request the confirmation from the third party. Ask him, bro, I am the auditor of this company. Is it actually there? If in the allowed inventory, if it is it actually there? If yes, then please tell me what is the quantity and quality of all these things. Please tell me quantity and condition. So he may write it and give it to you. Then perform inspection or other procedure which is necessary in the circumstances. Other audit procedure involves inspecting the documents, requesting confirmation, same things. Then litigation and claims. All the cases against and all the cases in the name of the company, given by company or given against a company, whatever it is, cases and claims also. How to check that? First ask the management, inquire the management. Bro, what are the cases against our company? Management will give you an idea. And in-house legal counsel also, you talk. Next, review the minutes of meeting of TCWG, because in meeting they will be discussing about the cases we have. So when you read the minutes, you will get an idea. Then review the legal expense account, because if there is a case, advocate will be there. You would have paid money to advocate. So in the P&L, if you see legal expense amount, then that means a case is there in that year. You can ask the manager, bro, manager is saying no case. Then to whom the hell you paid this money? You can ask, right? Okay. Then how to seek? This one is important. If this is, I'll say the content of this, it simply means sometimes this is, I am the auditor of this company. I can communicate if any issue is there. I can communicate with the advocates of that company. I am the auditor of this company, and that company may have, for example, I am the auditor of Byju. Just think, not Byju is gone now, but think I am the auditor of Byju. Byju will have a lot of complaints cases against it. And so I want to do the auditing of Byju. I wanted to talk with the auditor, to the advocates of Byju. That is Byju's external legal counsel. External legal, not people inside their company, advocates outside their organization, external legal counsel. If auditor assesses a risk, bigger risk is there, I found out some bigger risk in Byju. So I need to talk with their advocate. Regarding litigation or claims, communication with entities, external legal counsel. How to do that? First of all, I need to go and tell Byju, bro, in your financial statement, I find out this one big mistake. This is a big mistake. About this, I need to talk to your advocate. Can I do that? Byju may agree, Byju may not agree. But Byju may agree. Byju told, okay, bro, no problem, bro, you communicate. No problem. In that case, you seek direct communication with entities, legal counsel. You send them a mail or go and meet them, whatever it is. Yeah? And how normally send a mail. How this mail happens is, first you will send a letter of inquiry. Letter of inquiry you will send. In the letter you will ask whatever you need, they will ask, and sometimes they may respond. You will get it. That is a way to go with. Normally, like an external confirmation, you can do this. But there may be a problem that sometimes they may not respond, because as per their bar council law, all these things, there may be prohibition for them. Don't respond to unwanted auditor's request, like that. Sometimes their bar council would have told the advocates. In that kind of a situation, what you will do? If law or regulation prohibits those external legal counsel from communicating, in that case, you have to perform alternate audit procedure. So first ask Byju, I'm going to communicate. Send a letter of inquiry. If they reply, you will get the certain audit evidence. Okay. And if they're saying it's not possible, some law regulation issue is there, then you need to perform some alternative procedure. Then letter of inquiry. This one, letter of inquiry, it is actually divided into two. Letter of general inquiry and letter of specific inquiry. Two things are there. General inquiry and specific inquiry. You need to understand what this is, because MCQs can come. General inquiry means it is a letter. In that letter, you are writing the letter to the external legal counsel. You write, okay, sir, I am the auditor of in a company like Byju. I need to know and give me the list of all the cases of Byju you know. You are generally asking, give me the list of all the cases, or give me the items of all the cases, like that. Generally, you are asking everything. If someone sees that lecture, will someone respond? No. Like, do they have time to respond like all the things? No. Letter of specific, first you will send a general inquiry. Normally auditors will do general inquiry, they will send first. Then if they are not responding, you can follow it up with this letter of specific inquiry. That is, you can like, okay, I am the auditor of Byju but Byju have many cases, I know that, but in this one case, you pick the one case number or one issue which you wanted, like one or two things. You specifically mention the things which you need to know. Mention you sent. But here you are specifically mentioning 2 or 3 case numbers or case details which you need to know. That is letter of specific inquiry. Okay. Then all these things where the case is auditor means, when will the auditor go and meet the legal counsel? Go and directly meet. Advocate may be in Delhi Supreme Court. I am from Tamil Nadu. I may be taking flight and going and meeting him. When are those cases? First, if it's a significant risk, company is a period problem. Then the matter is complex. If there is a disagreement between the manager and the legal counsel, there's some disagreement is there. Then in case of non-response, management, the external, you send the letter of inquiry, they are not responding. Legal counsel is not responding. In that case, if sorry. If the management refuses to give the auditor permission to communicate with the legal counsel or entities, legal counsel refuses. First, you ask the management and management say, no, I won't allow you to communicate with my advocate. Management is saying like that. Or management says you communicate, okay. Then that external legal counsel is not responding to you. In both these cases, first of all, do some other audit procedure, try to see, and try to do some other audit procedure if it's possible. Else, an auditor is unable to obtain sufficient appropriate audit evidence by performing alternate procedure, performed something but unable, then modify the opinion because he tried everything. He tried confirming, management either agreed or won't agree or that guy will not respond. And he performed other procedure also, still unable. So modify the opinion. Okay, then one more thing, if management agrees, it is not related to this case, it's the other case. If management gives the permission, normally when I request the manager and they say, okay, you go and meet my external legal counsel, they will not allow you to go alone and do it. No. Management will also send some person from their side also, management side also, just to see what you are talking with the legal counsel. They need to know, right? That is one thing. Second thing, sometimes the external legal counsel may not speak to you. So management are all in the better. So in that case, okay, got it. Then segment information. I mean, guys, please understand, we are having a marathon. That is why we are going really quick. It's not like how we in classes, we are not doing it like this. We'll sit and explain everything. The topics that are taken around 80 hours, I have to finish it in 10 hours. Because it's just a revision. My hope is that you guys have already watched lecture, not watched lecture, you have studied auditing at least once. Segment information. Segment information means a company. For example, I take a company like Nike. Somewhere here I saw it. Nike. This is a letter of general inquiry, specific inquiry. Somewhere I saw Nike here. This is Nike. Nike company is divided into two segments. Different in accounting, you would have learned that, right? So business segment, geographical segment. Business segment, you can say what are the based on different products Nike is selling. Like clothes is one product, clothes business, footwear business, bags business, like that. When you divide Nike in the base of geographical segment, you can say Nike India, Nike US, Nike Europe. Like that you can say. This is what we call segment. So as per the accounting standard of, like, what was the standard? Forgot. AS what it is. In days it's 108. So accounting in the case of segments, there are a lot of rules as per the standards. Accounting standard rules are there. Segment in the madri, you have to disclose all these things. So our duty is to check whether that disclosure is actually proper or not. Simple. How to check that? Obtain sufficient appropriate audit evidence regarding the presentation and disclosure of segment information. That is only our duty. First of all, we look at what is the method used by management in determining segment information. Management will have many methods. First, to see what method they are using. Second, evaluating whether that method result in a disclosure as per AFRF. They are using one method. So as per the financial reporting framework, is that method correct? Whether the disclosure is coming proper, that thing they'll look. Then whether appropriate testing will just take some trial sample or something and we'll just try this method once and see. There are many methods on this, like internal reporting status, EODM, like many methods are there. You don't have to worry about those methods. Just first we'll understand what method a company is using. Then we'll look whether that method is appropriate as per financial reporting framework. Then we'll see, then we'll test that application of that such a method. Some testing we'll do it. But test try CARO. Then perform analytical procedures also. Then understanding the method used by the management for simple things. Then external confirmation, easiest essay, you know that. Not wasting too much time here. Because we need to waste time on sampling and analytical procedure. We need to waste some time. So we are saving time on easier standards. External confirmation. External confirmation, I told you in the books of accounts, the debtor figure is there 10 lakh. How to get the how to check that? One debtor Ram, his name figure is 10 lakh is written. How to check that? Simple as that. Just ask Ram's email ID from the company. Make a letter. Ram, this is Sudarshan, this is auditor of this company. And in this company's balance sheet, your figure name is there as debtor and the amount is 10 lakh. Is it correct or not? In that letter, we will send to Ram, and Ram, when he sees the mail, he will respond. If it is correct, he will say yes. If it is not correct, he will say no. In whatever case, that is an audit evidence. That reply mail is an audit evidence which you can use. Okay. First of all, positive confirmation request. Positive confirmation request means I send the request through mail. He will reply if he agrees or not agrees. In both cases, he will reply. Even if he agree or disagree, he will reply. If he will say if it is correct or not, he will say it's not correct, like that. Negative confirmation request means he will reply only if he disagrees. I send something. If he agree to that, I send a confirmation request with the 10 lakh amount. And if he agree to 10 lakh, he will not respond. He will respond only if he disagree. That's it. Then non-response. Non-response means I send it, they are not responding. Simple. Then exception. Exception means you asked him, bro, Ram, 10 lakh, with the amount of 10 lakh, you send a request. And he is saying that, no auditor, it's not 10 lakh, it's 8 lakh. You are asking to confirm him 10 lakh and he says, no, not confirm. 8 lakh is the amount. That is exception, difference. You are asking something, the information you ask him to confirm and the information he confirmed is different. Okay. Then external confirmation is a very easy standard. Nothing is first. How will you external confirmation audit procedure? How you are checking the external confirmation? Number one is first you will determine the information which need to be confirmed. In the information, for example, debtor Ram 10 lakh. That is my information to be confirmed. I will determine that first. Then I will select the appropriate confirming party. Who is the party? Ram. Ram's debtor Ram can only confirm, right? Then designing the confirmation request. I'll write in the present format, letter alla format, thank you yourself, all these things, that format. Then sending the request, and once we send the request, they may not, normally they will not reply. So you send a follow-up request also, follow-up message back after 2, 3, 4 days. Okay. Then same thing is written there. What are the factors you need to keep in mind while designing a request? All the simple area. Then positive confirmation request. This area I need to talk. Wait. What is positive confirmation request? That is the problem. I'll ask you a problem. I'll say you a problem. I send a confirmation request. Normally, will they reply? Why should they open? Imagine I'm sending a confirmation request to Ram. I would have sold some good to Ram. Ram need to pay me 10 lakh. Okay, this is the company. And then auditor came. And auditor will send a confirmation request to Ram. Is it correct amount? Why should Ram reply? Why should Ram look at his books of accounts? He said 10 lakh or 8 lakh. He'll let him look and reply. Why? He's bored. He'll not do that. That is a problem. That is a problem with the positive confirmation request or any request. So the problem is, to solve this problem, they said, first you send a blank request. Send a blank request. You send a blank request to them. For example, you can say a request without the amount. Ram, this is Sudarshan, the auditor of this company. So here the amount is amount in the area, you will not put the amount, blank request. So when it receives, he will open his books and he will put the amount and he will reply. Sometimes there is what will happen. I say, you are putting, say, 10 lakh amount and sending it to him. He may be playing cricket in the time layer message on that. He'll take it, see it, 10 lakh amount, whatever. He'll not even look at the amount. He'll say, yes, confirm, like that. So the amount may be wrong. So to avoid that error, you will not put the amount. So even if he's playing cricket, reply pocket letter, he will go to his office tomorrow, then open the laptop, see the amount, and then he will reply. So we will get the correct amount. That is why we will give a blank request. That is a blank request. But there is another problem. This is done to have an advantage over the first thing. But there is another problem to it. He's playing cricket, open it. Okay, a blank request. I will reply. Put it in pocket and he went. He forgot. Blank request. Who cares to open the book and open the books of account, see the amount and put it? No. Right? So that is a problem with blank request. Sometimes they will not reply. All positive confirmation request, ask the confirming party to reply to the auditor in all the cases they will ask. Okay. Leave it. This one. There is a risk that the confirming party may reply to the confirmation request without verifying the amount is correct or not. Auditor may reduce this risk by not stating the amount, not putting the amount. He can reduce that risk and asking the confirming party to fill the amount or furnish the information. On the other hand, using of this type of blank request will result in lower response rate. Okay. Other thing, then this is easy standard. Full of rest is easy. Nothing is there. Then 510 auditing, initial audit engagement. Just one concept I need to say. That's it. This is applicable when you are auditing a company for the first time. You are auditing that company for the first time. It doesn't mean company is auditing this is for the first time. No. You are auditing that company for the first time. Company would have done its audit previously many years. Imagine I am auditing Reliance this year. Reliance is an initial audit engagement for me. For me, I am auditing it for the first time. But that doesn't mean Reliance has not done audit in the past year. No. This standard is applicable when I am auditing. Initially, when I am auditing this company for the first time, I need to follow SA 510. That happens only in two situations. Number one, that company is a new company. Like last many years, it has not been audited. It has not been audited. I am the first auditor for that company and I am doing it for the first time. Number one. Number two, I am auditing that company for the first time. Then number two is it was audited by a predecessor auditor, different auditor in the last year. And this year onwards, I am doing the auditing. Yeah, that is also correct. I am auditing it for the first time, right? That's it. That is called initial audit. Okay, just think once, you'll get it. It's very easy standard, but some people think that should be company's first audit. For me, that should be my first audit of that company. Company can do like many audits in the past with many auditors. That is not a problem. I need to use this standard only in that case. And allatha case I'll check with the opening balance, all these things. But reporting as per the standard is only required in these cases. Okay. First, to obtain audit evidence regarding whether the opening balance contain any misstatements. CCC. As per SA 510, the auditor's responsibility relating to opening balance when conducting an initial audit engagement. Initial means first time. I am doing it for the first time. Okay, initial audit engagement refers to the engagement in which either financial statements for the last year were not audited by anyone. It's like a new company or like a small company thing, or were audited by a predecessor auditor. Okay, then this is my two objectives. All these are easy. This standard is not a simple standard. Let's go to related parties. Who are related parties? Who are related parties? Who are related parties? Related party, first of all, it's a party defined as per the financial reporting framework. That is in your accounting standards, everywhere related party definition is written, right? Either it can be that definition, or you can take it as if financial reporting framework does not give this kind of a related party requirement, then these are the related parties. Related parties, number one, means a person or entity has control or significant influence over the reporting entity. Imagine this is our entity. This is what we call reporting entity, my company, Reliance. If any person or any other entity is having a control in this, that is what we call a related party. Control or influence. That is called both of he and this company are related party, and this company and this company are related party. Number one. Number two, directly or indirectly. That is, sometimes this person may be owning a share like around 70% share in this company, and this company owns 60% share in this company. So he will become a related party, right? Simple, you know that, accounting. Then another entity over which a reporting entity has control. So this is first case. Then I'll give a second case. This is our company. Sometimes our company, this is my company. My company has bought a 70% share in another company, Geo. So both of them are related parties. Or I have bought a 70% share in Geo, and Geo bought another 70% share in another ABC Limited. So me and ABC Limited are also related. See, another entity, this is another entity over which reporting entity has control or significant influence, directly or indirectly. Directly in this case, indirectly in this case. Because indirectly means here I am not directly holding. Indirectly hold. Then another entity that is under common control with the reporting entity. That is one entity, one person. Imagine this person, or imagine he is a company. He has two companies under him, A and B. So both A and B are related because it's under the common ownership. Then owners are close family members. Imagine this is Mr. A and Mr. B is there. B has another company called C Limited. The C Limited and A and D are related because A and B are brothers. And not a brother or a company, and my company is a related party. Then common key management, both the company are doing under a common key management. In that case also it is a related party. And let me ask you one thing. LIC and BSNL, both are government companies, right? LIC BSNL, under government bodies, both of them. Are they related? And body like government authority level companies, LIC and BSNL, are they related? They are not related. Even though they are both owned by the government, still you can say that both these companies, under the government ownership, companies which are under the government ownership will not be stayed as related because they are under the same ownership, but still we will not say these two companies as related parties unless they have some significant transaction between them. But LIC is giving so many insurances to the BSNL people at a discounted rate. So that means LIC and BSNL are entering into significant transactions. And since the government is also controlling them, they will become related party. But in other cases, they will not become related party. Normally, if they are not having any transaction between them, it's not a related party. Just by the government, no problem. So entities under the common control by a state are not considered related unless they have a significant transaction or they share resources between each other. If they are not having anything in between, no problem. Okay. Then meaning of control and significant influence in relation to related party. Control. Okay. Control means basically one thing. Control means your power to govern. Here the power to govern. Imagine I have more than 50% stake in one company. Here I alone, one person, me itself can decide what's happening in the company. That is power to govern. That is a weird. In significant influence, you don't have power to govern. You may be having some 30% share in that company. Others also may be having 30%, 20%, 80%, 60%, some shares in the company. But since you have 30%, you have a voting right. Your opinion is valued, but you alone cannot govern that company. Here you alone can control the company. But in this case, you can just your opinion, everything you can say, like everyone's opinion considered, your opinion will also be considered. Significant influence means power to participate in the financial and operating policy. Example, this voting rights or something. Here you cannot govern, but still you have a sense of control, like a small control. And one more thing, just guys understand, how will you get this control and all these things? How will you get this control? Through equity holding, shareholding or financial interest, 50%, 80%, 60% shareholding. And the entity is holding directly, so basically shareholding. This is on the entity and this is by the entity, 2 points. Then, being a part of TC, you are the board of director or audit committee or the CEO, CFO, you are a related party, obviously. Then, being a close family member, my brother is running Baiju and I am Baiju's brother. So, if I am having a company, or me itself is related to that company and my company is related to Baiju's company. Okay, then having a significant business relationship. This is very, very important. You will sometimes get a case scenario in paper. This is, please don't leave this. This means, let's take two companies, Kia and Hyundai. Exactly, I don't know what's happening in between them, the contract, but Kia and Hyundai. Hyundai is running only because of Kia. Just imagine, Kia don't have any share in Hyundai. Just imagination. Kia don't have any share in Hyundai. This is Kia. This is Hyundai. Kia don't have any share in Hyundai. Kia don't hold any share. Kia's management is not Hyundai's management. Just think like that. But the only thing is Hyundai manufactures all their cars with Kia's patent, or say for example some majority, some 80% or something with the Kia's patent. Designing, engine, everything is given by Kia. They don't have any share on each other, no. But Hyundai to manufacture the car, support from Kia is needed. So obviously we can say that actually Kia may be controlling Hyundai. In this case, it can control or influence, you can say that. Because if tomorrow Kia says, give me 10 crore rupee, else tomorrow onwards I will not give you my engine. Hyundai will have to give it, basically controlling them. So here, because the patent is with Kia, Hyundai cannot do anything, patent is with Kia. Okay, this happens. Okay, that is called significant business relationship. Even without any percentage share or something, this kind of things will be, you can control. Okay. Then, meaning of related party, all these things, the nature of related party is simple. Then, understanding the entities related party relationships. How will you understand? First of all, auditor. Understanding the entities related party relationship. So, what is our duty? We don't have to look, because we are auditors. We don't know the company. And the company related party, we will not know. They may have thousands of related parties. I'm not a related person of that company, so I don't know anything about who are the related parties of the company. Nothing. But so what is our duty related to auditing? First thing, ask the management. Give me the identity of the related parties. Tell me who are your related parties. Tell me. Give me the details. Give me the details. Tell me. Ask your identity. Parent, name, and details. Ask me their identity. Second, the nature of the relationship. How that person became your related party. Ask the management. Or how that company is related to this company. Sometimes because of the brother-sister relationship. Sometimes equity holding. Sometimes business relationship. Many reasons may be there. Then whether the entity with that related party, whether our company did any business this year, any sale or purchase, anything we did this year. If yes, then what we did, whether it was a sale, whether it was a purchase, whether it was an expense, what was that? What is the type of that? Type of transaction you did with the related party. Ask the management. Then tell what is the purpose of that transaction? Where a company, why you did with that person itself? What is the purpose of the transaction? Anything you can ask. Okay. So first, ask for the identity. Our name and second, ask nature of the relationship, how they became your related party. Ask this to the management. You are auditing a company has a management. To the company, you are going and asking who are your related parties. Tell me, give me their name, give me their how they become, then whether any transactions you did with them this year. If yes, give me the type and purpose. Okay. Then I don't know. This one, it simply means that auditor shall inquire the management and I'll leave it. Management to obtain an understanding of the controls that management has established to. This is important. I'll say what it is. It's not like important, but still you have to understand. Why? Because auditor shall inquire the management to obtain an understanding of the controls that management has established to identify, account and disclose related party relationships. See, authorize and approve significant transactions. Authorize and approve significant transaction. This is with the related party. Outside normal person. This is because why? Because the problem is that company will have like daily lots of transactions happening in a company. Other lot of related party relationships will be there. Related party transaction relationships, all these things will be there. So this normal account, because say for example, if I am selling my product to outside for 100 rupee, if I am selling the same product to my related party, I will be giving it for some 90 rupees. Some discount will be there because he is my related party. So what happens is, in the related party transactions, will not be normally approved by the accountant. Normal sales and purchase will be done by accountant itself. Accountant itself can give the money. But for related party transactions, of either the finance manager or some senior person need to approve it. Because 10 rupee we are lesser I am giving, because so some fraud should not be there. So related party transactions need the approval of some senior management. Okay. In that case, if you need the approval of senior management, so that senior management is basically a control. A finance manager is a control. He is controlling it. Like nobody should weekly give some software or above him some another person may be there to control. So company will have a lot of controls like this to identify, account and disclose related party relationships. Company will have internal controls to do this. Enna related party transaction daily happen. So I have to identify that. And other account data entry to put it and to disclose it, company will have controls. And company will have another controls to authorize and approve the significant transaction with the related party. I told you, finance manager can only approve transaction with the related party. Because 10 rupee discount. So we have to do it. Finance manager can only do it. Accountant cannot do it. Same thing with here. With the transactions that are outside the normal course of business. So many controls will be there. Many controls will be there like this related to related party. Controls of related parties will be there. So as an auditor, we need to obtain an understanding of this controls. Not about this. We need to obtain an understanding of the controls used by the company to identify the related party relationship, significant transaction, all these things. In the controller party, we need to get audited. We need to understand them. Auditor shall inquire the management to obtain an understanding of the control. Okay. Control kept by the company to prevent related party, to approve, authorize, identify all these related party transactions. Okay. Then, how can an auditor verify the existence of a related party relationship? How will he verify? Just look at all these things. You can identify the related parties, looking at the tax returns, looking at the, what is 3, 4, 5, 6 things you keep in your mind. That's enough. Other things, don't leave it. Just go through it 1 or 2 times before the exam, because some MCQs can come from related to this. So 3, 4, 5 things you keep in your brain, memorize things. Sometimes if a question comes, it's easy 5 marks. So 5 points you keep in mind, other points you just MCQ purpose you will keep it. Then essay 520 analytical procedure and 530 sampling. 2 topics are pending. We'll see. Wait. What do you mean by analytical procedures? Okay. Understand this. Since routine checks cannot disclose all mistakes, I'll leave it. Let's focus on the concept, because reading everything is not possible. Analytical procedure is basically comparison. Many things are there in analytical procedure. I'll give you an idea. Analytical procedure. Number 1 is you are comparing current year with the previous year, or basically comparing. Number 2, you can say you are considering relationship. 2 things. This is what we call analytical procedure. Please be with me. It's a bit conceptual in the initial stage. If you get it, it's very easy, or if you don't get it, you just rewind it and watch it 1 or 2 times. Okay. Analytical procedure basically means comparison and consideration of relationships. Comparison means, for example, you can compare current year data with the previous year data. Current year financial statements you have, right? In that, sales is there, previous year sales is there, or current year gross profit, previous year gross profit. If you compare current year 8%, previous year 9%, so current year why the dip happened. You can think like that. When you compared both, you identified a conclusion why the dip happened. Then you go behind that and do the checking. Like what? Then you go behind that and do all these things. That is one way. Comparing current year with the previous year, you can do current year data, anything with previous year, not only financial statements item, anything. You can compare the current year quantity of goods sold. Quantity. Current year 5,000 quantity sold. Previous year 3,000 quantity only sold. Why we were our current year 5,000 sold. Previous year 8,000 sold. So auditor in the comparison, auditor will itself, he'll think, okay, why this year quantity sold reduced? He'll have a question in his mind, right? Then he will go the detailed checking. At that time, he will identify some fraud or error or something. So first in the comparison, he'll get a doubt. From the doubt, he'll identify, it's like a risk, some fraud risk. Then he will do the detailed checking later. So this first using the analytical procedure for identifying in the type of risk. To get to that doubt is what we call normal analytical procedure, used as risk assessment procedure. There we are not testing anything. We are just comparing 2 statements. Okay. So when we see the sales here, we'll have a doubt or something. So we'll write in the book, okay, risk assessment is at the time, oh, this is sales is a risky area because current year level so next year I need to do the detail checking. Like that you'll write and keep it. Like not next year, so I need to do the detail checking. So when you go for further audit procedure, you know sales need detail checking. You'll do the detailed checking in further audit procedure. So when you are using analytical procedure like this, for just identifying the risk only, you are using it for identifying and assessing. That's detailed test just identifying and assessing you are using, that is called a normal analytical procedure. Normal. Analytical procedure and substantial analytical procedure is the same. But using it for normal purpose is called normal analytical procedure. Like in the risk assessment, using it for risk assessment is normal analytical procedure. But if you are using it for detailed checking, the same comparison that you are using for detailed checking, then it becomes substantive analytical procedure. See, somewhere, this is audit procedure, right? Audit procedure, risk assessment procedure. Here also we have analytical procedure. So if you are using this comparison for just identifying the issue, that is this one. And the identify panni, we will write it in a paper and keep it. And we will do the detailed checking of this, whether any issue irka illa. Detailed checking is done through further audit procedure. That way we may use test, substantive analytical procedure, test of details or anything we will use. But if you are using analytical procedure at this stage for identification, it is risk assessment. If you are using the same analytical procedure for detailed checking, not the same, some different analytical procedure itself, same comparison or consideration itself, for detailed checking purpose, it's called substantive analytical procedure. This is a basic understanding for your exam purposes. Okay, then one thing I'll say. What is analytical procedure in the comparison. One thing we know. Then I'll give you many examples so you'll get an idea what this is. Rather than explaining it, one comparison I told you, comparison is analytical. Then consideration of relationship. See, consideration of relationship means, this example, we'll read and go. As per 520 analytical procedure, it means evaluation of the financial information. Okay. Through analysis of the plausible relationship between financial and non-financial data. What are you doing? You can take two examples. So here example last class right. Okay. Here you have two examples. Previous yearly, you know, quantity sold was 1000 units. And previous yearly you got 10 lakh rupees sales amount. This is a previous year data. So current yearly, if you see, if quantity is 2000 unit, then what should be the sale figure? This is your expectation. Current yearly, actual current yearly figures here. Actual current yearly quantity sold was 2000 units and the sale figure is say 18 lakhs. But no, based on this trend, 10,000 units, 10 lakh. So 2000 units, 20 lakh should come, right? So your sale figure should be 20 lakh. But in 10 lakh, actually books of accounts, it is 18 lakh. But you actually should be 20 lakh. This is what you identified. You compared last year order financial data. Sales is a financial data. Quantity is a non-financial data. You compared these two with the current year. And you identified and you evaluated a logical relationship between them. You compared these two. The current year, previous year, current year data you compared. Financial data, non-financial data, you compared. And you identified a logical relationship between them because 1000 units are not 110 lakh. Then 2000 units are not 220 lakh. You identified a logical relationship between them. That is what we call analytical procedure. See, you are evaluating the financial information. Because your duty is to, this is the current books of accounts. So current books of accounts sale is 18 lakh. So your duty is to check the 18 lakh sale correct. I need to check whether the correct. So rather than looking at all the invoices and doing the calculation, and the last year current year prediction I'll do it. And that is analytical procedure. I'm using it substantive analytical. I'm checking it detailed. See what I did. I evaluated the financial information. That is, I evaluated sales. How? Through analyzing a plausible relationship between sales and quantity among a financial data, non-financial data, sales and quantity. That is a procedure. Got it? Okay. Then another example of substantive analytical procedure. If you see, you can get. You need to verify the total wages. Say for example, the examples will only help you to understand this chapter. Otherwise, you will not understand. Total wages in the books it is written the wages is equal to say 10 lakhs. In the books of accounts, P and it is written like this: wages is equal to 10 lakh. Now you need to check it. Two options are there. Either you can use a test of details like ella wage or salary statement and you can compare like this. That is one option. Second option is that you can use analytical procedure. How? You will ask the manager, what is the total number of workers? Manager will say from 100. Okay. What is the total number of days? What is the average salary paid to a worker? He will say 1000 rupees a day. 1000 rupees a day means into how many days? This many days. 100 workers are there, or just say 10 workers are there. What is the average salary paid? They will say 1000 rupees per month. Just like 1000 rupees per month. So average 12,000 rupees per month is a salary. So you know 12,000 rupees per month is a salary. How many workers are there? Say just imagine, or not 12,000. For a calculation easy, you just say average salary is 10,000. If you know this, you got the number of workers. You got the average salary into how many workers all this. You can multiply and see whether this figure is coming to 10 lakh or not. If it is something near to 10 lakh, it is coming around like 9 to 11 lakh in between. So it's like not a problem because anyways you use the average salary, right? So if it is something coming around near to the wage amount, it is okay. Okay, now we need testing. Okay, almost correct. We don't need perfection. We know almost correct. Okay. Ow. Okay. We don't need the perfection. We just need the basic correction. Okay. If it is coming, just say, if it is auditors calculating this and if it is coming to say 6 lakhs. Here it is 10 lakh. Sometimes in the fraud, expensive, sometimes they would have manipulated or something. Right? So because of that reason, so this is what substantive analytical procedure. Here you are using the relationship between total number of wages, total number of workers with the wages per day. Right? This is also analytical. Any pattern you can use it. It is not like this way. If you know in the books of accounts, it is written as the interest paid, interest expenses at 10 lakh. To check that, it is very easy. You can just use the calculation. What is the interest amount, loan amount into number of days a loan has been taken, like that into interest percentage. If it is coming something near to 10 lakh, it is correct. This is called analytical procedure. Either you compare 2 years or things, or you consider the relationship between the two, or you can do comparison with the consideration. That is analytical procedure. Got it? This is basically considering the relationship between loan amount, number of days, and interest. In the time here we were considering the relationship between all these things. Okay. Hope you got the concept of what we mean by analytical procedure. Basically, you are using this to compare. And when you are comparing, it's not necessary that current year with the previous year. No, you can compare with the 10-year back also if you want. Or if you want, you can compare our business Zomato with the Swiggy. You are auditor of Zomato. You compare Zomato's data with the Swiggy's data. Zomato sale with the Swiggy's data. So you can compare actual versus budgeted. Year start we budgeted 10 lakh sales value. But at the end of the year, the sale is only 8 lakh. You compare both and see what is the difference, all these things. That is analytical procedure. So our competitor versus different competitor, you compare anything, brand A versus brand B, anything you can compare. So examples of analytical procedure having consideration of, comparison. See the comparison of financial information. Examples of analytical procedure having, if you want, leave it, this one, black no problem. Examples of analytical procedure having comparison of financial. When you are comparing, what can, in this phase, what all can you involve? Comparable information of previous year, then anticipated results. Actual versus budgeted, you can compare. Then similar industry information, current, our industry with Zomato versus Swiggy, you can compare like that. Then examples of analytical procedure having consideration of relationships. This was comparison of financial information. See, comparing two informations, current year, previous year. That is one. Then considering relationship in the loan, wage, like that. You can use many things to consider the relationship. Don't overcomplicate it. It's that simple. Either you can use analytical procedure for comparing two things, or you can use it for considering the relationship between two things and predict something. Okay. See here, comparison means you're comparing current year with the previous year, comparing current year data with the budgeted data, what we budgeted, then comparing our information with the Zomato's information. All this are comparing. Here it is not comparing. Here we are not looking at here and here. No. This is also analytical procedure. This plus this is analytical procedure. Okay. Considering the relationship means you are considering the predictable pattern. You are creating a predictable pattern. Last 3 years like not thing. So you don't compare there. You just think, say the payroll, that number of wages calculation we did, or interest expense calculation we did, anything. Okay. I believe you got an idea about analytical procedure. Basic idea is enough. The rest everything you can read it. Once you get this idea, then now it's easy for you to when you read and you can understand it easily. What are the objectives? All these things are easy. Purpose of analytical procedure. Why do you want analytical procedure? By comparing current year with the you will know about new things. When you compare current year with the previous year, you will identify new things. You will identify new risk. So you can go and do the deep checking and you identify some issues, anything, you can easily identify that. See, by comparing the balance in P&L with the previous year period, current year, previous year compare, you will find out the reason for increase or decrease in any amount. Or current year sales was 10 lakh, last year is 9 lakh. What happened? Why suddenly it increased this year? You can do the reason, all these things. Then by setting up a certain expense ratio, when all these are easy. Independent verification, correctness, also. Analytical procedure, you can use at a planning phase, a testing phase, and completion phase. At the starting phase, risk assessment, that charter you remember, right? Their analytical procedure is there. Using analytical procedure at that phase is what we call using at the planning stage, because we are risk assessment is the planning stage. At that time itself, we are using analytical procedure. That is analytical procedure used as per set 315. This is analytical procedure which you use as per set 330. Testing or completion phase if you are using. And one more thing, guys. One thing I need to forget to say. What is the objective of auditor as per analytical procedure? Please be with me. First is obtain relevant audit evidence using SAP, substantive analytical procedure. Okay. To do the detailed checking, you do the, for like I told, if wages, any issue is there, wage amount is 10 lakh is given. You need to see whether it is correct or not. So use the substantive analytical procedure. So other some 6 lakh worth. How can that happen? It should not come like 6 lakh. Then you do the correct with the exact amount, it is coming to 7 lakh. So that means some error is there. In books it is 8-10 lakh, and when you did the substantive analytical procedure, it is coming only 7 lakh. So that is an audit evidence which you can use, because it's a mistake. You checked it, but it's only the figure is 7 lakh, but it is books it is 10 lakh. Okay. That way. Second thing is that design and perform analytical procedure near the end of the audit that will assist the auditor when performing an overall conclusion. What does this mean? We are auditing. Auditing finish, complete testing, everything is finished. At the end of it, like, we are going to give the report, like that, finishing the end, the final procedures is happening. At that time, just take the financial statements and just to do the analytical procedure once more. Like basically, chinna items, just see, compare current year with the previous year, compare with any information data or something, just do the analytical procedure and see, just compare with the current year with the previous year or compare with any industry data, whatever it is. Just to not compare or comparison, you can consideration is better. You use consideration. I will say you finished the entire auditing. Some evidence you got, some evidence you don't got. But at the end of the auditing, just use analytical procedure once more. For what? To assist the auditor for forming overall conclusion. That means entire audit. Now just cross-check whether everything is correct or not using analytical procedure. Just cross-check. How you will cross-check? Simply means that just simply take any item. Say for example, we need to identify loan. Loan amount in the financial statement is say 5 lakh is written. We have already checked the verification certificates, everything, but just check once more analytical procedure, but just check whether this is correct or not. Like many, you pick some random transactions and once more you just like cross-checking. For here, like 7 lakh, how will you check it? You know the interest amount is there. Interest amount in your books, the interest amount is say 50,000. And you know the percentage is say 10% is the interest rate. So 50,000 divided by 10 into 100, because how we got the 50,000 interest? 5 lakh into 10% is 50,000. So to check loan amount whether 5 lakh is correct and you know the interest amount and percentage, you do the reverse calculation, you will get 5 lakh. Okay, so 5 lakh correct. Okay, loan is correct. Similarly, many items you can do the analytical procedure at the end of auditing. Once more, just for cross-checking, like you can do it. You can design and perform the analytical procedure at the end of the auditing, just to assist the auditor in forming an overall conclusion as to whether financial statements are actually as per his understanding. You can use it for further audit procedure. Detailed substantive analytical will be used. Okay, but this is other than that. If you want, you can use it. Okay. Then what are the factors to be considered for substantive audit procedures? Substantive audit procedures factors. Substantive analytical, substantive audit procedures. What are the factors? Substantive audit is divided into two. Substantive analytical procedure and test of details. What are the factors to be considered for substantive audit procedures? Substantive analytical procedures, basically things like that. Take it like substantive analytical procedure itself. Okay. First thing, availability of data. For this comparison, you need good data. Previous year financial statements, how will you compare? You need data. If you need to, you are Zomato and you need to compare with Swiggy, you need data. Swiggy data, that's it. Then disaggregation, the amount of breakup available in a data. Breakup means, imagine you need to compare the marketing cost of, you are Zomato, you need to compare the marketing cost of Zomato with the Swiggy. The more breakup detailed information you receive of Swiggy, it will be that better. So disaggregation means the degree of disaggregation means the degree of breakup. If more breakup information you are getting, you can easily pinpoint, you can compare with that. Just a bulk outside amount, it's very tough. Then account type, source and predictability. Three things are very similar. That simply means that basically comparison is possible mostly for P&L items, income statement accounts. Why? Because P&L items are more predictable. If you have last 3 years P&L, you can basically predict the current year financial how it will be. Current last 3 years sales is at 10 lakh, 12 lakh, 14 lakh. So you know this year it will be 16 lakh or 17 lakh maximum. So like that you can predict P&L items, expense allam. Sometimes 5% 10% increase or 5 or 10% decrease, like that it will be. But balance sheet items, last year asset you know, but how will you predict current year asset? Sometimes they may buy a very big new asset, sometimes they will not buy. It's very hard to predict. So analytical procedures are more useful when the accounts are predictable, because here we are comparing the trend, considering the relationship comparison. Here you need this one, what? Predictability, madam. So account type, substantive analytical procedures are more useful for certain type of accounts that are predictable accounts, more predictable ones, like numerous transactions happening. Predictability is there, simple as that. Then nature of assertion. Substantive analytical procedures may be more effective in providing evidence about some assertion, like completeness and valuation, rather than rights and obligations. It simply means substantive analytical procedure, you are comparing two information. How will you get an evidence regarding rights and obligation? If you compare current year statement with the previous year statement, you will be getting to know whether all the transactions, last year sale was 10 lakh. When you compare it to the current year sale, it is showing us 9 lakh. So you will have a doubt. So what you will do? You will go and see whether all the sale has actually been incurred, whether the entry missed. So that way you can get an idea about the completeness. And amount also 10 lakh. So when you look at that, the amount will change. When you put the exact sale, missing sales, everything you put it, the new amount will come also, 12 lakh also. So you can get substantive analytical procedure, which you can get audit evidence regarding the completeness and valuation also, you can get audit evidence. But that is substantive audit evidence, analytical procedure will be more effective in these two. But it is least effective for rights and obligation. Comparing rights, how will you get the rights? Who owns the, you are comparing current year asset with the previous year asset. Okay, with this comparison, how can you identify the rights and obligations? Who own the asset or no? Not possible. It's maybe possible, but it is more effective. It's definitely it is possible. Like share certificate, share ownership certificate, comparison, etc. We can see that, but understand this is more effective for some assertions like completeness and valuation. If you want to check whether everything is entered, that is completeness assertion or amount valuation. In that case, this is better. Okay. Then, what are the techniques available as substantive analytical procedure? What are the different techniques available? First is trend analysis. You can compare the trend, current year trend with the previous year trend. If you know last 3 years data, gross profit trend, what is the trend happening in the gross profit? So trend analysis is one technique which you can for the last 5 years, sale has been increasing 10%, 10%, 10% every year. So current year we are predicting, okay, maximum 10 to 12% or around 8 to 12% sale you can predict. That is trend analysis. Comparing current data with the previous year balance or with the trend or 2 or more periods. Things are easy. Then ratio analysis. You can compare the ratio. Last year's ratio, current debt equity ratio with the current year ratio. See whether the relationship between them changed or not. That is ratio analysis for analyzing the asset and liability accounts as well as revenue and expense accounts. That is balance sheet and P&L. Then individual balance sheet account is difficult to predict. See, balance sheet accounts are difficult to this is very important. This sentence is important sentence. Individual balance sheet account is difficult to predict on its own, but its relationship to another account is more predictable. Means current year debtor with the previous year, if you compare current year debtor with the previous year debtor, you may not be able to identify the change or all these things. Like predicted, no. But when you compare, see, I'll draw it and show it, then only you will get the idea. Debtors. This is the sentence is important. Last year, previous year, the debtor was 10 lakh. And current year, the debtor is say 6 lakh or something. You cannot predict anything with the debtor. Current year, last year, 10 lakh. Sometimes this year increase or decrease. How can you predict it? No. Just by seeing the debtors, you cannot predict it. Like last 3 years of debtor, you cannot predict it correctly. But sales, everything, there is a pattern you can predict. So, just individual balance sheet item, any item, individual item in the balance sheet, you put asset or anything, you cannot predict. But when you see on its own, but relationship to another account is more predictable. See, trade receivable with the sales. This is less predictable. But if you compare previous year or debtors, sales also we take. Previous year, sales and because debtors comes from sales, right? Previous year sales 10 lakh or previous year sales 20 lakh, in that 10 lakh debtor. So if you get it like this, then now it is easy to predict. See, current year if your sale is 40 lakh, then you know this much. Previous year 20 lakh sale, 10 lakh debtor. So current year 40 lakh sale, 20 lakh debtor, you can predict like this. So here you are, just by comparing the individual balance sheet item debtor, individual balance sheet item, you are unable to predict. But when you consider the relationship between both these two and then compare, it is easy to predict. Okay, see. But the relationship to another account is often more predictable. Then reasonableness test, checking whether one item is reasonable or not. That is using analytical procedure to identify whether something is reasonable or not. How to do that? Unlike trend analysis, here we are not using any prior period thing. Normally analytical procedure we are using prior period thing, but here we are not using any prior period stuff, not using any prior period. So understand this, these tests are more applicable to income statement accounts or certain accrual accounts, and I will explain what it is. Reasonableness test. In your balance sheet, you saw loan, in your balance sheet, in your P&L, you saw interest expense on loan as say 50,000. Interest expense on loan as say 50,000. Is reasonable? You need to check. That is, you need to check the reasonableness of this. Is it actually reasonable? Like interest expense, how to check that? Just take a paper and calculator. Just you from the financial statement, the loan amount will be there, right? So loan amount into interest rate into the number of days, all these things, you will get this amount, right? And when you did the calculation, the amount came to say 45,000. So, or say it actually came to 50,000 itself. So now the reasonableness test is over, it is reasonable. For example, the amount is 30,000. So this amount is not reasonable, some 20,000 is fake. That is this calculation, the consideration of relationship used for the calculation, that is reasonableness test. You can compare this occupancy rate. See, this one is a perfect example. Occupancy rate. In your financial statements, in your balance sheet, the P&L, the rent amount is say 20 lakh is there. Is it reasonable? You need to check. How to check it? Just ask the company. Okay, how many rooms do you have? They say number of rooms. They'll say, okay, sir, number of rooms is 10 rooms we have. Okay, what is occupancy rate? That is on an average per day. How many rooms will be occupied? Occupancy rate. They're saying on an average 50% will be occupied. That is basically 5 rooms. 10 into 50%. Okay. Then what is a room charge per day? Rupee per day. Per day, you will get an amount. Into 365 when you do, somewhere the amount should be near to 20 lakh. If it is near to 20 lakh, somewhere around 19 lakh to 21 lakh, you can say this 20 lakh is reasonable. Another reasonable, it's having some problem, error or fraud or mistake, you need to do deep checking. Okay, this is reasonableness test. Reasonable? Okay. Then structural modeling. This basically you are creating a modeling tool with the previous year data, and that modeling tool will predict the current accounting balances. Then this ones are very easy. Then reliability of data, that is for comparing analytical procedure. For doing this analytical procedure, you need data, and that data should be reliable. Then only reliable data, how will you get good result? You will not get a good result, right? So the reliability of data is influenced by the source and nature from where it is actually obtained. Comparison. You are Swiggy, you need Zomato's financial statements. From where are you getting this? If you are getting this from a good, decent website or like Government of India's website, okay, it's a good source. But if you are getting it from some PDF fake thing, it's not a good source. Like that, it's easy. Comparability should be there, everything. All these things are easy, nothing complicated is there. Evaluation of whether the expectations, accuracy with the expectations, let's say head points is enough. It's enough, done. Then now let's, it's not time to stop. We need to look at one more thing. Okay, where is the audit sampling? Yeah, sampling was missing. Sampling, I'll say sampling, and we are not going to waste too much time because other topics are also there. Sampling, quick revision. So understand this. Sampling, okay, so audit sampling. Application of audit procedure for less than 100% of the population is called sampling. You know that, right? 1000 bills in the 10 check printer, that is sampling. Okay. Then sampling, what are the characteristics? Appropriateness, completeness, reliable. Appropriateness, completeness, reliable. You know that, sampling. Then what are the approaches to sampling? I'll put the toughest area. Approaches to sampling. That is statistical sampling and non-statistical sampling. What is statistical sampling? Random selection of sampling units. Okay. Then probability theory is used to evaluate the sampling result. Sample chosen by applying certain criteria like statistical or mathematical methods using some Excel formula or some random number table. Here, what are you using? Statistical sampling means 1,000 invoices are here. You are not just closing your eyes and picking things. No. That is one method of sampling. But statistical sampling means you are using some mathematical tools, some equations, some techniques, and at the which you are picking the sample. This is a sample total bill. This is a sample you are picking with this technique, with this tool you are doing it. Mathematical technique. It's not like completely closing eyes and picking. No. That is what we call statistically you are doing the sampling. Statistically, mathematically you are doing the sampling. Okay. You can use some Excel formula or random number table. In class we will do the calculation and see. Okay, leave that. Then what are the advantages? The amount of testing does not increase in proportion to the size, and advantage is very easy. Just read it, you will get. Then what is non-statistical sampling? Non-statistical. Non-statistical means any sampling which do not have these kinds of features, simply closing this and picking, which do not have these kinds of features like statistical features, it is called a non-statistical sampling. Statistical means you are using some mathematical data, the calculations, a random number table. Idella use panni you are selecting the sample. If you are not using anything like that, then it is not statistical. Okay. It is determined by the personal experience of the auditor. Risk of personal bias will be there. Sample to operate, all these things will be there. Okay. Then advantages is done. Then stratification and value weighted selection. Many things are there in the chapter, but the main areas we will focus. Stratification and value weighted selection. This is basically how you do the sampling. Stratification, I'll say, if you get these kinds of 1,000 bills, the concept I'm giving you, read from the book, you will get it. Okay. Stratification means this is a method of sampling. It's not like a method, it's a way of doing it. Stratification. First you will divide the entire population. See, this is the amount of bills. Imagine 10 bills, not 10, it will be, say, 1 lakh bills are there, or 10,000 bills are there. In this 10,000 bills, understand with me, you have two options. Imagine you have 10 bills with you. 10 bills means 10,000. I keep in mind 10,000. Okay, you have 10 bills with you. I asked you to pick a sample. What will you do? Either you can close your eyes and pick some, not close your eyes or whatever, just you can 10,000 bills, you can just pick something which you like. In the 10,000 bills, amount of bills will be different. Some bills will be 100 rupees, some bills will be 10,000 rupees. In that range, many amounts, invoices will be there. Two options are there. First option I told you. You can pick any 10 from that, whichever you like. Not 10, like if I'm 10 from 10,000 bills, I'm asking you to pick 300 bills. And you are picking randomly. Another way is that, so sometimes some 100 rupee, 200 rupee, all these things will come. But if you divide the population properly, in the 10,000 bills, first all this, we are dividing the population. If we see, here we have 10 bills. We are dividing the population into first 0 to 500 rupee bills. So this bill, invoice number 2, like 300 rupees, all these things will come. Then 500 to 1,000 like that. If you divided the bill into proper categories, and understand, 1,000 plus peri amount, material amount, no material like important big amount, because this is a smaller amount. 1,000 plus bill is a bigger amount. So when you are picking a sample of 10 from this 10 bills, more sample varanam, because there is a chance of mistake more. Who is going to put a mistake in a 500 like below 500 rupee? No. So chance of misstatement is more in this thing. So when you divide the population like this, and from this you will pick a sample. From this sometimes you will pick 3 samples. Or imagine the 30 things are there, we will pick more sample. Not sample. So we will divide the population like this, and from those population we will pick samples. So what are we getting? We will get a representation of the entire population. That is in the range of items, like in the 1,000, when we pick a sample, 1,000 or male item, I will get some sample will be from that. And 500 to 1,000 gap, some sample will be from that. And 0 to 500 gap also have some sample. So if I'm picking 300 samples from 10,000 bills, my sample size, these 300 bills contains bills in all these ranges. All ranges bills. But if I don't do like this, strata, if I don't split and don't take sample, like if I took the normally sometimes the 300 bills may be around like 200 bills from that may be coming into this category or this category, any category. Sometimes some 500 to 1000 range bills, sometimes I will not be inside that. In sampling, there is one policy. Always, whenever you are picking sample, try to make your sample a representation of the entire population. We used to say that, right? Your sample should be representative of the entire population. So because of that reason, we need to divide our sample into this ways. Divide our population. This is what we call population. Entire thing. Divide the population into stratas, and that is called stratum. And from that, when you're picking, called strata. This is stratification. Then what is value weighted selection? Value weighted selection means when performing test of details. It is similar to the stratification, but in a different way. Imagine, see, here you got debtors like this. Say, this is the data that you are getting. You are going to do audit debtors. Rama, Rahul, Suma, like this. From this, if you see, just one fun thing is there. In the 10 lakh, 30, in the 60.6 lakhs, majority of the debtor, like 90% of the 60.6 lakh is from these 4 debtors, because these are people having bigger amount. Amount, 80,000 to 2 lakh, 1.5. About 10 lakh amount. So we can say that what we will do is we will sort these debtors now. Debtors name and order sort like highest amount 18 lakh this guy. So that way when we sort them, like if you are finding it complicated, just pause it and just read it and understand and then move on. Okay. That is why I'm saying always a lecture one time you should have watched lecture or studies, then only please watch marathon, else you will not get it, because we are going real quick. Okay, everyone is good. That is marathon, right? Okay, then Ravi, we divide it into this way, and the 90% of this comes from 90% of the population. See, this is 56 lakh. 56 lakh is more than 90% of this amount. So basically, these are the bigger chunk people. So these people need to be given more value. When I'm picking a sample from 10,000, in the 10,000 if I'm picking a sample, then I need to get more samples from these peoples, because amount sample I don't need it. It's like an irrelevant thing, but these are relevant bigger things. So I need sample sizes. My sample should be more from this. That is why I'll sort the important things like this first. Then, like this is a value weighted stuff. Then I'll pick more sample. Then once I sort it like this, then I'll start picking sample. So more sample I'll take from this. Imagine my sample is I'm picking 3 samples. 2 I'll pick from here and 1 I'll pick from this category. Okay, got it. So my population will be representative of everything. At the same time, more focus will be given on the more weighted stuff also. Okay, rather than just simply taking. This is stratification versus value weighted selection. Then ways of stratification is there. This is like you don't have like too much time. Either through monetary value where you can get identified when performing test of details, the population stratified by monetary value, or you can do it through the aging. Just I'll pause it. You can, if you want, you can take it. This one is the exact same like we discussed like above. When performing test of detail, population stratified by monetary value. This one is exactly like we said things above. That is, you are dividing the entire population. Same population, you are dividing in the base of monetary value, and you are picking sample from this. Second thing is population stratified based on particular characteristics, not monetary. Monetary means money. Okay, we are dividing it on the base of characteristics. What is my characteristics? I'm 6 feet tall, I'm 9.95 kg weight, I'm the normal brown skin, I have a beard, I have this much hair. That is my characteristics. What is your characteristics? You will have. So similarly, you are dividing sample. In this case, you are dividing sample based on monetary value, money. See, money, 0 to 100, 500, all this. Here you are dividing the sample based on, this is ways of stratification. Dividing the sample based on characteristics. Similar name amount you are given. Then debtors and aging will be given. That is how old the debtors are with us. So in the debtor, so what we will do is we will divide it in the base of aging. See here characteristic. Here it was money. Here it is characteristics. Aging we will divide, and bigger age category we will pick more sample. More sample or less sample. Sample should be representative of entire population. but a bit more will should be from this, because this is important area. Okay, you got it? Okay, so now let's move to, then other things are there which I hope you know, that tolerable rate of deviation, misstatement, all these things. A tolerable rate of deviation sampling means what is the amount of deviation that you can tolerate from when you're checking internal controls. Tolerable rate of misstatement means what is the amount of misstatement which you can tolerate when you're doing the checking. Okay. Okay, then third chapter, fourth chapter is also, we have almost done it. Quickly we need to move. Then what is an automated environment, everything. Now we'll see fifth chapter, we'll do it at the end, financial statements. Now let's move on to be with me, don't go. Don't go, Mandipindi. Where is it? Chapter number 6, audit documentation, simple chapter, and I am setting a priority examination, A category first chapter, this one. Like 5 pages. At least minimum 5 marks you will get it. Don't lose it. Okay. Audit documentation. Take it. We'll finish it. 5 minutes we'll finish it. Chapter. Nothing is there in this chapter, but still you will have to study it. Okay. Why? I'll say. Chapter number 6, essay 230, that is audit documentation. What is it? Audit documentation means whatever audit work you are doing, this is an easy chapter. I know it will be easy for everyone. Just to do 10 minutes revision. Think like that. Okay, what is audit documentation? Whatever work you are doing in your auditing. You have a CA, and CA, below CA many articles will be there. Your team will be going to do the auditing. You know, doing whatever work each and every article is doing, every CA, whatever is doing, anything. Any work you are doing, any audit procedures you did, audit evidences you got, any judgments you made, and why you selected that procedure over this procedure, why you selected this sampling over that sampling, that method, why you selected this over that. That is professional judgment, right? All this thing you need to write it in a piece of paper. That is documentation. It happens now. It happens on soft copy offline, online, like in the laptop or all this thing, Excel everywhere, but Excel or Word or somewhere. But normally, earlier it was paper. Let's focus on paper for that you will get an idea easy. It will be easy to study. Okay. Definition of audit documentation. It simply means that it refers to a record of audit procedures performed, audit evidences obtained, and conclusions the auditor reached. Whatever audit procedures you performed, you will write about that in the document. You will document that. History or book madri, you will keep it. Then there is audit procedures performed. Then audit evidences obtained. And then audit evidences you received. What all audit evidences you received, like external confirmation, all these things you will obtain. Then what are the conclusions you reached? All these things, why, how you reach that, why you reached that, like all those things will be put in the documentation. Okay, objective is simple. Then nature of audit documentation, it provides a basis for conclusion. Then that the audit was planned and performed as per auditing. That is because once you finish the auditing, sometimes someone will come and question you, will ask you, bro, not bro means to the CA, will come and ask you, how could you give an unmodified opinion in this case? How could you conclude an unmodified opinion? Here the modified opinion should have been perfect, right? Because this case is there. When they ask you like this after over 6 months from the auditing date, you would have forgotten the steps, everything. If you have not documented what you've done, after 6 months of auditing, you would have forgotten what you did in that company. But some issue may come. They'll ask, why did you give an unmodified opinion? It had a material misstatement. It's a modified opinion, right? You may not have an answer. You may not have an answer on that. You have already forgot. So, but if you have an audit documentation, you can open. Bro, see, these are the procedures that I have done. Now, nobody can say that I have not done the auditing properly. Every procedure, every audit evidence, if you want doubt, you check it. Like that, I can say to you. So, it provides a basis for conclusion. How I reached my conclusion. How I reached my overall objectives. Overall objectives, what is our overall objectives? So to reach how the auditor reached the conclusion, see whether financial statements are free from material misstatements and report, right? Then whether evidence was planned and performed in auditing. If someone comes and says tomorrow your audit was not planned, bro, so this is my plan, entire thing is documented, audit strategy, audit plan, everything. Okay, then what is the purpose of audit documentation? What is the purpose of audit documentation? First, in assisting the engagement team to plan and perform the audit, PP, plan and perform the audit. Because if you have it, document everything, it will assist them. Then DSP, direct and supervise audit work. Then accounting, accountable, making the people accountable for their work. Then retaining a record of continuous matters for future auditing. For future auditing, if you need anything for future auditing, you can retain a record of those matters. Then quality control review, enabling the conduct of quality control review, you can do it. Then EXI, external inspections, if you want anything, because quality control reviews, if you don't have the document, what will happen? If you don't have the document, what will happen? You cannot, how can someone go and do the quality control review? It's not possible for them. Everything should be documented. Then only they can know what is the quality of your auditing that you have done, right? Then enabling the conduct of external inspections. External inspections and any conduct. Then the form, content and extent of audit documentation. Form, content and extent of audit documentation. That is what are things coming under audit documentation. When you are making an audit documentation, just understand one thing. You need to make it in a way that an experienced chartered accountant, auditor, having no previous connection with the audit to understand these things. What are the audit procedures you did? What is the result of audit procedures you got? Audit evidences you obtained? Significant matters that you raised during the auditing? What are the important matters? All this. And the game is experienced chartered accountant, experienced auditor. We don't need to prepare an audit documentation in a way that a normal person will understand. No. Or experienced auditor only need to understand that. Okay, only experienced auditor need to understand that. Others problem. Okay. So basically, some accounting professional need to understand that. Like a normal, not a normal layman. Normal layman will not understand what are the procedures, anything. Who will understand? Only CA can understand. Okay. Then all these things are easy. Then form, content and external document. Just the points, it's easy. Then audit file, timely preparation. Whenever you are doing the auditing, along with that itself, you need to prepare the audit documentation and move. Whenever you are doing the auditing, along with that itself, you need to prepare the documentation and move on. Don't think of like one day full work finish pannite next 1 week one weekend I'll sit and no. Whenever you're doing the work, that moment or after 10 minutes or in the break itself, you write down what are the procedures you did. Then documentation prepared after the audit work. After the audit work prepared is likely to be less accurate because you would have forgotten many things. Then audit file. Audit file means, this is for hypothetical example, just understand. Think. Some articles, imagine one CA, 3, 4, 5 articles are there. Each article will have his own documentation, his own file. So once the auditing is done, what the auditor will do? I am talking about these two processes together, okay? What the auditor will do is, auditor will collect the audit documentation from everyone. Audit, like audit documentation. Then he will give it to some article, or he itself will, just think, he itself will. What he will do, he will look at their own each one, every, just imagine all the articles, our documentation is then in single paper. 5 paper is there, 5 article is there. Just think. Auditor will go through what are the relevant things from that. Okay, this is the cut. Relevant things are add. He will make it in a better format. They would have just scribbled and wrote it. He will make it in a better format. Now it happens in computer, just understand. He will make the things in a better format. Compile these 5 documentations together and like imagine like stapling it. Like unwanted superseded documents remove like rough papers he'll remove, correct things he'll correct, like make things, staple it, and he will put it in a file. This is what we call audit file. In the file with the entire documentation of that one single audit. I am the auditing Baiju. Okay, Baiju's full audit work. Baiju in audit, whatever the audit procedures, audit evidences, audit conclusions, judgments, all these things, I will put it in this file. Audit documentation related to Baiju. So all the separate documents with the articles, I'll compile it together. Their own documentation, their own notebook, I'll compile together and I'll make it a separate file. And this process is what we call like audit documentation. Compile one big process, one big file, one big that audit. Okay, it will have a heading Baiju. Baiju means when you open the Baiju, and this document, this file will be kept in chartered accountant's office. And this file, when you open, okay, Byju audit full procedures, correct order, everything will be there. All the things will be there itself. Okay. That is this one. So that process of assembling, compiling, this is what we call assembly of final audit file. And the finishing product like this is what we call final audit file. It is defined as one or more folders or other storage media in physical electronic form containing the records that comprises the audit documentation for a specific engagement. All the audit procedures, all the audit evidences collected, reason for all the professional judgments, all these things will be included in that. Okay, this one. Then assembly of the final audit file, same process I told you, and it should be done within 60 days. 60 days after the date of audit report. I finished the auditing today. I'm a CI, finished the auditing today. In the date later, the audit report signed. From this date, in the next 60 days, I need to prepare finishing the audit. Like that day, I'll have a lot of my single paper audit documentation. Compilation process, delete better format. That process should be finished in 60 days. And once the process is finished and once it becomes a final audit file, then you should not make any changes in that. In the time when you're making the documentations into this final file, you can make any small changes if you want. Like changes means this, any unwanted information is there, you can delete it, then sorting, collecting, ordering, ascending order, all these things. But once it is a final audit file, don't change it. You cannot change anything. And that is a property of the auditor. And SQC1 says that you should retain that for the next 7 years. 60 days in the audit report date. From there, 60 days, you need to finish the audit file. And once it is finished for the next 7 years from the date of audit report, you should keep it in your office. If it's an electronic media, in your folder, office, cupboard should be there. 7 years minimum from the date of that audit report. Minimum 7 years, you need to retain that. Then all these things are simple. Then audit documentation memorandum, it's basically a summary of the significant matters, and you will be keeping it along with the audit documentation. Like audit documentation, we'll have a summary book, like a summary book where a significant matter, audit letter of all the important significant matters only addressed, and the documentations relating to that will also be like cross-referenced. Like that you will keep it. That is audit documentation summary. Simple, everyone knows that. So you just read it. Ownership of the document is it's the property of the auditor. He may at his discretion, audit discretion, he may at his discretion make portions or extracts with okay, so 60 chapter is also done. So next is SA 560 subsequent events. Okay, and the standard is basically very easy standard, but the thing is it is written in a way that it may make you complicated, but I have made it in this chart format with the ICA language itself, so it will be easy for you. And if you want to access this file, you can go to the Telegram channel link that is mentioned in the description. So there this file is there. I would highly suggest studying SA 560 from this file would be beneficial rather than studying from the book, so that you will get a structure of this. So when the question comes, you can easily remember. Then just listen to this completely, then you will understand why I am saying that like that. Okay. So first is, see, SA 560 is called the subsequent events occurring between the subsequent events, basically after the date of financial statements. Any event occur after the date of financial statement. But even though the standard name is subsequent event, basically two things are there. Events, that is events, and facts. These are basically two. Don't consider this as one. That is a difference. These are two. So when we talk about events, it's divided into two: events occurring between the date of financial statement and date of audit report. That is, this is date of financial statement, date of audit report. Events occurring between this. That is again events occurring between this. Okay, events. And then after the date of audit report, events are not mattered. After the date of audit report, only facts which become known to the auditor. See, so as per SA 560, events that occur between this date only is considered, and facts which has already occurred. Facts means something that has already occurred, but auditor is hearing that only after this date. That is facts which become known to the auditor after the date of audit report, but before the date of issue of financial statement. That is case number 1. Or after the date of issue of financial statement. That is case number 2. So this is the thing that you have to understand. Okay, then when you look at the audit procedures, you will understand what is the difference between both of this. This one thing you have to keep in mind. Okay, events after this we are not considering anything. So only facts after this we are considering, after this date. After date of audit report, events are not considered, facts are considered. Okay. Then types of subsequent events. Two types of subsequent events are there. Case number one, that is condition already existed at the date of financial statements. At the date of financial statement, the condition already existed. See what it is. For example, a provision for legal case. This legal case, a case against the company. Let's take a case like there is a case against Coca-Cola. They're saying that Coca-Cola, they have some aspartame sweetener, some issues happening. So such kind of a legal case is against Coca-Cola. So that case is existing at the date of financial statement. 31st March, that case is there. So company already, that condition is there. Case is existing as on 31st March. That case may be filed before 31st March any day. So company knows that the case is there. And because company expects that company may lose the case, company put a provision of 20,000 on 31st March. So if they fail, like a penalty or something they have to pay. So they put a provision of 20,000. But one event happened. What was the event? We are talking about subsequent event here. Event. Okay. So what happened? See, but that case got settled for 17,000. You put provision of 20,000, but it got settled for 17,000 after the date of financial statement, but before the date of audit report. That is, at this period, you put the provision at this date, but it got settled at this date. Case judgment may came or outside the court settled. So this is an event that occurred between this time. And her condition was existing. That is, case was already there on the date of financial statement. So it's called an adjusting event. So for that, what you need to do? It's an adjusting event. Hence, ask the management to remove the 20,000 provision and put 17,000 as provision. Because audit report date is not yet reached. So this is first thing we have to do. But one more thing, guys, understand, this is auditing, not accounting. Okay, this is auditing subject. So here you don't have to think too much about the accounting of subsequent events. Please think about how the audit procedure is auditing only. Don't think about the calculations, all these things. Okay, I'm just giving this as an example. So many people think about their accounting standard and then they'll get complicated here. Don't do that. It's just audit procedures theory. Focus like that. And if the condition was not existing at the date of financial statement, that is, a fire occurred after the date of financial statement. Fire, nobody knows on 31st March that fire will occur. So no provision, nothing was put. Suddenly a fire occurred on like 5th April, something. See, date of financial statement or report, fire occurred. In that case, what to do? No condition was existing. So hence only a disclosure is needed. You don't have to put any provision like adjustment, anything in the balance sheet. Just a disclosure is needed. And what is auditor's duty? This disclosure, these things are done by the management. Our duty is just to see whether management has done that or not. We are just checkers. It's the management audit duty. Okay. Then SA 560 is just an auditing standard, not an accounting standard. So you don't have to overthink about the accounting treatment. Here just focus on how the auditor will look at the auditing theory. Okay. Then what are the objectives of auditor? First, obtain sufficient appropriate audit evidence whether all the subsequent events requiring adjustments, that is this one, adjusting event, this requiring adjustments are done properly, events. Then about facts, respond appropriately to the facts that are known to the auditor after the date of audit report. So that's it. Then audit procedure for events that occurred between date of financial statement and date of audit report. Events, that is audit procedure for this part. Yeah, that is what we are talking now. Audit procedure for events that occurred between, see, we are talking about events only, not about facts. That is why I draw this chart. What is audit procedure? Perform audit, first thing what you have to do, perform the procedure to obtain audit evidence that all the events are actually identified. All the events that occurred after the date of financial statement has been identified. Events occurring with date of financial statement that require adjustment has been identified. You have to do something to see that all those kind of events, first management has identified those events and you are also identified that management has identified the event. And you also have to identify what are the things that occurred between this date. Then no need to do any additional audit procedure on matters where all the audit procedure was satisfactory. For example, in the case of provision, that legal case, you have already done enough audit procedure during the normal auditing thing for the legal case. And this case settlement happened after the date of financial statement. So in that case, you don't need extra audit procedure because you have already done checking of that legal case, all these things before. So after the provision, you just don't have to do any extra procedure because you have already done that. Okay. Then this one is easy. In determining the nature, timing and extent of audit procedure, auditor has to consider the risk assessment. That is what all audit procedure. Here we talked about audit procedure, right? To perform what in determining the nature, timing and extent of this audit procedure. Which audit procedure to do? In determining that and how much to do, how deep to check, all these things. auditor has to consider risk assessment, and this risk assessment includes, that is in the audit procedure, to decide this audit procedure, you have to consider the auditor's risk assessment. First we will assess the risk, then only we will do the procedure. Remember SA 315, we assess the risk first, we identify the risk, assess the risk, then we do the audit procedure as per SA 330. Similarly like that, it's not the procedure same. Here we need to see audit procedure, first auditor consider the risk assessment. That risk assessment includes obtaining an understanding of management or a procedure to ensure subsequent events are identified. Management will have their own procedure to ensure this. So we have to see whether you have to obtain an understanding of those procedures. Management and a procedure will do to identify the events. Management will have their own procedure. You have to identify, obtain an understanding of what is management's procedure. Then inquire to the management, ask whether any subsequent events has occurred. Just go and talk to management. Bro, any subsequent event occurred? And have you identified all the event? Like that. Then read the minutes of meetings between owner and TCWG held after the date of financial statement and inquire about the matters discussed in meeting for which minutes of meetings are not available. Simple that. You go talk to the manager, you just read the normal minutes of meetings held after the date of financial statement. 31st March meeting order minutes you go and read. You will get an idea. And like if there was any subsequent event, they will discuss about that in the meeting, right? So minutes you will get the idea. Second thing, go and ask them, bro, is there anything that is not included in the minutes that you have already talked in the meeting, but you're not included in the minutes? If something like that is there, please tell to me. Conduct an inquiry about whether matters discussed in the meeting for which minutes are not available. You discuss that, but minutes illa. And the matter you will go and ask them. Then read entities' latest subsequent interim financial statement. Interim, like first 3 months, quarterly financial statements, you go and read it. Okay. This is the auditor's risk assessment, and it includes this. In determining the nature, timing, and audit procedure, auditor will first consider the risk assessment. It includes these 4 points. Okay. Then what is the auditor's responsibility for facts? This is the only a bit tough area in this standard, because this essay requires this kind of structured learning, else it will be very hard for you to remember this essay. The process, if you know correctly, you will write, because else what will happen? If a question comes, first you have to identify other subsequent event or fact. Then you have to think which of audit procedure to write all these things. So what will happen if you directly learn from the book where just theory is written? Any book, what will happen? You will get confused. The fact or the event, which procedure, you will get confused like that. But here in this, if you are following this chart, you will not get confused. That is why I asked you, join the Telegram channel, take this kind of notes. And other notes also I have put there. Some different questions from different chapters I have constructed as charts. Easy, and in my charts, what I do is I only use ICS language. Here also I have used ICS language. Only thing is I have used mnemonics like this. MGT, manager, you know that, right? Okay. What are auditors' responsibility for facts? Facts means something that already occurred. But auditor is hearing that only after the date of audit report. Management has already done a fraud. But auditor, he is only hearing about that after he signed and gave the audit report. That is fact. Event means some event that occurred. Event and fact is different. Fact means something already occurred here, after that. Event means something that occurred. A natural calamity occurred, a fire occurred that date. Okay. Auditor's responsibility relating to fact. Fact means husband was cheating on a wife, or wife was cheating on a husband, or girlfriend, boyfriend cheating. And the husband got to know about this only after cheating happened on 1st April. Just imagine. Cheating happened on any day, but husband is knowing about that after only like 1 month or 2 months, 3 months. That is fact. That already happened, he is knowing. Then event means something that happened. For example, a fire occurred. That is what we call event. Okay, you need to identify the difference between both. Just giving the easy example so you'll understand. Don't blame me for that. Okay. Okay. Responsibility for facts. What should auditor do? That is, what is his audit responsibility procedure? All these things he need to do regarding fact. Regarding event, this is audit procedure regarding event, like this one. This is audit procedure regarding fact. 2 audit procedures are there. One, fact that auditor came to know between this period, that is date of issue of financial statements, then second is after the date of issue of financial statements. This means date at which like the accounting year closes. Date of audit report, the date at which auditor signs the report. Date of issue of financial statements. Normally, guys, understand one thing. Normally, sometimes this dates, 2 dates will be like very close. But I'm just putting it like this because you'll get the idea. Like we are separated like this. Okay. Date of issue of financial statement means you signed the audit report and gave, and then they are issuing the financial statements to the public. Normally, these two dates come very close. Okay. But since ICA has asked procedures like this, that is why I splitted the data exactly in a different way. Okay. What is auditor's responsibility for facts? First, all those facts which become known to the auditor after the date of audit report before issuing financial statement. That is this period. This period. Here some, this you forget. This is something example that I showed students in the class. Okay. Events you ignore. This events you completely ignore. Okay. This we are talking about first about this fact here, and then about this thing that is here. See, facts. First, let's talk about facts which become known to the auditor after date of audit report but before the date of issue of financial statements. Okay. First, for example, a very serious fraud of management, the auditor came to know only after audit report date, before the date of issue of financial statement. What to do? First, auditor has no obligation to perform any audit procedure after the date of audit report. Audit report once signed, he don't have any obligation to perform any audit procedure. But if in the fact he would have known before the date of audit report, he would have knew. If he would have knew that before he signed this, that is one day before, if he would have knew this. Normally, after once auditor signs audit report, he don't have responsibility to perform any audit procedure extra. But if in the fact, if he would have knew before this date, audit report signed pandradhukku munnadi, if he knew this fact, then sometimes he would have, then if he would have knew this fact before, then he would have amended the audit report. Then in that case, the munnadi therinja, sometimes he would have amended the audit report because that is a very big fact. Some very big fraud or something. So if he knew this before, he would have changed the audit report. But since it is known after, he is unable to do. But if the munnadi therinjirundha, he would have changed, he would have amended the audit report. If it is that kind of a very big fact, very serious fact, and amended the date, he would have amended the audit report, then what should he do? Then he should go and discuss this matter with the management and TCWJ. Go and tell them, bro, what is this thing? I heard about this thing. What is it correct or not? Go and discuss it with the TCWJ management. Then determine whether financial statement need amendment. Is it some serious amount or disclosure, some serious thing? So whether financial statement needs amendment, because already auditor has audited and signed, and discuss, bro, is it something serious? In my opinion, financial statement may need amendment. You can say like that. You can discuss with them. Then inquire how management plan to address this issue. You tell them, bro, I think financial statement need amendment. So how are you planning to address this issue? Like that, these three things you need to do. Then two options is there. If management amends the financial statement, that is, they changes the financial statement, or amount of fraud, so they are planning to amend the financial statement. They are planning to change this amount. In that case, what should auditor do? Carry out the necessary audit procedure. Extend the audit procedure to the date of new audit report. Necessary audit procedure, he will to carry out that and extend the date of audit procedure to the new date of audit report. That is, here, this is the old date, normal date of audit report. So now he came to know about some fact on this date. So he is discussing with the manager and all these things. And sometimes if management is amending the financial statement, he may issue a new audit report at this date. A new audit report sometimes he will issue based on the amended financial statement. So he need to perform audit procedure for these period. Okay. Extend audit procedure to the new date. Provide a new audit report on the amended financial statement. Okay. Then, if management does not amend the financial statement, our management is saying, no, it's not a serious issue, auditor. We are not going to amend the financial statement. We are not going to change it. If they are saying like that, first, if audit report not yet given to the entity, that is, you have signed audit report, but you have not given it. Adukku munnadi you knew about this issue. If audit report is not given yet, you have already signed, but you have not given it yet. In that case, modify the audit opinion as per just SS 705. Audit report la change pannunga. Modify audit report as per SS 705. Give the modified opinion. If audit report is already given, you signed and you already gave it to them. Date of audit report finished, you signed the next day, you gave it to them also. Gave it to the management. In that case, tell the management, notify the management not to issue the financial statement to the third party without amendment. Tell the manager, bro, this is something serious. Please don't, I have given you the audit report. That was my mistake. Please don't give it to the third parties without changing it, without the amendment. And if management has already given it to the third party, management, oh, I have given it. Management is saying like that. In that case, take appropriate action to seek to prevent reliance on audit report. You have to take appropriate action so that the third parties will not trust the audit report. They will not rely on the audit report blindly because some serious fact is there and he has not put about that fact in the audit report. So you have to take action accordingly. So then one thing. Okay. Then another thing is that this one point is an important thing. This is in case where the management amended the financial statements. I told you these three procedures you need to do. Then this is a special case. That is, the period is there, right? Date of audit report. That is, if auditor don't want to perform any audit procedure on everything that occurred between date of old audit report and new audit report. That is, this is the date of normal audit report. Auditor came to know about a fact on this date. So management amended the financial statements on this date and he is issuing the new audit report on this date. Just imagine. So in this period, some events happened, right? Some would have happened. So normally we consider about this event. So in this period also something would have happened. So auditor actually, normally he need to perform audit procedure only on those facts which he came to know. Normally if you want to do that only, like where events he does not want to mind. He only want to do audit procedure on those fact only. That's fact which we came to know on this period. If it is like that, if he want to do audit procedure only on that fact, where events on the date level, where events he is ignoring, in that case, first he have to see whether law and regulation permit, law, regulation and financial reporting framework permit management to see management restrict amendment. That is whether law, financial reporting framework allow management to restrict the amendment only to those fact, those event, those fact, those subsequent events, those fact. Here we are talking about fact, right? So understand this. If he simple as that. If he want to perform audit procedure only on those fact, then first see whether as per law management can also do that. Management can restrict their amendment only to that fact. That is, their other facts also there, some other small facts may be there, but they are only amending the financial statement for this one fact only. Other facts they are also ignoring. If law permits management to do so, auditor can also do so. That is, if management and the water fact amend, then auditor has to perform audit procedure only on that fact. If law and regulation permits management to amend the financial statement only for that one fact, where fact on that one fact, then auditor can also do the audit procedure only for that one fact. If law and regulation is not permitting like that, then auditor is also not permitted to do like that. See, then if law, regulation, financial reporting framework allow management to restrict amendment only to that one subsequent event, that is one subsequent that fact, then auditor can also restrict his audit procedure only to that one event, that one fraud, that one thing. Okay, he don't need to perform audit procedure on all the events that happened between those dates. That is, in the under date other events he can completely ignore. He just need to, if management is amending only that one fact, then auditor can also do audit procedure only for that one fact. Okay, where are the frauds, where are the facts in the, don't have to, management is not amending that. So basically you don't also have to amend something like this, unless it's not serious. Okay. So in this case, if this is a special case, in this case, auditor has two options. What are the two options? First, amend the audit report and put an additional date. That is, old audit report. He is not issuing any new audit report. He is just editing that audit report, and that is amending that audit report and issuing the same audit report itself. He amended the audit report. That is all the same audit report itself. He will add something. Okay, amend the audit report and put an additional date onto that. So now two dates will be there. Date of old audit report, date of new audit report. So old audit report itself, he will make the changes and put an additional date. That is, this is a new audit rate. So now we will have two dates will be there. Old audit reported, new audit reported. That is called double dating. Like two girls say one time will date panta, two boys say one time will date panta. Okay. So date of old audit report, date of new audit report. It indicates that audit procedure is restricted only to those one subsequent event. Then that is first option. Second option is that he is planning to issue a new audit report itself. Old audit report amending and then I'm going to issue a new audit report. In that case, issue a new audit report and put an emphasis of matter paragraph or other matter paragraph and state what the audit procedure is done only to that one subsequent event. Here we told you, like, we are only doing audit procedure for that one subsequent event. So issue a new audit report and put an emphasis of matter paragraph stating that you have done audit procedure only for that one audit report, that one event. Okay. And now you may not be getting the flow properly. I know that. Because how much ever I tell you, you will not get the flow properly. Only thing, take this chart, sit for 30 minutes in your room, read and visualize it in the process. Okay, if this comes, this is. If this comes, this is like that, like that. I'm just explaining the meaning. So this one chart, this is a chart thing. You need the paper in hand or at least a PDF in hand. Then only you can get the connection right. Okay, so please understand that. Even if you ask me blindly, if I cannot close the eyes and say all these things directly. No, I don't memorize auditing. I understand it and teach to you. I don't memorize and just come and just blindly say and go. No, I don't do that. That is not how it works. Just think about the situation, because just imagine two people I've seen, like two types of people in CA. If you ask some students, bro, what is the journal entry for sales? Or what is the journal entry for bills discounted? Like bills discounted, like all those complex entries that you are asking. Bills receivable discount, something. So some people will immediately say it in 1 second without even thinking. They'll say. Those people are the rectification memorized people. They may not be thinking about how, okay, bills discount, you are giving this, debit what comes in, all these things. So you are like that, you need to think about the journal entry and say. Blindly saying it out doesn't mean you are smart. It's basically like you have memorized it. I've seen a lot of people who don't know how the accounting principles, all these things. What they do is, if you ask them the cash sales entry, they'll immediately say it. But 1 second pause is needed. Just need to think, okay, sales, okay. That is the real understanding people. Similarly, auditing, I understand stuff. I don't memorize all these things directly and keep it in my head. No, I know all the procedure. If you ask me something, I just 1 second, I'll think, okay, this, in that case, this should come, okay, then this is the answer. That is how it should be. But memorization is needed to pass the examination. But still, what I believe is, first understand the process properly with the structure like this. Then we can memorize it. Once we understand, then memorizing is easy for the exams. But in real life, you don't have to memorize anything. What situation comes, okay, just think what is the situation. Common sense, use common sense. Okay, learn auditing like that. Don't sit and just memorize, okay, this comes, this comes. In that 1 second gap, it's not a big thing. Think and speak. Okay. So understand, that is one thing that I have to say. This one PDF you take, okay, you think, you watch the lecture again. If you have doubt, then read it, because this one standard is very beneficial for you if you understand. Okay. Then facts which become known to the auditor after the date of audit report already issued, but after the date of financial statements has also been issued. Adukapparam he is knowing about the fraud or some issue that happened. In that case, what to do? In that case, what you should do? That is the case. Okay. First, auditor has no obligation to perform any audit procedure after the date of audit report. Audit report has happened. You don't have any obligation to perform any audit procedure after the date of audit report. Same thing. Here it is the same. Both the things are exactly the same. That is why you draw it like that. So when you learn, it is very easy. Then, if management amend the financial statements, they are amending the financial statements. In that case, what to do? If management amend the in this case, that is, he knew about this fact at this period only. If management amend the financial statement, they are changing that. Carry out the necessary audit procedure, review the steps taken by the management to ensure people who received financial statements are aware of the situation. Simple. First, what necessary audit procedure you do it. Second, here financial statement has already been issued. Financial statements, audit report issued, financial report statement also issued. Everything they have given it to the public. It is issued. It is gone. So what to do? Not like that to the shareholders, all these people. So see, in this case, management is amending the financial statement. That is changing. So management is changing it. So management will do some steps. Management will have to do some steps to ensure people who received the financial statements are informed of the situation. To whoever the financial statement has been given, management will take some steps to tell them, bro, I've given you the financial statement, but it is some amendment is there in that. So what are the steps taken by management like that? You will go and see that. What are the steps? Okay. Then if auditor don't want to do any audit, same audit. If you need to amend, if you need to focus only on that one event fact, then in that case extend the audit procedure. Same situation. In that case, extend the audit procedure to the date of new audit report, and the date of new audit report should not be earlier than simple things. Date of approval of amended financial statements, and provide a new audit report on the amended financial statement. This one you read, you will get it. Nothing is the same. And if management does not amend the financial statement, that is, auditor came to know about a fact after this date, and management is not amending the financial statement, some serious issue, but management is not amending and does not ensure that the people who received is informed of the situation. That is, this step they are not taking. And management is not amending and they are not taking the step also. In that case, notify the management and TCWG that auditor will seek to prevent a future reliance on audit report. Tell the management, bro, okay, tell the management that I am going to, like threatening them, tell the management, threatening them, notify the management that auditor, I'm gonna seek the future reliance on this audit report. I'm gonna tell the people, don't rely on those audit report. I'm gonna do the things like that. I'm gonna take legal action. And we threatened them first, but still they are not agreeing. Still they are not changing this. In that case, even after this, if management does not take necessary steps, then auditor will take action to prevent the reliance, legal action. Okay, this is the SA 560. I know you have some bit clarity, because if you see this thing only, if this paper is in your hand, everything is sorted. It's a conceptual essay, like a logical essay. You need to get the connection. Then it is very easy. So logically, just get the connection right, structure right. Then this is just the procedure. You memorize the procedure, no problem. Okay, understand just the basic understanding and memorize. That's fine. But understand the logic and concept. Events, facts are like two. Okay, what to do like that. Get the structure in your head properly. Your brain is like a library. Don't feed everything like just imagine two types of libraries there. One library, this is the concept everyone wants to understand regarding your preparation stuff. Bro, two types of libraries there. One is a cluttered library. Just visualize in your mind a library, very big library where books are like thrown here. Some fiction books are in one area. Along with that, some other magazines are also there. Some fiction books are there on this area. Some autobiography is mixed with that. Like a fully mixed library. Like some books thrown here and there, all these things. And that library has a librarian. If you go and ask the librarian, bro, I need this one book. I need Ikigai. Will he be able to tell you where Ikigai is? No. He'll have to look around, because it's not structured in a proper way. That is same happening with your mind when you're learning auditing or CA subjects. You're just learning everything and your mind is completely cluttered. You're not structured things properly. Not everyone, some people, okay. You may not have structured it properly. So what happens when the examination, the question is asking to you, okay, this is the answer. Your brain is not structured. From here and there, you will have to think what is the answer, like think, then you have to take. That is a problem. Create the well-structured library in your mind. That is why I always focus on what are the topics in the chapter, what is the structure of the chapter. That is why I focus on the question sheet learning format in the class. So structure everything, especially at least you can manage the concepts, the topics are smaller in audit. But if you come to final, bro, understand that it's very big, massive volume is there. You cannot just memorize everything and go and write it and come. You have to structure it properly first. First structuring the topics, then understanding the topics, then you will get the clarity. That is why I always say, like in my audit book, you can see audit clarity. First understand, then memorize. I have not simply written that. This is a structure that I teach. First, I'll give you first I will draw the structure. Then we'll make you understand the things. Then you get the audit clarity. Because you know the structure and you understood. Then it's memorization. Because for getting marks, we need memorization. So once it is structured, when one question comes to your brain, okay, this question is from 7th chapter. So in your mind, the only 7th chapter will remember that. At that time, 7th chapter will only come to their mind when you are reading the question. 7th chapter, okay, this is the question, okay, done. When a question if you learn with this chart, SA 560, when the question comes, your brain first will think whether it's an event or whether it's a fact. Okay, it's a fact. Okay, first. Fact in the time, this point your cut will be gone from your brain. You will only focus on fact. Fact and the factor, this factor, this factor. So you are learning, okay, this fact. This factor, what was audit procedure? Immediately you will go, okay, this fact, this is audit procedure. So this only your mind will focus on this area. All the other things you will forget, but you will remember. I mean, you will leave. That is a game in creating structure. Okay, learn everything like that. Okay, so yeah, whatever it is. So SA 560 is done, and in this chapter many other essays are there. Other essays are very easy because, like I told you in the beginning, we are focusing on the topics which are difficult for you to understand or complex topics. Other easy topics, there is no point in just coming and speaking about it again and again. Okay, so it's like a marathon session. Anyways, we have to do the things in like 10 hours. You have to listen to this. Normally students listen to 2-3 times. I'm not asking you to do that, but in your wastage time only you do that. Going concern, bro, understand one thing. Going concern also I'll spend some time. Other essays like written representation will finish quickly, and 260, 265 you read it also. What is there in that? It's very easy standard. So 570 in 7th chapter, subsequent event is one thing that may make you complex. Going concern is also one area is there where you may make it wrong. Other things are easy in this essay. Written representation is too easy, nothing is here. At 260, 265 is also very easy. But this one thing, basically 3 situations are there. I divide the situations like this. This is for your understanding, okay? Hypothetical understanding of the standard. Basically, 3 things are there in this chapter. 3 types of word. Material uncertainty. You will hear that. What the hell is this material uncertainty? What is normal uncertainty? What is going concern? So first of all, some big event happened. Imagine, I'll give you 3 situations. A normal fire happened in a company. This is not subsequent event, during the year itself. Just think. A company is having just one factory. And the company is purely dependent on that factory. Okay, the hypothetical situation. Company is dependent on the factory. Factory lena company gone. We have put around 10 crore rupee to construct that factory, or 100 crore rupee to construct that factory. So if factory is gone, then no insurance is also there. Just think like that. First thing, factory some area some issue happened, some fire or something happened, but that's not a big deal, right? But or let's leave this example for a better understanding. I'll say company, I'm running a company. In my company, basically only 2 buyers are there for my company. 2, 3, or like around 5 buyers are only there. A bigger company. I'm running a very big company, like an industrial pipe. This is my company. I'm creating an industrial pipe. Just this one example only I'll say about going concern. This one example you'll get everything, then we'll immediately move on. Because this one standard, one example I will finish it. I am the manufacturer of industrial pipe. Industrial pipe, not everyone need industrial pipe, like very big pipe under which water is going, or some cable underwater, this oil is gone, flown, all these things. So one of my customer is Indian Oil Corporation. I am the manufacturer of this. And I only have very few, in India, only Indian Oil Corporation and say for example, like one company, GAIL, they only need this. No other department need this. In India, these 2 are my main customers. I don't have any other customer. Nobody needs this thing, right? I am manufacturing just for them. But one pipe is worth 1 crore rupee. One big, very long pipe. I'm selling them. So in that, I'm getting a profit margin of say 30%, more than happy. I'll sell 100 pipes in a year, more than happy, right? This is a very big business. Only 2 customers are there. Just think, or these 2 customers, the problem is it's a government company. I'm not taking their name. So let's say X is one customer, X Limited is one customer, and Y Limited is another customer. These 2 customers only I have. And around 80% of my sale is with X Limited. X Limited. And now just understand, only 20% of the sale is with Y Limited. When that Y Limited is like a negligent customer, you leave it. So basically X Limited. So what happened is, because of some reason, normally what happens is that I will sell 50 crore pipe to them, and give them 2-3 months of credit period, and they'll give me the money after 2-3 months. This is the game. So I've already sold them 50 crore worth of industrial pipe. They are my main customer, right? But what happened was, credit period in the time, this company got a very big issue, some fraud or very serious issue. This company may shut down. Some very big issues happening with this company, and this company may not be able to pay. That company will be unable to pay me this 50 crore. What will happen? Because this is my main customer. If I don't receive the 50 crore, my company will have to be shut down. Because my main money is with the pipe they have given to them. They put the pipe also. So my working capital is getting blocked. Pipe I could have done something. But my 50 crore is with them and they are unable to pay me. One major customer, it is like that. So if this customer shuts down, or not exactly shut down, they're planning to shut down. Sometimes they may shut down, or sometimes they may not shut down. Some serious issue is going on. It's not like if they completely shut down, we are gone. But we are like around 50% probability. Some may shut down or may not shut down. So this in situation, here it is an uncertainty. It is an uncertainty. So on 31st March, this is the situation happening. On 31st March, for industrial pipe, our company's name is S Limited. So this is the situation happening. If that company shuts down, I'm gone. That is the situation. But they may or may not shut down. 50% chance here and there. So here it is on 31st March. It is completely an uncertainty for me. I don't know whether what will happen on. But if that uncertainty materializes, that is, if the company shut down, I am gone, right? So it is not a small uncertainty. It's a material uncertainty. It's a material, very big. But this one term is called material uncertainty. If the company shuts down in another 3 or 4 or 5 months, I am also gone. My company is also gone. So if that company survives, I also survives. It's a situation like that. So it's not a normal uncertainty for us. For an industrial company, it is not a normal uncertainty. It's a material uncertainty. It's a very big uncertainty. Okay. And if this kinds of a material uncertainty is there for us, we are auditing this company, right? If there is a very big material uncertainty like this, first thing the company need to do, not the audit, company need to disclose it. Like this is, but one more thing, material uncertainty doesn't mean going concern is gone. No. Because on 31st March some issue is there, but still there is like, if that company repays the money, our company will work fine, no problem. So our going concern is not affected. Company is still a going concern. People mistake this material uncertainty with the going concern. That is a difference. Both are different. So first is, like, I'll explain it. Wait. Then this is one case I told you. Let's look at, so this case you understood it. Here it's a material uncertainty is happening for us. Because it's a serious buyer. If that buyer doesn't pay, our money is gone, company is gone, everything is gone. Second case is that imagine this company is working fine. X Limited, everything is working fine. No problem for X Limited. And imagine Y Limited. You sold 10 crore rupee industrial pipe to Y Limited. And Y Limited is going this bankrupt. Y Limited is planning to shut down like this. But here only a 10 crore, 5 crore something is with the Y Limited. It's a normal uncertainty. Will I get if they shut down, I will not get the money. If they survive, I will get the money. It's a normal uncertainty. And even if the 10 crore we lose, still our company will survive. Because we have the major customer is there with us. 10 crore panel will have loss, but still our company will survive. So it's like, this is also an uncertainty, whether on 31st March, here it's an uncertainty for us, whether we will get the 10 crore or whether we will not get that. Because 10 crore is a very big amount for us, but not huge to a point that we will shut down. No. So here it's a normal uncertainty, sir. Here the uncertainty is normal. 50-50, same 50-50 is there, but the seriousness of the uncertainty is normal. So this is normal uncertainty. In case of normal uncertainty, it is not at all a problem. It's completely ignored. No problem. In case of normal uncertainties will be there in every business, leave it. So this is normal uncertainty, like a small uncertainty. But if it's a material uncertainty, company is having a material uncertainty, then company will have to disclose it and auditor will have to check whether company has properly disclosed that. And here in material uncertainty cases, going concern is still okay. No problem is there going concern. Because company is going, no problem. If that company shuts down, we will go. If that company complete on 30, that is first case. Then I'll say one thing. So in this case, here company is planning to shut down only. 50% chance is there. 50% chance to survive is also there. So it's a material uncertainty. We disclose it. And the third case, imagine this company is not there. This company is actually shut down. The liquidation order came on 31st March. As on 31st March, this company has already shut down. So that means on 31st March, we know that our major customer is gone. Our 50 crore rupees is also gone with him. So there is no option for us to survive. We are gone because industrial pipe company. This is our company. We know that. In that case, going concern is, and in that case, our going concern assumption is gone because our major customer is gone. Our 50 crore money is gone. There is no chance for us to survive. Industrial pipe company. So on 31st March, that is the third case I'm saying. On the 31st March, in this case, our going concern is gone. That is, going concern is gone there. So three things. First is a normal thing, normal uncertainty, material uncertainty, going concern is gone. Here there is no chance. In the material uncertainty case, there was a chance that 50% chance that this company will survive. 50% chance it will shut down. But in the third case, I told you that company is already gone. We are also gone. In the third case, going concern assumption is, our going concern is affected. So that is a going concern is affected for our entity. If going concern is affected, management should prepare the financial statements on a liquidation basis. Normal cases, management prepares on the normal basis. But if going concern is affected on 31st March, if going concern is affected, not material uncertainty, If going concern is affected, we know that we are going to boom, we are gone. If going concern is affected, then we need to prepare the financial statements on a liquidation basis. Management need to prepare the financial statements on a liquidation basis and give adequate disclosure. That is management's responsibility. When I am auditing that kind of a company, my responsibility is to check whether management has prepared the financial statements in a liquidation basis. That is what I need to check. That is what I will check. Okay. Whether management has done that or not, that I will check. If management has done everything properly, going concern assumption is gone, but they have prepared the financial statements in a liquidation basis itself. They have given the proper disclosures, everything. So management has done their part perfectly. So we will give an unmodified opinion because everything they have done perfectly. Financial, the going concern is assumption is inappropriate. They have also made it in the financial statements, everything. Then another case is there. If going concern assumption is affected, whatever I am saying, sometimes it may take some time to process in your mind. It is normal. Don't worry. Just pause it, think it, write and get it. Okay. If going concern assumption is like gone, it's gone. But if management prepare the financial statements on a in the normal basis, normal how we prepare the preparing. How can they do that? If going concern is gone, management has to prepare it in a liquidation basis. But they are preparing it in a normal basis, a financial statement. In that case, what to do? That means management has done wrong things. In that case, auditor need to give a modified opinion because management has done wrong in the financial statement. Going concern is gone and they are preparing it in a going concern basis. It's wrong thing. So give a modified opinion. So this is the case. So now the only thing I expect from you, opinion part you leave it because you may get it confused now. I know that, guys, because I saw at least no students, right? So if you were in front of me face-to-face classes, we would have discussed everything. Because recently in the last batch, we discussed this topic like crazy. Every student's doubt was clarified. I loved the batch. I loved those students also because they were so good in pointing out their doubts. Like I made them confident. Like you ask all the doubts, even if it's the crappiest doubt, let's do it. Okay, whatever it is. So now you understood about normal uncertainty. That's our company had a smaller customer. Some issues happening, then it's a normal uncertainty. They are unable to pay us 10 crore. It's a normal uncertainty. Material uncertainty, when our major customer is planning to go shut down where we don't have any other option, it's a major uncertainty. Then, because I told you, hypothetically I told you, there are no other customers for our company in the world. Only these two companies need our product. Just think like that, hypothetical example. People may say, if these two customers go, I will find a third customer. No. My situation is, I'm telling is, no other customer in the world. Only these two companies need me. Okay. Then second case, this is a material uncertainty because it's a major customer and it is not yet shut down. 50% as on 31st March, 50-50 chance is there. They may shut down, they may not shut down. That 50-50 chance is there. In that case, you give this one. Okay. Then the third case is that this company is completely shut down. On 31st March, we know that this company is shut down. In that case, our going concern is also gone. Okay. Now you know. Now I'm not going to speak too much on this because we don't have time. Concept explanation is what I focus on. So you have to prepare liquidation basis, all these things I told you. Then responsibility for assessment of entity's ability. This is management's responsibility. Management will look at these things. They look at the degree of uncertainty, size of the entity, all these things when assessing going concern. Then this one thing, risk assessment procedure and related activities related to going concern. First thing is that, bro, understand one thing. It is not auditor who is checking whether going concern is irka. First thing, management has to check that first. It is management's responsibility. To check whether going concern is appropriate or not, using them it is appropriate or not. For that, management, see, when performing risk assessment procedure as per as the 315, okay, auditor shall consider whether events or condition exist that cast a significant doubt on entity's ability to continuously going concern. If there are any significant events like that, auditor will see. In doing so, auditor has to determine whether management has performed a preliminary assessment of entity's ability to continuously going concern. That is, management, before making the financial statements, they need to do this thing. This word is a keyword. This word is a keyword, preliminary assessment. It is management's duty. Before making the financial statement, management has to do a preliminary assessment. That is a basic assessment. Basic checking. Company okay, so can we make it in going concern or not? Financial statement. That way they need to do a preliminary assessment. Are there any events or conditions because of which our company's going concern is affected, like the case we told. Management need to do a preliminary assessment like this. This is management's responsibility before even making the financial statements. Okay, first thing, entity's ability to continue. Is entity able to continue as a going concern for the next year? Management need to check that. And one more thing, guys. Auditor, when performing RAP under 315, before starting the audit, will perform the risk assessment procedure. At that time, we need to check whether management has done this preliminary assessment or not. This is management responsibility. We have to check whether management has done this or not. Okay. If such an assessment has been already performed, management has done that assessment. Management has done it. Already management has done preliminary assessment. Because when I was checking whether management has done that or not, management has done that. Yes. In that case, if such an assessment has been performed, case A, auditor shall discuss the assessment. Bro, what was the issue? You done the assessment, right? So what was the issue? Are there any issues that you identified? Any issues there with the going concern? Like that, you speak to them. Discuss the assessment with the manager. Determine whether any events or conditions are there, like that debtor X limited, Y limited case, which cast a significant doubt on entity's ability to continue as a going concern. Any issue is there, like that. Then second case, I checked whether management done this assessment, but management has not done this assessment. If management has not performed the assessment, they prepare a financial statement and give to you for auditing, right? So before preparing that, they need to do this assessment, right? If they have not done this assessment, then auditor will ask, then how the hell did you make the financial statements? Before making statements, you need to look at the assessment, you do the assessment. But you have not done the assessment and you have made the financial statements. Then how the hell you concluded that your company is a going concern? Without making this preliminary assessment, how the hell you concluded that your company is a going concern? How the hell auditor will ask like that? Visualize what I'm saying. Don't just memorize the procedure. Visualize. Just think in a way, if this comes like this comes like this. That will visualize things. Don't just memorize auditing. Understand auditing first, structure it, understand it, then get the clarity, then memorize. So auditing, you will love auditing. Else you will hate auditing. That is a problem. Learn it in the structured approach. Your auditing will become your favorite subject. So if such an assessment is not performed, audit discuss the management. What the hell is the basis for the intended use of going concern base of accounting? How did you conclude without doing that assessment? How can you conclude that the financial statements are how can you conclude that the going concern assumption is appropriate? Only after making this they can conclude. So this one thing you have to keep in mind, like a process. Other things are easy. Then what are the examples of some conditions which may cast a doubt? Like for example, these things will lead to a doubt. If these kinds of issue is there, it will become a serious doubt to entity's ability to continue as a going concern. Fixed term borrowing, company borrowed 100 crore from one bank and told after 5 years I will repay this money. But after 5 years, company is not in a position to repay the money. And now it's reaching the maturity date. Next month, 5 years, 31st March. If I don't repay, bank will take over my company, my security, everything I've given. In that case, I don't have any option to repay also. In that case, my going concern is gone. Because 31st March, this is the situation. Next month, if I don't repay, bank will take my company and go. And there are no chance of money coming in, I'm expecting. So 99% company is going to shut down. In that case, going concern is affected. So these are some conditions which will indicate that you are unable to continue as a going concern. Or that way cast a significant doubt on entity's ability as a continue. You read this, it's very easy. Inability to pay to creditors on due dates. All these things are easy. This, then other events, financial events, all this. Then management's assessment, all these things you go. The main thing is this one. Audit report, like how to give the audit opinion. That is the main thing in this chapter. Other procedures, everything you read it. If you know basic English, you will understand it. That's very easy. Other procedures. But this audit conceptual part, let's focus. So audit opinion. In case of going concern, how to give the audit opinion. Audit opinion. Okay. This one you leave it. Then the where the thought process okay. This same thing is mentioned in the upward also. This point, the same point is mentioned. Similar point. That is why I'm saying it here only. Both of those upar wala is also important. Okay. Implications of the auditor's report. If use of going concern base of accounting is inappropriate. That is, understand with me. Going concern is affected. That is that company that first. I'll take that example and come down. So it will be easy for you to identify it. The கொஞ்சம் complicated like full messy but still I believe if you understood the example you could understand what I'm saying here. Okay. anyways, let's put it here. Okay, let's see. That is, first case is this one thing you have to understand, because mostly the questions similar to this will come. Else the audit procedures mentioned above, like many procedures, that's a very easy thing, like read it, go it, put it 5 points, keep in mind and go. This conceptual things will make you lose the marks. Audit opinion kind of things. Okay, and now ICS testing on concepts. That is why I'm focusing on this one. Okay, so let's first thing is going concern accounting is inappropriate. That is this case, the third case. The two case I told you. This is a case number 1 here. Material uncertainty. Sorry. Hey. Okay. Case number 1 is this one. Normal uncertainty case. This one. Case number 1. That's easy. That's problem. That you completely ignore. That's case you ignore. Second case is this one. Material uncertainty case. That is this one. What is audit opinion to give in this case? Then third case is this one. Going concern is affected. That is the third case. This is one, 2, like all this thing. The third case is that this X Limited shut down. X Limited already shut down on 31/3. Like it's in the process of liquidation. We are 100% sure that it's going to shut down. That is a case 3, right? So that is a case, first case. That is the first case. See, if use of going concern basis of accounting is inappropriate, we know that management know that X Limited is going to shut down. So going to shut down means X Limited shut down, think like that. So that means our major customer is gone, our 50 crore rupees is also gone with them. No other option is there for us. We are completely doomed, because under 50 crore kadakkalena, we are also gone. We have taken loan from the bank to do that, but that company declared bankrupt and it shut down. IBC procedures are all, many things are there. If you go to CF and IBC procedure, they will get back the money. All those things are there. You leave that. That's where creditors payment, all those things you leave it. Hypothetical example I told you. So in this case, we are gone. So management should on 31st March, management no, and the company shut down, we are also going to shut down. So management should prepare financial statements in this basis, going real liquidation basis, because going concern is affected. Liquidation basis we need to prepare the financial statement. So liquidation basis means you will write down all the assets and liabilities, everything to the realizable value, the current realizable value. That means normally, imagine normal basis, last year in your balance sheet the asset is 10 lakh. So this year when it comes, and the 10 lakh minus current year depreciation, that should be the normal figure in current year, this one, normal balance sheet. But if the liquidation basis you are preparing, then that means if you sell that asset market, how much will you get it? If you sell it now, sometimes it 10 lakh asset value balance sheet, but if you sell now, you may only get like 7 lakhs or something. That value you have to put. Liquidation basis you have to put value. Your company is going to liquidate, so and the value you have to put down. Then regarding the liabilities also, you have to, if I'm paying off the liability now, at what amount I will have to pay off, that amount you put it. That is liquidation basis preparing financial statements. I don't have time to touch upon all those things. So in this case, going concern is gone. So basically, company has to prepare the financial statement. Management has to prepare the financial statements in a liquidation basis. That is going concern thing is gone. But what did the management did? Management prepared the financial statements in a real normal basis. In the normal basis they prepared. They should prepare it in a liquidation basis. That is their going concern assumption is gone. But they are using going concern assumption. They are saying that we don't know, we don't have a problem. We will survive next year also. That is this case. That is going concern. Use of going concern basis of accounting is inappropriate. Your going concern is gone, and still you are using it. That is inappropriate. That is you should actually prepare it in a liquidation basis, but you are preparing it in a normal basis. So in this case, management has done a mistake, so auditor will give an adverse opinion. You will blindly say the financial statement is wrong. Adverse means it's like blindly saying mofula mistake. That is adverse opinion. You are saying that you should prepare the financial statement on a liquidation basis because your going concern is gone, but still you are using that damn thing. So I am giving an adverse opinion. That is case number 1. Then second case is that if use of going concern basis of accounting is appropriate, but a material uncertainty exists. Material uncertainty irukku. But I told you in this case, see, material uncertainty just disclose it. That's enough. Because in this case, if this company is gone, we'll go. But on 31st March, we have a 50% chance that company may survive, this company. So we also have a 50% chance. So it's like a material uncertainty, not a serious thing. It's a serious thing, but not very serious, like not 100% sure. So in that case, just a disclosure is enough. So going concern basis of accounting is appropriate. They can use that there. Okay, no problem is that. So in that case, two things are there. If like a material uncertainty case, two things are there. Material uncertainty case, two things are there. That is this one. This is case number 1. A. If adequate disclosure is given, that is, I told you disclosure kodukkanam. Management has given the disclosure. Going concern, they prepared the financial statements and the proper disclosure also they have given. In that case, the financial statement is correct. But problem, they have disclosed it also. So financial statement, management part correct. So auditor part we give unmodified opinion. No problem is there unmodified opinion. Okay, then state attention there note that financial, like this things also you need to give simple. In audit report, you need to include a separate section under the heading material uncertainty relating to going concern. All those things you need to put it like simple. Then another thing, this one, if adequate disclosure of material uncertainty is not made, that is a material uncertainty irukku, but they have not disclosed it in the financial statement. Management going concern financial prepare pannita, that is okay, no problem. But they need to disclose about material uncertainty in the financial statement, but they have not disclosed that. That is a problem with the management. So financial statement has a mistake. In that case, we will either give a qualified or adverse opinion, depending upon the circumstances. Okay. Then, that is 2 cases we learned. Case number 1, case number this and this 2 cases. Normal uncertainty is not a problem, I told you. So in this one you ignore, no problem. Other 2 cases you look at. So 2 cases we told you. 2 cases basically there are 3 situations. Going concern or one situation like irka ille. But material uncertainty 2 situations. Disclose pannite pannalaya. 2 situations. Okay. You go through in your mind once, you'll get it. So we spend more time on concepts for this chapter. Okay. Then this manager is unwilling to make an assessment. The preliminary assessment they are not going to make. Going concern irka ille, they are not going to make it. Give a qualified or disclaimer opinion. Disclaim the opinion. You leave it. Then 450 is easy. You read it. Then written representation is also, you see the written, you know that it's simple standard. What is the point of written representation? Then 260, 265 is also not that tough. Standards are easy. Let's go with the audit report chapter, because 7th chapter, these 2 things are only that a bit affecting you. Okay, let's go with the 8th chapter. So SS 700 audit report basically is divided into many. What is the structure of audit report? First we'll learn about SA 700, 701, 705, 706, 710. 5 essays. That is one thing coming. Then this 299 may be coming. CARO is coming. 143.3 reporting is also coming under section 143.3 of the Companies Act. These are the structure of this chapter. We'll focus only on the important things. Quickly we will navigate. SA 700. This is audit report section, audit reporting. First, auditor has 2 responsibilities under this section. Number 1 is to form an opinion, and the other one is content of audit report. Those 2 are the coming under SA 700. To form this opinion, audit opinion, to form that opinion, he has to obtain reasonable assurance whether financial statements are free from material misstatement. If financial statements are not free, then modified opinion. If financial statements are free from error or misstatement, then unmodified opinion. So to get that opinion, obtain reasonable assurance whether financial statements has misstatement or not. To get this, to form this opinion and get this assurance, auditor will evaluate these structure. I structured it, so it will be easy. First, you will look at whether sufficient appropriate audit evidence has been obtained. Then whether uncorrected misstatements are material. Then some evaluations by the auditor. These auditor will evaluate these 3 things. He will evaluate what are the qualitative aspects of entity's accounting practices. Entity will have their own accounting practices, like when the journal entry should be recorded, when it's like all these accounting practices will be there. How to recognize revenue, all these things. So what is a qualitative aspect regarding that? Quality and so for that, to know about the qualitative aspects, 4 things are there. Auditor will evaluate all these things to know about the qualitative aspect of accounting practices, company audit. What is first thing? First, you look at what is the management, what are the management judgments. Management will make a lot of judgments regarding the disclosures, financial statements, in all these things. So what are the judgments made by the manager? How effective are they? They will evaluate all this. Then like these qualitative aspects depends upon these things. Then SA 260 has also said about the qualitative aspects of entity's accounting practice. Then what are the possible bias in management judgment? Management judgment at a time, what is the bias with them? And why does this bias comes? Imagine a management is biased. Management is taking a biased decision. Maybe it will be basically for their own favor or for the favor of someone, right? That is what we call biased, one-sided decision. Two option management should be normally neutral. If two options are there, for example, management wanted to buy an AC, just think, or management has to take LIFO method or FIFO method, which are one method they have to choose for inventory. So they should be neutral. They should look at what are the advantages and disadvantages of both LIFO and FIFO, then pick what is best for the company's perspective. That is, they should be neutral. They should not be, before even starting the judgment, they should not say that I am going to pick LIFO. No. They should be neutral. They should not be any sided. LIFO and LIFO is here, FIFO is here. They should be neutral, and then observe the two things and then pick whichever is needed. They should not have any decision towards. They shouldn't be biased towards LIFO or FIFO. But when management is not neutral, management is one-sided towards LIFO. That is, management wanted to take LIFO. He is sided towards LIFO. He is always supporting LIFO. In that case, it is called a possible bias in management judgment. So this bias, how this bias will come? This bias first comes from lack of neutrality. That is, he is not being neutral. He is one-sided to one decision, either LIFO or FIFO. He is sided to anything. That is lack of neutrality, one thing. Then second thing is selective correction of the uncorrected misstatements brought to management's attention. That is, if auditor, imagine just a situation, if someone tells the management, bro, these 10 mistakes are there in the financial statements. They are correcting only those mistakes that are in favor of them, in favor of the company only. Other mistakes they are not correcting. There is, for example, there are 10 mistakes in expenses, which I told to the manager. I told the manager, bro, there are 10 mistakes in expenses. 5 mistakes they are correcting. 5 mistakes are actually the things which will increase their profit. They wanted to do that. If they wanted to increase the profit, they'll do the things that is in favor of them only. So when I correct those 5 misstatements, my profit will increase. So manager will correct that. But other 5 mistakes are there. That if management corrects, what will happen? Management's profit will decrease. So they are not ready to correct that. Selective correction. They are correcting things which are only favorable for them. They are that way. So uncorrected misstatements. That is selective correction of means uncorrected misstatements brought to their attention. So this lack of neutrality, that is not being neutral. What are the indicators of lack of neutrality? What all things will indicate lack of neutrality? First is selective correction. They are selective correcting. Then possible management bias in accounting estimates. When they are taking, for example, useful life or depreciation, accounting estimate. That time they are possible management bias. To get more depreciation, they are reducing the useful life like that. So this is a structure, complete, that process is written here. Then he will see whether financial statements are prepared as per FRF and also some specific evaluations by the auditor. This is a structure. Same thing, I'll show it in the book. That is forming an opinion, that was his responsibility. Then content of audit report. To form that opinion, he need to obtain whether sufficient appropriate audit evidence, corrected and uncorrected misstatements material, whether the evaluations required. Then what are the evaluations required? All those things we have done. Then qualitative aspects. What are the qualitative aspects? See, management judgments is there. SA 260 is there. Then what are the possible management bias comes from? Lack of neutrality and effect of uncorrected misstatements. What are the indicators of lack of neutrality? I showed this. Selective correction and possible management bias in making accounting estimates. Then SA 540 also address about the possible management bias. Okay. Specific evaluations you read, you will get it. Then form of opinion, we'll learn that there. Then one more thing. Here I showed you, where is this? Here I told you, here we talked about this one completely. Then what are the content of audit report? What is the content of audit report? You see, content of audit, that is also coming in SA 700. This is the content of audit report, auditor's report. All the content is there, like title, addressee, audit opinion, unmodified opinion, all these things, basis for opinion, key audit matter, other information, responsibilities, all these things are there. All those things are easy. So I'll just show it to you one audit report just to get a glance. I'm not going to explain anything that is not needed also. So if this is one audit report that I'm taking. So see, this is what we call the title. Addressee, to whom the audit report is given, who hired you to do the auditing. Members of Infosys Limited. Here, see, opinion, auditor's opinion paragraph. That same order in your book, it is there. Audit opinion. Then we have audited the financial, same sentence also. Same sentence is also there. See, you see, audit opinion paragraph. This is audit opinion. First, selection of the audit report shall include auditor's opinion with the heading opinion and shall first identify the entity, state that the financial statements are audited, identify the title, refer to the notes, specify the date and period. All those things they have, see, where is it? All those things they have done. See, I state that the financial statements are audited. We have audited accompanying financial statements. Date, it is there. Identify the entity, means which is the entity. Name the name of the entity you write. That is identify the entity. Same things are there. Title of each statement, the balance sheet, the P&L, all these things are there. Then refer to the notes of financial statements. Everything, that 5 points is there in this. Okay, that is opinion. Then basis for opinion. That is how you were able to get this opinion. If you are giving an unmodified opinion, how you reach that. If you are giving a modified opinion, how you reach that. That is basis. Same thing regarding basis also. In your book, whatever is written, same thing is written here also. You can take this audit report format and do it. I mean, check it. Then going concern, it should come here. Then what are the key audit matters? I'll explain that in the essay. When this is how the key audit matters will be. Next will be key audit matter. So I'll explain key audit matter. What are the key audit matters? Means the most significant matters that are needed in that the auditor wishes to communicate. Then these are other informations other than the financial statements which need to come here. Then responsibilities of management. Then auditor responsibility relating to audit, you write about that objective, the reasonable assurance and statements, all these things. Then report on other legal and regulatory requirement. It is under this head. Remember, it is under this head. Report on other legal and regulatory requirement. All the others, the reporting as per different act comes under this head. It will not come here or anywhere. It is, for example, as per section 143.3, we learn about this. This reporting comes under this head only. This is the head you have to keep in your mind. Or see other, all these things. 143.3, when we are learning 143.3, I will show you. Then CARO reporting. CARO also comes under that. But if you want to report anything regarding CARO, you will state here and you will give it like an annexure. That is how it works. As required by the CARO issued by the central government, we give in annexure B a statement regarding the paragraph 3 of 4 of the order, like that. Then here sign of the auditor will be there. 12 sign of the auditor, the audit firm name, firm registration number, all this, auditor's name, auditor's membership number, UDIN will be there. Then place and date, all these things. UDIN, all these things, I guess you know all that. Okay, then let's go to the same 705, that is modifications in the auditor's opinion. When do you give a basically you know all this, most of this people will know different audit opinions, all those, very important thing. Okay, then SS 705, modifications to the auditor's opinion. Basically two types of opinion are there: modified opinion, unmodified opinion, or unmodified opinion, modified opinion. When do you give which audit opinion? That is a game. Okay, so yeah, 1 second. You know this, but I'm just saying this. Okay, you can just use this format to check it. First of all, you check the financial statements and you know that the financial statements are free from material misstatement due to fraud or error. Whatever management should include, everything they have included, all the disclosures, all the format, all the amounts, everything is correct, everything is perfect. You give a unmodified opinion. Whatever you checked the financial statements and you agree to what is there in the financial statements, just like that. Unmodified opinion. Okay, that is unmodified opinion. Let's talk about modified opinion. Modified is divided into qualified, adverse, and disclaimer. Qualified opinion means, okay, the adverse is the, if qualified opinion means it's like, you checked the financial statements, so except a few matters, all the other things are correct. Like that you are saying. When you are auditing the financial statements, some misstatements you identified that are material, okay. And you are saying, okay, except these 3, 4, 5 misstatements, the entire financial statements are okay. That is what is called a qualified opinion. And adverse opinion means you are completely saying the financial statements is like a boom, it's gone, like that. That is adverse opinion, like it's completely bad. Adverse, negative. Disclaimer means you are unable to obtain audit evidence. And you conclude that the financial statements has misstatements also, but you are unable to obtain audit evidence. Audit evidence kadakile. You know this person killed that person, but you don't have any evidence, like that. If you don't have any evidence, if you go to the court and say that I know this person killed that person, but without any evidence, any irka, so you cannot go into the court. That way, that is like, similarly, you know the financial statement has a problem, but you don't have any audit evidence. So you'll say, since I don't have any audit evidence, I don't have anything to say. It's like a disclaim my opinion. I'm not going to give any opinion, like that. Disclaim. So now I'll give you the conditions when these three things are. I gave you the meaning of these three opinions. So now this is the basic hypothetical meaning thing. So here I'll give you the basic on which conditions which you need to give this opinion. First is qualified opinion. Qualified opinion is this one. Qualified opinion. You have misstatements. When you audited the financial statements, you identified a material misstatements. So the misstatements, you identified misstatements. Misstatements you identified, right? So you identified misstatements and you got the audit evidence. And you got the audit evidence that misstatements are material. It's important misstatement, like serious misstatement, but not pervasive. Pervasive means it does not affect the entire finance. It doesn't have a very huge impact. Entire financial statements will not affect, but it is material. It's a serious mistake. In that case, when you did the audit procedure, you identified that the misstatements. This is the first thing you do. First thing, I'll give you the order. The moment you get the question, first go and see. First see, are the misstatements material or not? First see that. This is the first thing you need to see. Are the misstatements material or not? Yes, material is material. Okay. Now see, are the misstatements pervasive or not? Just see. In this case, pervasive means is it huge or not? It is not huge. Okay, it's not that huge. It's an important misstatement, but it is not that huge. Okay, now see, have you obtained audit evidence, sufficient appropriate audit evidence regarding this? Yes or no? It changes in condition to condition. Okay. So now let's talk about, this is the, one second, this is the easiest way to, the moment you get a question, you can check it like this. First see whether misstatements are material. If it is material, yes, it is material. Okay. Material means, it is material. Okay. Next, misstatements are pervasive or not? They are saying it is not pervasive. So it is not pervasive. Okay. Then see whether audit evidences, whether sufficient appropriate audit evidence in the misstatements, okay, you got audit evidence or not regarding that? Yes, I got the audit evidence. Yes, I got the audit evidence. So in this case, these three things are matching. So you can give a qualified opinion. And then now we will see the opposite things. Okay. Misstatements are material or not? Yes, misstatements are material. If misstatements are not material, then it means unmodified opinion, right? So see, I can give you different opinions. Wait. We'll draw this in a good way, man. We'll draw this in a good way. This is a good chart. We'll draw it in a good way here. I have it with me. I'll draw it here itself. Even if it takes some time, it's useful for you. Okay. First thing, this is the first step auditor will do is, he will see, are the misstatements material or not? This is the first question you will ask. What is the second question you will ask? You will ask, are the misstatements, first this is, are the misstatements material or not? Are the misstatements pervasive or not? You are asking pervasive or not. Third thing, you are asking whether sufficient appropriate audit evidence obtained or not. That is, whether you obtained audit evidence that the financial statements contains a material misstatement. Audit evidence kadacha illa. That you know that debtors will problem. So whether are you unable to obtain an audit evidence? You send external confirmation. Whether you got audit evidence or not. It is a material thing, but whether you got audit evidence or not, that is a question. So this is the order. The moment you get a question, you can check it like this. So first, I'll give you different cases. So first thing, we are saying that material misstatements, yes or no. Yeah. I'm saying no. Material misstatements illa. But whether the misstatements are material or not? No, it is not material. They are saying it is not material. So you don't have to check all these things. You don't have to check all these things. It means you are giving an unmodified opinion because it is not a material misstatement. So give unmodified opinion. Misstatements are but not material. Misstatement. That's not a problem. You give unmodified opinion, no problem. Okay. Then what is the second case? We are looking at the second case, that is material misstatement irka illa. Yes, material misstatement is there. Like no means I'll write it as no. Or no is better. So it will be easy for you to understand. Okay. Whether misstatement is material or not? Yes, it is material. Second case. And whether it is pervasive or not? No, it's not pervasive. It's not that huge. Or whether you got the audit evidence? Yes, you got the audit evidence. In that case, you can give a, what is the opinion? Just see, material misstatements are material. Yes, but not pervasive. And you are able to obtain the audit evidence. In that case, you give a qualified opinion. Same case. Are material misstatement material? Yes, material. Are pervasive? Pervasive is also not pervasive. Not pervasive. But have you obtained audit evidence? No, you have not obtained audit evidence. In this case also you give qualified opinion, because here you are concluding. Qualified opinion has two clauses. First, you obtained the audit evidence and concluded material misstatements are not material but not pervasive. Second case, you are unable to obtain audit evidence. You know this person killed this person, but you are not able to obtain an audit evidence. Audit evidence kadakile, but you know that this person killed this person. But you are a police officer, you don't know. You know that this person killed this person, but you are unable to get the audit evidence. But based on the possible effects of the undetected misstatement, undetected misstatements or a possible effect based பண்ணும்போது you decided that the misstatements will be material, not pervasive. You know this happened, you know this person killed this person. That is, you know financial statements and material misstatements irukku, but you are unable to obtain audit evidence. So based on your observation, based on your thought process, you are concluding that the possible effect of those misstatements are material. And the misstatements are but audit evidence kadakilla. But I'm just thinking that, okay, the possible effect of that misstatement can be material, is material I'm saying. But I don't have any evidence. In that case, you conclude it as a qualified opinion. Here it is material and pervasive. Same material, not pervasive. The material misstatements is material but not pervasive. It is not affecting huge. But same item, exact opposite is there in disclaimer. Same audit evidence kadakilla. You know there is material misstatement, but audit evidence is not there. You are unable to get audit evidence. You know the misstatement is there and that is material also, but you are unable to get audit evidence. And you conclude that the possible effect of that misstatement, and the misstatement possible effect is material and pervasive. It is material, not qualified. Material and pervasive are it is disclaimer of opinion. It is disclaim the opinion because it's a huge misstatement. Material is pervasive. So it's a huge thing. For that, you don't have to give an audit opinion, just like you disclaim the opinion. Same thing opposite. And this same thing. So if you learn this too, you can write all this. The first, learn panna. Second point is same material, not pervasive. It is this. Well, material and pervasive, it is disclaimer. And first is the same thing. You are unable to obtain audit evidence. Same thing, audit evidence. You are able to obtain audit evidence and conclude it is material and pervasive. It is adverse. Okay, so I'll give the situation here. Third situation. And these both here, it was unmodified opinion. And here in these two cases, it is qualified opinion. And now let's take a look at the third case. Misstatements material, yes, material. Because material, it's directly unmodified opinion. Material. Pervasive or not? Yes, it is pervasive. Because first two cases, no, it is. Yes, it is pervasive. Audit evidence kadachirukka. Yes, audit evidence kadachirukku. In this case, you give a adverse opinion. And the only one case is remaining. Only one case is remaining. That is what is the one case remaining. You are saying that misstatements material, yes, material. Okay, pervasive or not? Pervasive or not? It is pervasive. Yes, it is pervasive. Audit evidence kadachita illaya? No, I cannot get audit evidence. In that case, you give a disclaimer of opinion. 4 things. So I give you different format. Either you can remember this format exam ECC, or you can remember the entire theory format, or if you can use this format. In this format, it is basically like a step format. So but the moment you get a question, you just ask these questions. Are the misstatements material or not? Yes, it is material. If it is not material, then unmodified, directly unmodified. If it is yes, material, okay, then ask the second question. Is it pervasive or not? That is, it's huge or not? Then like that, ask these questions in these order. So you will get these answers, and based on that, you can decide which opinion to give. Okay. I hope you got it. Audit opinion is done. Then these all things we'll just quickly go through. It's nothing is there. This opinion paragraph is only thing. Then what is emphasis of matter paragraph? Emphasis of matter paragraph. Let me see whether there is something is important in that. Just give me an idea. What is emphasis of matter paragraph and what is other matter paragraph? The only difference is only the thing you need to know. And what is key audit matter? Those 3 things. Emphasis of matter paragraph, let's say. That is in your financial statement. In your financial statement, say for example, let's say a major related party transaction is there in your financial statement. A major related party transaction is there. So when a related party transaction happens, you need to give the disclosure, right? Okay, management has also given a disclosure regarding that. And entry amount is there is also in the financial statements. But when the auditor thinks that, okay, thing is very important thing. I need users to know something about this also, extra. That is in auditor's opinion, he need to write something about that also. So in the item is already there in the financial statement. The related party transaction is also there and the amount is also there. Disclosure is also there. So that item, if this is the financial statement, in this statement, the related party transaction item is there. Inside it, the amount, the disclosure, everything is there. So this is something that is already mentioned in the financial statements. If auditor need to draw an attention to this, that is, this is like an important thing. Auditor thinks, okay, this is an important thing. I need the users of the financial statements to know more about this. Like auditor want to write something about this, like related party transaction, the problem I laid out, something if you want to write, he will create an emphasis of matter paragraph. Emphasis of matter, just emphasizing the matter. I'll do one thing. Just if you see this page, here everything is written in black. But in the red, what happened? In this 1, 3, 4 words are highlighted, right? If this was in black, it will not be highlighted. This is in red, it is highlighted. That is emphasizing these words. I just emphasized these words. Words in here, I just emphasized it with the color. I just showed it out to you more. So for example, I'll see if this auditor word, I can just highlight it. So it gets emphasized. When someone is suddenly reading the book, this yellow color or red color, their eyes will go and they'll read that more. So to purposefully do that, we are emphasizing that. When I was making the book, I wanted you guys to focus on the red thing, keywords. That is why I colored it red. I emphasized these matters. With red color. I just highlighted it. That is the meaning of emphasis. So in financial statements also, in the Madri, a lot of matters will be there, which auditor want to just highlight. Just to highlight that is like an important matter. He want everyone to focus that more. So for that reason, he will create an emphasis of matter paragraph and write about that. So when a user is reading audit report, okay, this matter is important. He will again go to the financial statement and see this matter. That is emphasizing the matter. That is emphasis. To draw it is like an additional communication in the auditor's report when auditor considered it necessary to draw users' attention to a matter presented or disclosed in the financial statement. So already disclosed in the financial statement, he want to emphasize that. That is when he use EOM. When will he use OMP? To highlight same thing, to highlight a similar matter which is not presented or disclosed in the financial statement. Related party transaction, financial statement, it is there. But something that is not there in the financial statement, but that is important to that company for auditing purposes, and he need to write about that, then he will write OMP, or other matter paragraph. It's both of these things are same. Only thing is, emphasis of matter we use to highlight things that are in the financial statements, OMP that are not in the financial. Example, an accounting standard was there. Company has not complied with that accounting standard or something. So he can give another matter paragraph relating to that. Some GST registration not taken or other that comes. That's auditor's judgment. Sometimes that may affect the qualified opinion. Some non-compliance, basically it's not a very big thing, but you need to write about it. Auditor company has not followed that rule, but it is like a big thing. If something like that is there, he can give it in other matter paragraph. Like any branch auditor's involvement or this non-compliance with any small laws or regulations, all these things. Or one more thing, for a normal in a partnership firm or something, if the audit was done voluntarily, not become mandatory, something like that. All those things you can put it. Audit you will leave it. That is not a company mandatory audit is there. Sorry. So these things you can use it. Okay. To draw you then emphasis of matter, same thing. Whatever I told you, it's same thing. It is there. If the auditor considers necessary to draw the attention, the financial emphasis of matter paragraph provided, I will not modify the pen. All these things are easy. It's not. It's easy. Communicating key audit matters. What are key audit matters? Key audit matters are emphasis of matter paragraph is key audit matters are the most significant matter. During the auditing, what are one or two matters which auditor considers as the best, the significant matter? For example, revenue recognition. Till last year, company were following one policy. This year onwards, company changed the policy. That is the most important thing that the users need to know. The below things are, we will put an emphasis on matter paragraph. Key audit matter means it's a key matter. Without key, you cannot open the door. That is that significant. That is key audit matter. Regarding some valuation of goodwill or revenue recognition or some inventory valuation, some serious things. So the most serious things he will put in key audit matter. See, definition of key audit matter. Key audit matters are those matters that in the auditor's judgment where the most significance, EOM comes below this, okay. In the audit of financial statements of current period, key audit matters are selected from the matters communicated with the TCWG. And why are you communicating key audit matter? What is the purpose of that? First is to CV, resume, communicative value, to enhance the communicative value. If a person wanted to read the financial statements, you don't have time, like audit report, you don't have time. So quickly key audit matter, other summary read like the most important things, I can read that and go. Like that. The most important things will be there in the key audit matter. So it's like enhancing the communicative value of the report. Reported a communicative value it is enhancing. Because normally when you read the report, okay, plus key audit matter is there, then it means auditor finds this matter as most important. So I also need to make the give importance to this. Users will feel like that. Enhance the communicative value. Next is provides additional information to the intended users regarding revenue recognition or inventory value, anything. Normally, if auditor has not put a key audit matter, the people will not know this is like a serious thing. But since auditor puts it as a key audit matter and writes a description about that, when auditor reads that, when the users read that, they'll get additional information regarding revenue recognition, inventory valuation, right? Then understanding the entity and the areas of significant management judgments. This is recognition, revenue recognition. In the policy vanam, that is management's judgment. So when you write detailed about that, the users reading that will understand the business and the area of management judgment also. See, when you read the key audit matters, see key audit matter, revenue recognition, they have wrote about all the things, what is auditor's response, all these things they have written like this, okay. The revenue fixed price contract using the percentage of completion method, so this was it. Like that, they will show it. Key audit matter. Then how will you determine the key audit matter? That is another question. Lot of matters will be there, right? How will you determine the key audit matter? Number one thing is that here we learned one thing. They are selected from the matters communicated with the TCWG. The most important matters during the audit process, right? Most important matters are there. And I will communicate to the TCWG, right? Weekly or monthly, I will communicate to them, right? So during the entire audit, I would have communicated some 10 matters to TCWG. The most important, and I'll pick 2-3. That is like key audit matter. Okay. Key audit matter. Determine from the matter communicated to the TCWG matters that requires significant auditor's attention. Auditor shall take into account these things. What are the higher areas of higher assessed risk of misdemeanor, significant risk area? For example, management change the revenue recognition policy. So sometimes a risk may be there. So if that area is assessed as the highest risky area in the entire auditing, he can give that. That is one area. He will take into account these things. He will think, okay, key audit matter. So that time he'll think, okay, what was the most riskiest thing I did? What was there in the auditing? Revenue recognition, right? So let me give revenue recognition, like that. Then significant auditor judgments relating to those areas where it involved management judgment, significant management judgment. Okay, I'll think. In which area management has made the biggest judgment, the riskiest judgment? So he will get one area. Okay, on the area, like auditor has also made a judgment relating to that area, right? Auditor made a judgment relating to area where management made a judgment. And the other area, okay, I'll take that area. Okay, that should be the key audit matter. Like that he can take. Then effect on the audit of significant events or transactions occurred during the period. Any other significant events here and there, some fraud, something you identified relating to which event, you can put that as a key audit matter. Okay. Then communicating key audit matter is not a substitute for disclosures, modified opinion reporting, all these things you know. Then essay 710. Oh, super essay. The essay, just let me ask you one question. What is the difference between comparative information, comparative financial statements and corresponding figures? Tell me. So guys, when you're studying, please invest in one good book stand, some book stand or a place where, or just do one thing, what I did. You keep some 5-10 old books in your front like this, and keep like 100 rupee, you will get some cardboard, tough board, like plywood board like this from the bookstore. You keep it like this and you write it on top. Like the slanted position should be there. So your neck will not bend like this, because that can create a very big issue in the long run. And sometimes during the exam time or like last week before exam, you can get a neck pain. That is horrible. Neck and back pain, it should not come during the exam time. So you have to keep your back stretched properly, like 1 or 30 minutes you have to stretch up. And neck pain is the most crucial thing. So don't, like in the mother, don't sit and do the practical problem, all these things. If you are not having that kind of a height, okay, it's fine. Like 5'3" or 4, it's okay, fine. Still, it's manageable because your table will come at this height. So you can at least this much bend. But if you are having above 5.8 feet, 5.9 feet, 6 feet, all these things, it's better because the table will be at this height. So you'll have to look like this. That will be a very big problem. It will have a problem in the long run. And if you're continuously sitting for like more than 1, 2 hours, 3 hours in a stretch bench or like in a chair, keep your feet touching the floor. So your body weight goes to the floor, like goes to the feet. If your feet is above the floor, what happens? Entire body weight is coming on your lower back. So your back will get crunched and it will get into a problem. So that is why if you're like, best thing is keep your feet down on the ground. Like the weight should go to the down. So only half weight will come on your back. So that the chance of pain gets reduced. So these few things you have to keep in mind. Okay, I just said it because I'm having back pain because this seat is having a bit height. Okay, I cannot touch my feet on the floor. I used to touch like that. It's not a big deal. So SS710, comparative information. Guys, understand just one thing. This is how a financial statement will be. This is how a financial will look like. Current year figure, previous year figure. It will be there, right? This is what we call comparative information in total. Why are we giving this? Because current year, if you are making financial statements for 24-25, I'm giving hypothetical example for you to understand this essay. I'm not saying how corresponding figure works in practical life, not like that. Here exam is coming, do what is required for exam. Practical things you come after finishing exam, you come to me for final, we'll discuss how things happen. Okay. On the 1 hour, like how can you do that? Okay. So financials, we are preparing a statement for 24-25 this year. So normally why do you want this? Why do you want to put this? Previous year figure, why are you putting along in current year financial statements? It is for comparison purposes. P&L and balance sheet. P&L here you'll know liability. Here liability, current year liability 10 lakh. So we can just go previous year liability was only 8 lakh. Current year it is 9 lakh. Liability has increased. That comparison we can quickly make decisions. That is why we are giving this previous year. If it is sales means we'll know, okay, current year sales are 10 lakh, previous year only 8 lakh was there. Oh, company is performing good. Then profit, check profit, current year it's 10,000 as a profit, previous year it was only 7,000. Oh, current year it is good. Or like extra, vice versa. So we are giving this for comparing. That is what we call comparative information. Okay. This thing we will divide it into two. This info, previous year info, that is comparative information. This is comparative information is divided into two. One is corresponding figures. Next is comparative financial statements. Not consolidated financial statement, comparative financial statement. That is, this comparative information is divided into two. That's part. Comparative information part is that. Understand? Okay, you got it, right? Next thing. Yeah. Then what is the difference between these two? If you are giving this previous year figure exactly like the current yearly all the notes, disclosures, everything. Current year, like, because you are auditing current year. So in the current year financial statements, everything will be detailedly mentioned, right? So exactly like that, previous year same figures you are giving. That is what we call a comparative financial statement. Here one more thing is there. If for a comparative financial statement, we are auditing this also. Basically, we are giving an audit opinion for this period also. Normally in financial statements, we are giving audit opinion for the current year only. But if you are putting a comparative financial statement on side, you will give an audit opinion for this one also. This one also you will give an audit opinion. If it is a corresponding figure, now let me, don't worry, I'll make it. Now I know it's getting complicated, but just one chart I will show you are done. Then corresponding figure, this one, same thing, but breakup on. Here I told you exactly, current year notes, breakups, all the bifurcations, all these things will be there. If debtors, all the bifurcation, all these things will be there. Expenses, all the bifurcation will be there. Current year, in notes, but if you are giving comparative financial statement, the bifurcation and all those things will be there in the previous year figures also. But if you are giving corresponding figure here, this same item, bifurcation, just outside amount only there. That is what we call corresponding figure. That is, corresponding figure will be less detailed. Detailed, just outside figures will only be there. But comparative financial statement, you will get more detail. It will be more detailed, like exactly like this. And corresponding figures, no audit opinion. You are just giving this period for comparison purposes, read only purposes only. No opinion, nothing will be given if you are giving corresponding figure. But if you are giving comparative things, audit opinion will be there. Both are the same. Amount ellame same aayirikkum. But here it will be more detailed, here less detailed. Because previous year amount change agadille. If previous year sales was 10,000, if you are giving corresponding or comparative, it will be 10,000. But sales or breakup irukku. That is the difference. So I'll show you one thing. Which chart is it? Let me see. I think it is. Just this difference you need to understand this essay sorted. Essay 710 corresponding figures. This is basically what is followed in India. This is comparative financial statements is not followed in India. It is basically for some different kind of sectored companies, all these things. It's not basically followed in Indian normal companies. It is not followed comparative financial statements. So you need to focus on this one only. There's some outside, some different sectors, industries to follow up, right? And it's not that relevant. You need to focus on corresponding figures only. Same thing itself, but the thing is, the same amount previous year amount itself, but by details. Then less detailed information, only limited notes will be available. Here, more detailed information, exactly like the current year. Same thing. Then here no audit opinion for the previous year data, that is current year data, only audit opinion will be there in corresponding figure. Comparatively, you will get audit opinion for all the date and period included in it. Then this is for read only purposes and this is for detailed analysis, just like current year. Got it? Yeah, I believe you got it. Then in this audit procedure is basically for comparative information. That is, comparative information is divided into two, corresponding figures and comparative financial statements. So if they ask you what is audit procedure for comparative financial statements, so see, if you want, you can write this. Because it is basically audit procedure for corresponding in comparative info. Comparative info is divided into two. See, this is audit reporting regarding corresponding figure. Then this is audit reporting. We also have prior period financial statements audited by predecessor, all that thing. It's important thing. The tough thing. Let me see in the books. Anything which it is difficult for the students to understand this. Corresponding figures. You just need to know the meaning of that only. What are the audit procedures regarding comparative information? What is the audit procedure regarding that? First, auditor shall evaluate whether, for this purpose, that is, auditor shall determine whether financial statements include comparative information. That is, side comparative information corresponding a previous year information given or not. First, you need to check. Then, whether such information is appropriately classified, proper classified. Then, for this purpose, auditor shall evaluate whether comparative information agree with the amount and other disclosure present in the prior period. That is, previous year audited financial statements was there. See, previous year audited financial statements 23-24 last year's, and that figure then current is that same figure given this year also as previous year. Last year financial statements sort of figure is given as the previous year and current year. Whether this amount or that amount is the same. Copy panna the problem on the tail. That's it. Only thing you have to check. Then, where the accounting policies reflected in the comparative information are consistent with those applied in the current period. Last year, example, revenue recognition policy was something. Current year, whether same revenue recognition policy is followed. Accounting policy change in the last year and this year. That thing you need to see. If there are any changes, see whether they are properly accounted and adequately disclosed. Okay, then corresponding figures. Corresponding figures are definition. Comparative information, corresponding figure is also called comparative information. I told you, corresponding figure. Comparative information where amount and disclosure for the prior period, last year amount and disclosures are included as an integral part of the current period financial statements. Integral part, like a series, everything exactly like the same. Sorry, this is corresponding figure, right? Included as a integral part of the current, like you have included that is only for read-only purposes. Read-only purposes. It is not that detailed. You are just using corresponding figure for just comparison purposes. The level of detail presented in the corresponding figures is dictated primarily by relevance to the current period figures. It will not be that detailed. Very limited detail will only be given. What is audit reporting for corresponding figures? For corresponding figures, when corresponding figures are presented, audit opinion shall not refer to the corresponding figures except in the following cases. That is, in these cases only, you will give Audit. Normally, I told you, current, our audit in comparative financial statements only, we will give audit opinion for the previous year. Also, normally, current year audit opinion definitely will be there. If you are giving comparative financial statements, audit opinion will be given for that one also. Comparative financial statements also. But if you are giving corresponding figure, audit opinion will not be given for this. Normal audit opinion will not be given. But in these three cases, a reference to the audit opinion will be mentioned. In the moon case, it's not like an audit opinion for the previous year, it's like a reference to that opinion. See what it is. If auditor's report in the prior period, last year report, included any matter which give rise to the modification is unresolved, then auditor shall modify the audit opinion on the current period financial statement. That is last year there was a problem, because of which last year's audit opinion was modified. Last year were misstatement and because of that last year's opinion was modified. That is previous years. And whether the same mistake is there in the current year also. Same misstatement in the current year. If it is like that, then current year opinion will also get modified. That is here prior period problem prior period financial statement was modified. So whether that same problem is unresolved, that is in current year also it persists. In that case, we will modify the opinion in the current year also. So basically, a reference to the opinion will be given. Like last year it was modified because of this reason. So current year it is also modified because of that reason. So here we are not giving any separate opinion for the previous year. No. Corresponding figures like I told you previous year, we are not going to give any opinion for the previous year. But in these cases, we will refer. The word is refer. We are not, just understand, we are not giving any separate opinion for previous year. We are not giving that. We are just referring. Current year opinion kodukkumbodhu, we are just referring to the previous year in these cases. Or reference model. We are not giving any separate opinion for the previous year. Understand this, please. Separate opinion varadu this one only this one. So this another cases are there. You just read it. Then, if the auditor obtained unmodified audit evidence that material misstatement exists in the prior period financial statement, of which unmodified opinion has been previously issued, all this is a simple sentence. Then, if the prior period financial statements were not audited, auditor shall state in the other matter paragraph. Last year statement audit illa. Imagine this year the company's first audit is this year. Last year it was not audited. In that case, auditor shall write it in the other matter paragraph that the corresponding figures in the side figures are unaudited. Current year, previous year, previous year audit pannala, it was unaudited last year. So auditor need to mention in the current year's other matter paragraph, previous years this was unaudited. Okay, then in that case also, one more thing. In such cases, such a statement does not relieve the auditor responsibility from obtaining audit evidence regarding opening balances. Because he is auditing it for the first time. Last year it was not audited. He is auditing it. He has responsibilities regarding opening balance. In the Madhuri statement, his responsibility will not go. Okay, keep that in mind. Then this one thing, sorry, this one sometimes also we'll write about this. If this is regarding this basis for opinion that you read it. Sometimes they can ask a question from this. Then, if the auditor obtains audit evidence that a material misstatement exists in the prior period. Last year, like there was a material misstatement on which an unmodified opinion has been previously issued. Last year, material misstatement irundichu. If material misstatement is there, then modified opinion should be given. But they gave an unmodified opinion in the last year. In that case, what has been previously issued, auditor shall verify whether the misstatement has been dealt with as per the reporting framework. Current year dealt idja. If not, auditor shall express a qualified opinion, adverse opinion in the current period. Last year there was a material misstatement, but last year unmodified opinion was given. See whether that material misstatement is gone or not. If it is not gone, then current year you give a modified opinion. I think my pen is gone. Energy on the time when I'm getting that energy kick in teaching, you lose all these things. Sorry. Okay. Thank God. Bye. These are things that are earning me money, like earning my living. These things, iPad, this pencil, books, all these things. So we need to. Okay. Basic things. Okay. Whatever it is, was these three things, this 1, 2, 3 point you have to keep in mind. Okay, then I told you. Then comparative financial statements, I told it's like the current year itself, different opinion, audit opinion, all these things. Then prior period financial statements audited by an predecessor auditor, you have to look at this. That is okay. Auditor branch accounts. Auditor branch and SA 299, 600, all these are very easy area. You can, it's when you read it, you will get understand. Two things. One more thing. 143 reporting requirement as per 143. One minute, guys. Joint auditors 299 is very easy. You can read it yourself. 600 using the work of another auditor is applicable. This is an essay, right? Don't miss it. Then this one area. This one. 143.3 section as per section 143 of the Companies Act. There contains a reporting requirement of auditor of a company in the form of some duties. He has a reporting requirement relating to this. What is that? Duty, this is basically, understand this. This things is very easy. This is just a duty to inquire only. I have specifically written these are the duties which he need to report. That is, these are the things he need to report in his audit report. Write about these things he need to write in the audit report. These things he just need to ask the manager and get evidences. If necessary, he can write about this, but this is not mandatory. So that is why this is duty to inquire. If he want, he can report. If any issue is there, this is mandatory duty to report. Auditor need to check all the item. If the problem, he need to report about this. I'll explain this. Wait. CARO is also coming. CARO, I don't think we'll have time in this. CARO is very easy. Marathon, like full stretch we need to go. It speaks very fast. Normally I can speak very fast, but marathon, like when you're doing it continuously for hours, it's because I'm not just recording this topic. I have other classes and I was recording some other topics from the morning. So when it comes like that with this, my sound is completely gone. Okay. Duty to inquire and duty to report. So these matters auditor need to inquire. What are the things? Auditor shall inquire into the following matters given as under. These matters. What are those matters? Whether loans and advances made by the company in the basis of security. We took security from someone and we gave them loan. In that case, see whether the terms on which they are made are prejudicial against the interest of the company. All these are basic. See whether transactions represented merely by book entries are prejudicial to the interest of the company. Basic things. It's like all these things when you read, you will understand. That is why I'm not focusing. Like, all things which you not understand or which are complex, I am moving. So if you studied auditing 1 or 2 times, just attend this marathon. You'll get refresh the concepts again. All the things you know, you can go for exam. So these things. So auditor is not required to report on the matter specified in subsection 1. This matters auditor don't have to report, but unless he has to give some special comments to make on any of the items referred there. If he wants, he can report. If he is satisfied as a result of inquiry, no further report. He need to ask management about all these things. Management, whether any loans or advances you have given, and is there anything prejudicial to the interest of the company? Ask. If they're saying no, and you got the audit evidence also no, okay, then no need to report. You're satisfied. Satisfied, Allah, the problem irunda, you can report. It's your wish. Okay, this matter. But these matters you need to report. Whatever happens, you need to report. These are also easy. It's very simple things. See whether he has sought and obtained all the informations and explanation that are necessary, whether books of accounts have been kept, then report on the accounts of any branch office, whether company balance sheet and P&L are in agreement with the books, the simple things. Okay, whether accounting standard is followed. They see whether this reporting requirement is there in the financial, okay, see, reporting, see 143 mandatory items, that is duty to report level items. See those items, whether he has obtained all information and explanation. Same sentence is there, right? See whether proper books of accounts are kept, whether balance sheet P&L are in agreement with the books of accounts, whether SFS comply with Indian accounting standard. All these things, whatever is there, everything is there here also. Okay, so that's it regarding audit report. Okay, reporting on fraud. Then this one also you have to read. If fraud is above 1 crore, you have to report to the central government directly. If fraud is below 1 crore, you have to report to what is board of directors or audit committee. If audit committee is there, to audit committee, else to the board of directors you have to report and include about that in para 11 of clause 11 of para 3 of CARO. So that is reporting on fraud. This you have to keep in mind. MCQ chance will be there. Then reporting under CARO is applicable to these companies. It is easy. And I'll give you one technique. Many students will have their own techniques to remember CARO. I'm not going to explain all the clauses in detail. I'll give you a technique to memorize CARO entire completely, because CARO is directly easy. Like for example, proper records. Whether proper records regarding the kepta illa. If company has not kept, you need to report under this heading. Then as per clause 1, as per clause 1 or as per clause 1A of para 3 of CARO 2020, BP has not been, records has not been kept regarding BP. Like that you need to report in the audit report. That is CARO. This is a mnemonic. And this mnemonic, if you learn, you can when the moment the question comes, you can think, okay, PILAG CDC, sure money fraud, Indian NRC, REMA TQ. You think like that, what happens is, in a clause, for which clause comes under which number, the clause number, remember, will be very easy. Because it is coming under C, cost record. So 1, 2, 3, 4. So it is 4. Fourth clause. Like that, you can easily remember. That is one technique. For example, I'll show it to you. This is one CARO chart that I used to give in class. But this with just the marathon, I don't think you will be able to get it, grasp it. You can follow your own method. But like CARO, it's very big. You cannot. This is chart that I used in final, CA final. This one you can use it. Same thing. So when I studied, I was using. So the mnemonic is PILAG, P-I-L-A-G-S. PILAGS is a name. PILAGS CDC, that is his name. It considers a name. Just consider this as a name. PILAG. A North Indian person, his name is PILAG. Bihar or Orissa. Just think. It's example. PILAG CDC. CDC. PILAG CDC is his full name. PILAG CDC is a sure money fraud. Sure money fraud. Romba fraud. Because you can see in this places like the scammers people, especially Madhya Pradesh area. I don't have anything against Madhya Pradesh, but at least 0.01% of people there are doing the scams, and the entire state is getting bad word, like bad comments, because the scam, like online scam, calling US people and scamming, sir, we are calling from America, like the Microsoft, and give me your bank password, like that. Cheating. You have seen that scammers pay back something. The YouTube channel is there, go and see. So the people, when they track the location, most of them is coming from either Ahmedabad area or the Madhya Pradesh area. So yeah, PILAG CDC is a person. That guy's name, scammer's name is PILAG CDC. He's a sure money fraud. And a girlfriend. That is, he has a boyfriend with him. Like not a boyfriend, like a friend with him. His name is Nitin, N-I-T-I-N. Nitin NRC. That is his name. PILAG CDC, Nitin NRC, and REMA TQ. These three people are doing a fraud together. I'll draw this so you'll get the idea. So PILAG CDC, P-I-L-A-G-S. PILAG CDC is his name. Two friends. One friend is Nitin NRC and REMA TQ. These three people, PILAG CDC, who is PILAG CDC? He is a sure money fraud. PILAG CDC is a sure money fraud. Nitin NRC, REMA TQ. If you know this abbreviation, not like mnemonic, your entire CARO is sorted. I will show how. See, PILAG CDC. Here, if you see all the capital words, the capital words are new clause. This is clause number 1, clause number 2. LAGS. This is one full word. Loans, advance, guarantee, security. LAL, C, D, C, S, U. RE is a single word. Money, fraud. This is single word. See, PILAG. P means proper records. Whether company has maintained proper records regarding PPE. PPE proper records whether company has maintained regarding the quantitative details and situation of the PPE and regarding the intangible assets. Proper records. That is the thing. You cannot put P as PP because it's intangible assets. So whether company maintained proper records. So question, if it is said that somewhere proper records has not been maintained, immediately think it is clause number 1. PILAG, P. And one question, like sometimes it is coming something related to cost records. You won't know which clause number is cost record. So there you can see PILAG, P-I-L-A-G-S, C, 4. Like that. You can say select CDC. So first C is not compliance with 185, 186. Sixth C. That is cost records. Like that you can easily remember. This is very easy. CARO is very easy. I'm not going to explain everything because it will take me another 1 hour. So if you want this chart, because CARO explaining takes 1 hour or 30 minutes. So that if you want, no, I think CARO most of you would know, right? And everyone knows that there is nothing to go deep. I'll just explain the big things if you want the proper records. This chart, if you want, you can get it from my Telegram channel. It will be there and you can write it in your own way, whatever You want, you can do that. This chart, the thing is that I used to stick this chart on the wall and recall CARO from this. Proper records. I enter CARO, I just close my eyes and feel like it is a P, what was the proper records, okay, what are coming in proper records, 1, 2, 3, 4 things, okay. These, when I see this, I can remember what is that. So completely I close my eyes and sit and recall CARO close from 1 to 0. 1 to like end, 21, around full. So that this chart will be here. Whenever I feel stuck, like after these 2 points I feel stuck, immediately I'll close my, open my eyes and see, okay, the point in the title leads, okay, whether the title leads is in the name of the company. The question the title lead name of the company illa. That means that is this clause is applicable, like that. Then revaluation of PP, if there are changes go more than 10%, then you have to specify the, you are revaluating and the change is more than 10%, you have to, what happened, I put a step this. Okay. If it is more than 10%, you have to. Okay, some issues with the CARO page. Yeah. CARO, you can do it your own. This chart is there in the, because it's just reading and it's very easy to understand. Nothing complex is there in the CARO. Reading and understand. And if you need the chart, you can take it from the Telegram. Anyways, join the Telegram and be with me, because you'll anyways get really good notes regarding auditing, inter or final, if you go to final. Because notes making is one process that I love the most. Every day I will sit and make small charts, notes, all this. So I'll put it there. If you want, you can take it. It's just free, right? What is the problem? One note may not be useful for you, but another note may become useful. So obviously join the Telegram channel. That is one request only I have if you are watching this till here. And just like, if you're liking the marathon, at least if you learned something, just give it a thumbs up. That's it. Okay, so CARO is also done. So our chapter number, this is done. Then now we'll go to chapter number 9, that is audit of different types of entity. Yeah, I'll speak about that in next, like, we'll cut the video, let me have water, then come back. Audit of banks, basically audit of banks. And this is one of the chapter, I think this is the, after chapter number 3, this is one technical chapter. One of the technical chapters where you have to, because chapter number 9, like it's a very big chapter, you feel like different entities, or chapter number 5, that is this one, financial statements. Both of these feel like a very big chapter, but there are no big concepts in the chapter. It's just reading, understanding. The game is with the memory, constructing mnemonics and memorizing it. That is a game. Like a very little area is there to understand too much. Like when you read it, you will easily understand. You don't need a faculty there mostly. But bank audit of advances, that area definitely you'll need a faculty, because you need to understand many terms in that. So that is a game. So that is where we are coming in, and I'll say, as like we did in the other chapters, we are focusing on the tougher areas. What are the different types of banks? It's very easy. Commercial bank, the bank which you see outside your home, like the SBI, all these banks. Then regional rural banks, banks in the rural areas. Then cooperative banks also you see. Then payments bank, the new banks like the Airtel Payments Bank, all these things, Paytm Payments Bank, this thing. Developmental banks, the banks which provide funding for infrastructure development, for the construction of a shopping mall, a bridge or something, SIDBI, all these banks. Then small finance banks, then RBI, regulatory body. These things are simple. Let's focus on the advances. That is where the concept lies in this chapter. Different types of bank audit report. This you have to just don't think of the concept, just the name you just keep in mind. For 5 names you need to keep in mind, and other names you just read and go. Like that. For example, LFIR, report on compliance with SLR requirement. That is this auditor after doing the bank audit. Statutory central auditors, these are the people who do the bank audit. Normal auditors, it's like bigger people. Statutory central auditors, chartered accountants itself have to furnish the following reports in addition to the main audit report. Main audit report, always they need to furnish these things along with the main audit report. That is one point. Okay. Then this is bank audit approach. Just read, not that important. Then engagement team discussion. Like in every case, before we start the auditing, we'll have an engagement team discussion. Audit team's discussion will be there. That is this one. Then engagement team discussion. One more thing. Here, normally engagement team, chartered accountant will be there. His articles, his staff will be there. And here, just understand the experts will also be there. If you are hiring any expert for bank audit, that expert is also included in your engagement team. Okay. Experts contracted by the firm for any work. You don't know how to value the gold or something in the land. So you in the bank or bank audit. So you hired an expert who is your friend, who is an expert in this. Okay. Then engagement team discussion includes a discussion about errors that are likely to occur, errors that are identified in the previous year. These things need to maintain professional skepticism throughout the audit, mean to become alert. Then method and audit response, simple these two. Then advantages, it's very easy. Then income recognition, if it becomes, that we'll learn now. Wait. Eligibility, same eligibility. Then who appoints the auditor for a banking company? AGM of shareholders. They at the AGM they appoint the auditor. Shareholders appoint the auditors at their AGM. In the case of a nationalized bank, appointed by the bank concerned acting through a board of director. Then auditor of a general regional rural bank, RRB to be appointed by the bank concerned with the approval of the central government. Let me ask you one question, whether SBI is a nationalized bank or not. SBI, you see it like a nationalized bank. Is it a nationalized bank or not? You write your opinions in the comment box. Just like, I'm not going to say anything. Go research, find out and write. And let's say also think why it is like when you are searching on ChatGPT somewhere, just see why. Then remuneration of the auditor. Remuneration of the auditor of a banking company is fixed as per the provisions of normal act. Then remuneration of nationalized bank fixed by the nationalized bank and SBI. If SBI is a nationalized bank, why would they say it separately? It is not a nationalized bank. Some provision is there relating to that. I'm not going to say that. The act was before all these things are there. You just go and find out yourself. So then you'll never forget that. That is why I'm just saying. Okay. Then powers of the auditor, it's same powers. Audit report, just read it. It should be true and fair transactions, simple things. Then LFIR, you read it. Reporting of fraud, any fraud you suspect, you can report. Those things are easy, but this you have to keep in mind. Sometimes they can come as a question, but it is easy. Conducting an audit, this one you just read and understand it. Head points you just keep in your mind. You don't have to memorize everything. They will never ask a question or initial consideration by statutory when conducting an audit. Like around points, lot of points are there to write. Initial consideration, even if the head points you keep in mind. 1, 2, 3, 4, 5, 6, 7, 9 is there. Question comes, write 5 and come. Head point with the declare in writing. In this, these things are everything. These things are basically the same thing which we learned till now. Initial audit engagement, whether SFI is fight and followed. Assessment of engagement risk. I told you what is engagement risk in first or second chapter. Then establishing the engagement team, understanding the bank and its environment, SA 315. All these things. And the only two important things which you need to keep in mind is this one, and this one. Planning is very easy, nothing. SA 300, SA 220, SA 210, as per SA 300. Simple. So this three you have to study. What is this? Declaration of indebtedness. RBI has advised the bank before appointing auditor. Auditor need to submit a declaration of indebtedness. That is, auditor should not be indebted to the bank. Auditor should not have taken any big money, any big loan or something from the bank. So if it is like that, he cannot do the audit of bank. He should not be indebted to the bank. Bank need to obtain a declaration of indebtedness. Situation of owing money. Then this one, internal assignment by the statutory auditor. That is, internal auditor cannot be the statutory auditor. Simple as that. You read, you get it. Then communication with the previous auditor. I am going to audit the bank for the first time this year. Last year there was an auditor. So before I start my work this year, before taking the appointment, I need to communicate with the previous auditor of the bank, last year's auditor. I need to ask them, bro, I am going to be this year's auditor. Do you have any objection? You got all your fees, everything right. You tell me what was important, things like that. You communicate with the previous auditor, and you have to obtain a NOC, non-objection certificate from the previous auditor. That is, he don't have any objection in you doing the audit this year. You have to get an NOC. Then only you can start the auditing. Okay, then these things are easy. Then again, discussion, audit planning, memorandum, all these things are easy. Then that's no problem. Now let's go to what is trust testing? MCQ can come. Trust testing. A software. Bank got a software that can handle. Imagine this is a hypothetical example for your understanding, so you'll never forget this. MCQ it may come. Imagine a bank got a software. It can handle in a minute 1,000 data, 1,000 customers' data. It can handle in a minute. Example. That is the thing. Stress testing means bank will put 1,500 data onto it just to check it's whether that thing is working properly or not. Can it handle the extra stress? Normally 1,000 data can only be handled by that software, but bank may put some 1,300 data just to see how much stress it can handle. If 1,300 data, if it can handle, that means the software is good. If sometimes tomorrow, because of the traffic, some 1,200 comes, it's not a problem because it can handle 1,300. So it's like to be on a safe zone. Imagine you are buying a chair and it is said that the chair can handle a weight of 100 kg. Imagine you are 90 kg. You may not buy that chair. But if there is a chair which says it can handle the weight of like 120 kg, you will buy it. Why? Because that extra, you know that you are only 90, even if your weight increases tomorrow, it will go till 100 only. And that can handle 120. That is here we are just checking it, stress testing. But software can handle only 1000 data. But bank will put some 1300 data into it and check whether it can handle 1300. If it can handle, that is called stress testing. Extra 300 we are putting, extra stress we are giving it. And see whether it can handle. If it can handle, it's a good software. Like we can rely on that. Daily problem like 1,200 data it can handle. Okay, that is stress testing. It's a software testing activity that defines the robustness of the software by testing beyond the limits. Beyond the limit, 1000 was the limit. We put it beyond the limit. Done by the bank, and the auditor has to see whether they have done the stress testing or not. Stress testing is particularly important for mission critical software, most important softwares. But it is used for some type of software. RBI has required that all the commercial banks, ICICI, SBI, HDFC, all these banks shall put in place a board approved stress testing framework to do this. RBI has advised all the commercial banks, MCQ, commercial banks only need this stress testing framework. And the auditor has to come and see whether that bank which he is auditing has put this stress testing framework. I am auditing ICICI. So ICICI and the stress testing framework, that is what I am checking. Got it? Okay. Then Reliance on controls. This is a question, you can study it. It's easy. Then now we will go to advances. Here onwards it is, conceptual, very conceptual. Advances are money or credit given as a loan. Advances means a loan given by the company, given by the bank, given by the bank. A bank gave a loan to that person, that is what we call advance. Loan given by the bank is an asset to the bank. Okay. It is an asset to the bank. We are giving loan. It is basically like an asset to the bank. Because our bank give loan, get interest from that, and that interest is bank's profit, right? That's bank's money, bank's income. I'm going quickly, only touching on the concepts. Two types of advances are there. Funded advances and non-funded advances. Funded loans means the loan which bank give as in terms of money. He asked me 10 lakh loan, I'm giving 10 lakh loan. That is funded loan. Non-funded loan means he asked me 10 lakh something, I'm giving him a help worth of 10 lakh. 10 lakh loan kodukale. I'm giving him a help worth of 10 lakh. Help worth of 10 lakh. For example, one customer, he needed 10 lakh rupee to procure a loan, procure some raw material. Bank is not going to give loan. He goes to one person, procure the raw material from that person. He bought the raw material. So 10 lakh and bank will give a guarantee of this customer for this customer to that person. Imagine this is bank, this is customer, this is the supplier. Customer needed 10 lakh loan. Bank is not going to give 10 lakh. Customer bought a raw material of 10 lakh from the thing, and the credit period given is 6 months. In the 6 months, the bank will give a guarantee that if customer does not pay in the 6 months, I will pay it in the 6 months. This guarantee is basically like a money, like a loan. Customer got 6 lakh for 6 lakh for 6 months, 10 lakh for 6 months. Then here we are giving the guarantee. Just the guarantee. If customer does not pay, bank will pay. Like that. This is non-funded. We are not giving any fund now. We are just giving the guarantee, and it seems like fund. Okay. Okay. Then what are the different types of advances? Term loans. Loans that are given for a specific term. 5 year, 10 year, 3 month, 1 month, all that. Cash credit to overdraft. What is the difference between cash credit and overdraft? Both they look the same. Overdraft is an extension of the current account. Company may have a current account in the bank, company or client. And the current account order extension. Current account means if this is a current account, this is 0. You can only withdraw money that you have put in, that till 0. But if you take an overdraft facility for the current account, if overdraft limit is say 10 lakh, you can withdraw negative up to 10 lakh. That is overdraft. And overdraft is normally given as a security against this fixed assets, any property, or sometimes against stock or debtors. Cash credit means it is not an extension of current account. It is a separate facility. That is separate facility. Gold loan is separate facility it is. This is a separate facility. You can take a cash credit limit. Here what? You will give your stock statement or debtors details to the bank. Other basis, they will give you a cash credit limit. And every 3 months or like in the quarter, you have to revise what is a revised new stock statement that you need to give to the bank. And based on that, they will change your drawing power, sanction limit, all this. So you gave a stock statement worth 10 lakh to the bank. So bank will do the calculation and bank will say, okay, bank will need a margin. So bank will say your sanctioned limit is 9 lakh is a sanctioned limit you can use as cash credit. And in that you can now, as of now, you can only withdraw up to 8 lakh only. That is your drawing power. But you have a sanctioned limit of 9 lakh. But withdrawal 8 lakh mattum podu. This is the maximum amount up to which you can withdraw cash credit. Then bills of discounted and purchased, then interest bearing staff loans. These things are also there. Got it? Yeah. Okay. Then what are the legal, then what are the classification of advances? Advances can be classified sector wise. You gave loan to different people like agriculture sector companies, MSMEs, education companies, priority sectors, like all the sectors you give. You can classify the loans given based on different heads, like okay, all the education loan comes in this category, all the housing loan comes in this category, like that. Classification you can do by sector wise or security wise. Whether when you give loan, you will take collateral from them, a security from them. So on the collateral basis, you can do the loan. Then nature of security, primary security, it is the first security you give as a loan. You take for a loan. When you are giving a loan, first security you are taking, first model, for 10 lakh loan you are giving, you will take his house, the stamp paper, like the title deed, worth 15 lakh house, then you will give a 10 lakh loan, right? That primary security, that is a primary security. Collateral security is some security that you are giving as addition. You took a 15 lakh worth of property and you give that person 10 lakh rupee as a loan. That 15 lakh is security. But before, like after 1 year, some issue happened and property value got down to 6 lakh. But bank will still loan above like 9 lakh, 10 lakh loan. So now you need an extra security for your security. First the model security value kammi. So that to protect, but the loan still is around like 10 lakh loan still spending. The security was 15 lakh, but 15 lakh security value go to 6 lakh because of some earthquake house completely demolished. Or some like example, not earthquake because of some reason. Not earthquake you don't consider because of any issue. So now bank needs an additional security to cover up that loan. So that is collateral security. Bank will ask, bro, I gave you 10 lakh loan for your 15 lakh security, but that security is now only value till 6 lakh. My loan I have given is now still pending, it is like about 9 lakh. Give me one more security, give me a car as a security. Like that he will ask. Okay, then what is a mode of creation security? That I'll just show it to you. Mode of creation. Okay. Mode of creation of security. This is a mode of creation of security. I'll quickly go through it. You cannot spend like more than 1 hour in a bank audit, but bank is very important. Bank is very important. Because it's just simple. Bank is actually very, very, very easy. Your way of learning it is making it complicated for you. That is a problem. Learning bank is very easy. If you know the meaning, it is like nothing is there in this bank. Just it's like a process. It's learning tax. Like learning tax. Process, just remember in your mind. Then all it is easy. First is mortgage. Mortgage means you are giving an immovable property. Client customer is giving immovable property as a security. Land or building. Immovable property as a security and taking loan. That is mortgage. Mortgage le 2 types. Registered mortgage, equitable mortgage. Registered mortgage le, here you are not giving any title deed. You have a property, you need to take a loan from bank. You only give the title deed to the bank. And writing, you only give the title deed to the bank. In title deed mattum loan that is equitable mortgage. Registered mortgage means what you do is you sign a formal mortgage deed, like an agreement with the bank. Here also basically title deed varum. Nowadays they take title deed and they also ask the agreement also. But just understand, here instead of equitable mortgage, instead of a formal agreement, you give your title deed and bank will give you the loan. Title deed of house and bank will give you the loan. Here and this is not happening now. This is basically like the old age, like the rural areas, like there was smaller people banks like that were there. poor people will give their house property, like title deed and take money. That was this thing. But nowadays, modern banks operate on this basis. They'll take your title deed also, but in this case, instead of title deed, you are getting into an agreement with you, and the bank will be getting into an agreement, and that is happening in registered mortgage. Normally, title deed will not be given. Here, title deed will be given. That is mortgage. Here, the main game is immovable property. You are transferring immovable property and taking loan. Then what is pledge? Pledge is borrower. Borrower gives his goods to the bank. Goods. Goods giving is to the bank as security. For example, I have a gold. I pledge the loan. Here, imagine, immovable property, bank cannot take it and put it in the bank locker. Here, this is still with us. The possession is still with us here. But here, gold loan, you are giving gold to the bank. Possession goes to the bank. Possession goes to the bank, but ownership is yours. It's in your name, but possession goes to the bank. Gold you are taking the loan. That is pledge. You are pledging your security there and taking it. Ownership is still with the pledger. Bank has certain rights only. Then next is hypothecation. It is similar to pledge. It is very similar to pledge, but you don't give the physical possession of goods. Physical possession. It's similar to this one, but the problem is that here it is immovable property only. Here movable property then, but you are not giving possession to the bank. Here it is immovable property and you are not giving possession to bank. Here it is movable property. See, physical possession of goods. But you don't give physical possession of goods to the bank. See, a car loan. You take a car loan. Car is with you. It's a movable property. Car is with you. Possession is with you. Ownership is also with you. But bank has rights. That is hypothecation. Just see. Here immovable property only. Possession is with you. Ownership is also with you. But agreementally they have given it to you. Give to the bank. Pledge we give the goods. Possession is with them. Then bank, but ownership is still with us. Hypothecation, ownership and possession both are with us, but loan bank has certain rights. Then assignment, transfer your rights in something to the bank and bank will give a loan. You have rights over something. You have a rights over a life insurance. You have a life insurance policy which is nearly reaching maturity. 10 lakh rupee. You are giving that policy to them, and other 9 lakh you are taking as a loan. So life insurance policy. Here you are giving something, assigning your right. Life insurance policy means you have the right to receive money on maturity, but you are assigning that right to the bank. In the bank, you are taking loan. Okay, you are giving that right to the bank. Bank, policy, you take the money. Give me 10 lakhs now or 9 lakhs now, like that. Life insurance policy transferred to the bank, and the right to receive money is assigned to the bank. Okay. Then set off. Set off means you have a loan to the bank. You have like one loan is there that is pending outstanding. But 10 lakh loan you have taken from the bank, but you have not repaid. So 10 lakh is pending. Another time, at the same time, in your FD account, in your deposit account, or in your savings account, there is another amount of say 6 lakh is there in your savings account. They can set off this. Number 10 lakh we have to give it, but in your savings account there is 6 lakh rupees there. They will set off this and will show that in now pending is only 4 lakh. That is set off. Bank has a right to use your money to pay off your debt. Your debt is there, and bank account money. So they are set off both. Setting off your debtor and debit and credit money. Then lien. Lien means legal right to keep someone else's property in your possession. Or legal right. For example, car workshop. You gave your car to a workshop and told him, okay, do the work, and they do the work. And once they call you for money, you are saying, no, money I'll give it after 1 month. You give me the car now. He will not say, no, you give me the money, then I'll give you the car. That is, he has a right to lien. He worked on something. Imagine I gave this mobile for repair. So the repair guy worked on this mobile, right? So until I give the money, he has a right to keep this phone because he worked on this phone. That is lien. Auditor, earlier there was this thing. A normal books we can retain. The bigger books we can, like some serious important books, there is no right to retain now, I guess. Okay, leave this. Then write it to lien. Normal is like simple invoices, everything we can retain. Then overdue, categories of NPA and provisioning. This we'll learn from when that comes. This one. Prudential norms, income recognition, asset classification, and provisioning. When an account will become NPA, that is, see here, this is the case of, need to write, term loan. Term loan will become NPA when the interest and sum already for 90 days And then all these things are easy. You just read it. What is this out of order? Outstanding limits, sanction limits, and drawing power. All these things are easy. Then account remains out of order. This is in case of cash credit and OD. This is the NPA limit. In term loan, this is the limit. Then in case of bills, this is the limit. Bills purchased and discounted. That is, interest or installment remain overdue for more than 90 days. 90 days overdue in case of term loan, that will become an NPA. NPA means non-performing asset or loan. Bank loan you have given. I am a bank, I have given a loan. Last 90 days I have not received the money. EMI monthly. So that becomes an NPA. It's a term loan. Last 90 days I have not received any money. So NPA is just a classification for them. It's just a classification we are giving it to them. Okay, understand that. We are just giving a classification. So what happens when I take a loan, when I give a loan, last 90 days or 3 months he is not paying the EMI, I will classify that borrower's account as NPA, non-performing asset. There is proper monthly EMI, it's performing asset. This guy is non-performing asset. So what is this is thing. If it is an overdraft facility, another thing. First case I told you. Second case, I have given a cash credit or overdraft facility to one person. So if that cash credit or overdraft facility becomes out of order, if it becomes out of order, then it is treated as an NPA. Out of order item. When this is out of order. This is out of order limit. If the cash credit or overdraft becomes out of order, then it becomes an NPA. Then third thing, bills remain overdue for more than 90 days. And in the cash credit, when will it become out of order? See, when will it become out of order? Outstanding balance remains continuously in excess of sanctioned limit or drawing power. Outstanding balance remains continuously in excess of sanctioned limit or drawing power. That is, your outstanding balance is, say, you took a loan, you took cash credit facility of, say, your sanctioned limit was 10 lakh. Your drawing power was, say, 9.5 lakh. You took a cash credit of, say, 8.5 lakh and you have not paid it. So what happened is, after some months, your cash credit, along with the interest component will compound, right? So interest component, your outstanding cash credit amount, this 8.5 lakh became 10.2 lakh. So it will go up unless you pay. So this is your outstanding balance, your outstanding cash credit balance remains continuously in excess of these two. If it is like that, your situation is like, if a borrower's account is like that, I will classify, I am the bank, I will classify it as out of order. If out of order, it means that it becomes like an NPA. Out of order means it is classified as an NPA. Got it. Then, in case where the outstanding balance is less than the sanctioned limit of drawing power, but no credits are continuously coming. Imagine this outstanding balance is less than, like, see, this is only the outstanding balance, 8.5. Sanctioned limit 10 lakh and 9.5 lakh is there. It is there. Now what to do? But no credits are coming continuously for the last 90 days of credits. Still, the outstanding balance is only 8.5 lakh, but this guy is not repaying money he has taken. So in that case also it becomes out of order, so NPA. Another case, credits are there, like in the 8.5 lakhs, and he has paid credits. Imagine he has paid 60,000 money he has paid. But in the 8.5 lakh, in this 8.5 lakhs, imagine for 2 lakh is, say 1 lakh is basically interest. 7.5 lakh is only outstanding. And he is paying only like anything like 60,000 or something. That is, this amount is not even enough to recover the interest also. That is credit. He is paying, the outstanding balance is there. It is less than this, but credits are there. He is paying 60,000, but it is not enough to cover that interest debited. Interest debited itself is 1 lakh. This cover cover. In that case also it is treated as out of order. Out of order. If it becomes out of order, it becomes an NPA. Got it. Then example is there. Then overdue. Basically asset category, 4 categories here. If an asset, I have given a loan to someone, that means it is an asset to the bank. Overdue. Overdue means basically 4 types of asset. I have given a loan to someone. I am the bank. Given a loan. If everything is paying perfectly, correct IMI, it is called as a standard asset. That guy is called as a standard asset for me. In my balance sheet, that guy is like a standard asset. He is paying perfectly. Like loan given means here, bank loan given is an asset. So that guy is a standard asset. He is called as a standard asset because he is paying everything fine. Second thing is substandard asset. That is, that person became an NPA. NPA ആയിடுச்சு NPA for less than or equal 12 months, like NPA ആയിடுச்சு but 12 months ആണ്, below 12 months NPA ആയിരുന്ന he is called a substandard asset and I'll put 15% provision for him because NPA like he is not paying anything for the last 12 months, so it's like sometimes he will not pay, so for bank it's a problem, so I'll put a provision of 15%. அவங்க கொடுக்கல அவங்க டெட் ஆகி போச்சு or எனக்கு அது போச்சு, I don't know. Then if it became NPA for more than 12 months up to 1 year doubtful ആയിരുന്ന it's called a doubtful asset, substandard category, it becomes doubtful. So we will put if a secured loan ആയിരുന്നാൽ his security is with us, in that case we will put 25%. If it's unsecured loan 100% provision. Similarly if it's 1 to 3 years this then loss asset that is more than 3 years they have not paid any money to the bank, continuously NPA irukku, in loss has been identified by the bank or amount has not been written off fully, in this case 100% provision you have to put. Then one more thing, classification of NPA is borrower wise not facility wise. I have taken 5 loans from a bank and 4 loans I have paid everything properly, but 1 loan I have not paid, or car loan 3 car loans irukku, 2 home loan irukku, I have paid all the 2 home loans perfectly and 2 car loans also I have paid perfectly, 1 car loan I have not paid perfectly, like NPA irukku. If one account in this 5 loan, I have 5 loan in the bank, this 5 loan is kept as a separate 5 account for them in the bank, but if there is 1 NPA all the 5 will be treated as NPA, because NPA, if a borrower turns NPA, it's like NPA is based on the borrower or account NPA ana ella NPA, like that. So asset classification would be borrower wise and not facility wise. If one loan you don't repay that 1 loan, it become NPA, all the loan you have taken will become an NPA. See, Mr. Raman has availed 2 facilities, a car loan and a housing loan. Car loan la EMI ellam proper due pannita, and hence in this case not only the car loan but the housing loan will also be treated as NPA. Like sorry I forgot to read in between, a car loan and a housing loan, and he is regular in depositing the housing loan EMI. Housing loan he is proper, no problem, but car loan proper katega. So in that case car loan becomes NPA, but along with car loan housing loan also becomes NPA, because asset classification NPA, that classification standard or substandard, the classification is borrower wise not facility wise. Enna loan la kadai. Okay, accounts regularization near balance sheet date, that is what the people do is that I have a loan with bank, I am Adani or Ambani, bigger people, and I don't want my account to be an NPA and my credit score will get dropped and I have bigger problems. So I'll take loan, I'll not repay for 3 months, just 3 months aga pora time le balance sheet date end balance sheet date agara time le, imagine my 3 months period ends on 31/3, if I don't repay till 31/3 it becomes NPA, 90 days I do. But just before that 25 March I'll go and deposit some money, so what happens, it never became an NPA. Okay, then April 4th once the balance sheet is done, my account is not NPA because I paid everything properly. Then once the balance sheet is done on April 4th or April 5, 6, 7, in the immediately shorter date I will take back that loan from the bank. I'll have tie up with the bank manager, bank will manually give me that loan again. Then I'll put for another 3 months run pannu, 3 months NPA aga pora time I'll immediately change it. And normally this NPA classification, everything, balance sheet date NPA classification is important because that comes in the balance sheet. So closing time NPA aga pora items immediately they'll pay, NPA tag poidum, then after that financial year end that same loan will be issued to the same person by the bank, so NPA problem he can get the fund. So what happens is Adani NPA agra time he'll arrange a fund from somewhere, he'll take some vatti palisha, like that, all these things. This is you say this in Kerala we say like vatti palisha, like for bigger blade rate we take it. So they will take the allocation money, deposit in the bank. Okay, it is not an NPA. 5 days after 5 days he'll take back that money and give it back to that. Okay, that's interest component only he lost. His credit score, nothing is getting affected. That is account regularized near balance sheet. In auditor, what should we do? We need to check whether these kinds of thing is happening. Whether the repayment paid by one, like this is one case, but normally some genuine repayment will also be there. So as an auditor, we need to check whether this kind of fraud, like I told you, this kind of issue is there. Someone put money and take money in the next April 1st week. Just like that, we need to check. That is asset classification of borrower or few credit. I leave that where the account indicates an inherent weakness, it should be deemed as NPA. Any these kinds of things are there, make it as an NPA. They're trying to skip from NPA to doing by doing fraud things. Put it as NPA. Then auditor should check for the sample transactions immediately before the closing. What I told. like the closing munnadi 2 weeks what are the transactions happening, any loan repayment like that, and if anything is there like that, then go and see after like closing, like April 1st 2 weeks whether any loan given to the same person irka. Something is there, then it's like an arrangement to evade the bank. Government guaranteed advances, central government guaranteed, state government guaranteed advances. It is very easy, you read it, you will get it. State government guaranteed, it's just like state government guaranteed means it's just like normal advances. Advance is to be considered as NP if it remains overdue for more than 90 days. A simple thing. Central government guaranteed advances, because the guarantee is given by a central government, it is always treated as a standard asset, because but you have to check whether it is not, the guarantee should not be invoked or repudiated. That is, government should have not withdrawn the guarantee. Okay, so as an auditor, just check government guarantee panna advance loan for like I have taken a loan from a bank and government has guaranteed me. For me, government has been, central government has given the guarantee. In that case, for those kinds of loan, auditor need to check whether guarantee is still there, and that is always a standard asset and NPA, but regarded as NPA in income recognition purposes. That is, here the income will be recognized only when it is actually received. I will talk about that. Wait, that is coming. Okay, one more thing. And for here, provisioning is not required because it is guaranteed by the central government. Okay, here NPA asset classification, income recognition, provisioning depends upon normal cases. Then advances under consortium. Consortium means, imagine I am a contractor, builder. I need 1,000 crore rupees to build a shopping mall. I may not get the money, right? So what happens is that I am a builder. I am the builder. This is me. I need 1,000 crore rupees. I may not get this money from one bank. So what happens is that I need 1,000 crore is the money I needed. So I will take this 1,000 crore from 3 banks together, like in a consortium, 3 banks coming together and lending me 1,000 crore. And here one bank, 3 banks will be contacted. They, if you approach SBI, SBI will say, bro, I cannot give you 1,000 crore. I don't have that much money, but I will enter into a consortium with ICICI and HDFC. We 3 will come together in one agreement basis. We will give you 1,000 crores. That is consortium. 3, like not 3, more than 2 banks coming, 2 or more banks coming together and giving a single loan. So 1,000 crore he needed. So he approached SBI, and SBI, this is SBI. SBI told SBI, I will give you 500 crore. This is a major amount. Then another bank, SBI and HDFC contacted, and HDFC told SBI that I will give him 200 crore. And then ICICI is also there. ICICI gave him 300 crore. This is thing. And in this case, this is the bigger bank. A bank which has given bigger loan is what we call the lead bank. And here I will get into basic agreement with the lead bank. And EMI for this 1,000 crore EMI, I will be paying it to the lead bank. And lead bank, share like this. They're on their own share. And interest rate may be different for different banks. We don't have to learn all those things because it is not accounting. We are learning auditing. Just understanding is enough. In class, we used to put all the examples, practically how it works, everything we will so. But this is, I can do that in here like time poet. And the lead bank, that is SBI, would be responsible for the computing, the drawing power calculation, all these things, because they are the major shareholders. And the major holders in this may hold the major share in the loan given. In special circumstances, at the request of the borrower, lead bank may allot a higher or lower share of drawing power to the member. If you want to have a different share, you can request the SBI. SBI will give all these things, like lead bank. Consortium advances means loan advances given to a borrower by 2 or more banks jointly forming a consortium. So this is what we call a consortium, that jointly they are forming a circle. Okay, then when remittances by the borrower under the consortium lending bank are pooled with one bank, you are be paying EMI to SBI, and the bank receiving the remittance is not parting the share. Imagine I paid the EMI of 1,000 crore to SBI, but SBI is not giving it to HDFC, ICICI. Their own shares, they are here, they are not giving. In that case, what should you do? Is not participating with the share of the other member banks. Account should be treated as not serviced in the books of other member banks and therefore an NPA. That is, if I paid, imagine the EMI, monthly EMI is say 30 crore is a monthly EMI. I paid 30 crore to SBI. 30 crore SBI ko koduthitte. But SBI is not giving it's the share to HDFC and ICICI. Their own share they are not giving. In that case, in HDFC's and ICICI book, in their books of accounts, these two people's books of accounts, my account will be treated as NPA. Even though I paid the money to SBI, but it is SBI's problem. But still my account, the B builder's account will be treated as NPA. All these banks should enter into this. Basically, these banks should enter into an agreement and it happens like that. Okay. So you have to keep in mind then accounts where erosion value of security, you give a security to the bank. Like you gave a 10 lakh security to the bank and bank gave you a 6 lakh rupee loan. You give a 10 lakh property and the value of this 10 lakh eroding, that is what we call erosion value of security. It becomes some say 10 lakh gets reduced to 4 lakh. In that case, what you need to do? It's written here. It's simple. Like I cannot sit and explain everything, right? Time will be taking. So advances to staff given, agricultural advances long duration. For long duration crops, one crop season is NPA period, and for short duration crops, it is 2 crop seasons. Short duration, it is overdue for more than 2 crop seasons. Okay. Long duration crops means which has only 1 season in a year. For example, mango, I guess, right? I think mango is having only 1 season a year. So it's like a long duration crops. Short duration, banana or something, 3, 4, 5 crop seasons in a year. Then computation of drawing power, like I told you, drawing power, it's basically you give a security to the bank, you give any security to the bank. For example, this is basic equation. Drawing power is primary security minus margin. That is what we call. But we can say that it is, you can say sometimes that if you are giving stock as a security, primary security means you give something to the bank. You need a cash credit or an overdraft. Basically for cash credit, we are thinking cash credit, what is the security you give? You may be giving either stock or you may be giving your debtors. This is what we call, either of this or together of this is what we call primary security. So drawing power means this primary security minus margin kept by the bank. You gave a stock of worth 10 lakh. Bank is keeping a margin for their safety. They are keeping 1 lakh. So they are putting the margin as 1 lakh. So your drawing power becomes 9 lakh like this. So, but if you are giving debtors and in the question, if creditors is said there, if creditors are a question, then you have to less the creditors also from this. If question has creditors only, okay, if a question has creditors, then drawing power will be your stock plus if you are given debtors minus margin minus creditors if you have given anything. Debtors minus creditors, sorry. Let's put it like the debtors minus creditors, then margin. Like that you can say. And this is what we call primary security. You know that, right? Basic equation. The concept may change depending upon the question, how it is asked, what are the topics asked. Sometimes in overdraft, the thing is given against a security, like an asset or property or something. Stock, it is given against this one. A cash credit, stock is given, stock or debtor. Nothing to what is the bank's duty auditor statement concern. He need to update 3 months stock statement. I told you all these things. Then computational drawing power as per the guidelines by board of directors and auditors concern, all those things. Then stock audit to be done by the auditor, all this. At audit of advances, it is not that tough. Audit of advances, in doing the audit of advances, that is, you are the auditor, you are auditing banks advances given, bank has given loan, you are auditing that loan given by the bank. In that case, how it will come. Okay, it is easy. What is the stated basis? You check whether there are no unrecorded advances are there. Then see that advances means amount due to the bank only. Amount included in the balance sheet in respect of advances that are actually outstanding at the date. You have to check that. All these things are easy. You can study and how to evaluate the internal controls over advances. See the existence and enforce. All these things are easy. Nothing is there. Internal control. It's also, this is just read, you'll get it. Nothing is there. This one provision. Strong DP, cube review, credit worthiness. Credit worthiness, employees, the borrower, all these things. Simple, direct questions. Now we'll know how to audit interest, how to audit income. So in the bank, the structure of the bank, I forgot to show you. Sorry, guys. So in the bank, basically intro some basic audit procedure, all the basic things are written. Then comes the, I guess the structure. Okay, anywhere, let's see. Basically, the audit advances is the important area. Advances, audit of advances. This is one most important. Advances and audit of advance. We learned all the advances case. Then we need to learn about income. Income and audit of income. Audit of income of the bank. We are how to audit the advances of the bank. Loan given by the bank, how an auditor need to go and check it. How auditor need to check the income received by the bank. How auditor need to check the expenses of the bank. Audit of expenses of bank. This is a basic structure. This bank 4 parts are divided. These are things basic. Everything that is before advances, the basic things. Then comes advances, income and expense. You have to learn it like in the 4 chunks. Okay. Now till now we learned how to audit advances. Now we'll learn how to audit income. Okay. Let's see how to audit income of the bank. So basically bank, these are the incomes. These are the incomes for the bank. Income for the bank. Interest and other income. Basically these are the different types of interest. Bank will have, bank will discount the bills. There he will earn interest. Bank will give investments. There he will earn interest. Then other RBI things he will earn interest. All this. Then other income of the bank. These are commission for bills. These are different types of other income. Fees, commission, bank charges. Profit on sale of investment. All these are bank order incomes. How to audit that income? That is the main thing. Really important. You just read it. The materiality, the material income which you need to learn. These things are easy. Where is something? Let me see some important points on this. Revenue uncertainty. This one. If something becomes an NPA, you should not. Okay, this one. Okay. The simple. Any income which exceeds 1% is considered material, except the interest. All this. Then revenue certainty. Banks recognize income on accrual basis. Normally, the accrual basis are record pandrathu. But if it becomes an NPA, see revenue uncertainty. In view of significantly uncertain things, that is, it becomes uncertainty regarding ultimate collection of income arising in respect of NPA. Guidelines require that banks should not recognize income on NPA until it is actually realized. So, for account NPA ana, if it becomes an NPA on any date, all the from there on, normally for interest everything you used to record it on accrual basis. But if it becomes an NPA, you need to record it on 1 second, guys. Okay. Okay. Normally for banks you need to record income on accrual basis. The moment it accrues, you are recording it. But when it becomes an NPA, from there on you have to record it on this basis, like the realized basis, only when it actually received basis only. And one more thing, if something becomes an NPA, all the credits that are you have actually recorded, because see, everyone knows this, but for some students may not know this. I am teaching for them. Okay, this date it becomes an NPA. So last 3 months, these 3 months, this borrower has not paid any money, so on this date it become an NPA. But in the 2 months, 3 months, accrual route already you would have recorded these 3 months income, right? Bank interest income expected from that you would have recorded on accrual basis, right? In the 3 income, you have actually not received it. That is why it became an NPA this year, right? These 3 incomes are recorded, 3 months something may be recorded. So these 3, the moment from here onwards, you are recording income on realized basis only. But these 3 things you need to revise. These 3 you have recorded these 3 as income. Interest from the customer is per month, it is EMI interest is 10,000. Here also 10,000. Here also 10,000. You would have recorded as income. You need to reverse that. And the income reverse. You need to reverse it. Because it is an NPA, the money has actually not been received. Okay. And then advances against security in the see whether it is proper margin has been kept. You don't need to put it as NPA. Then bills purchased on discounting is things are easy. Then renegotiation. What is renegotiation? Bills purchased, etc. You know, right? The concept. You would have studied it from your foundation, journal entries, all this. Then renegotiation. What do you mean by renegotiation? Renegotiation is very simple. Renegotiation simply means the camera is a bit low. That is why my eyes are moving here and there. Okay, whatever. The renegotiation means any already a loan in this. You have a loan. I took 10 lakh rupees from the bank. And that the terms was first, here something is already written. Okay. Anyways, we'll use that and explain. Okay. I took a first loan from the bank initially as 10 lakh rupee. I took the loan at the rate of 10% interest rate for 10 years. I took it. This was my first terms. This was my terms. So EMI was 10k per month. This was my first loan. But what happened was next year 1 month I got some issues and I'm unable to repay the loan. My business got ruined or something. So I'll go to the bank and I tell the bank, bro, last few months I have paid the money, but now onwards my business is gone. So I have some issues. So I won't be able to pay 10k EMI per month. Can you do some favor to me? Can you just give me some relief? So the bank guy will say, no problem, bro. I will renegotiate your loan. 10 lakh itself. Like now some EMI would have been paid. So 10 lakh some amount would have been paid. So imagine that amount is, say, 50,000 has gone. So 9.5 lakh. 9.5 lakh wheel. 10% of interest, I'll give you 9% interest. No problem. But only thing is 10 years later, I'll put it as 20 years. 20 years you need to pay for 5,000. So like that. So this amount may not be correct. This is hypothetical example. So the terms have been renegotiated. The first terms was this. But since I was unable to pay 10k per month, the bank renegotiated the term and gave me a new term. But here I have to pay till 20 years. The 10 year 20 year pay but 5,000 money. So monthly at least 5,000 I can pay, right? 10 I cannot do. So like there are sometimes they'll reduce the interest or increase the interest. They'll do whatever it is. That is renegotiation. Fees and commissions earned by the bank as a result of renegotiation. So as an auditor, what are our responsibility? Our responsibility is to check whether proper, whether they have done or not. Renegotiation. Okay. So we need to check the fees and commissions earned by the bank as a result of renegotiation. Other accrual or rescheduling of outstanding debt should be recognized on accrual basis over the period of time covered by the renegotiated or rescheduled extension. Here, sometimes bank may earn a fee or this is first loan. Bank is renegotiating it and giving to us. So for this service bank is doing, bank will charge a fees of say 15,000. This 15,000 or whatever the fees, whatever the income bank is getting from this renegotiation, that income, fees and commissions, not the interest, fees and commissions like this, whatever bank is getting as income from renegotiation. Renegotiation, we have to pay the charges, that charges earned by the bank should be recognized on an accrual basis over the period of time covered by the renegotiated credit. Renegotiated credit 10 years later, 20 years, so 10 years extra. So this 1,500 should be recognized as an accrual basis for the next 10 years at that period of time. So bank, we don't need to overthink about this. The bank need to do this procedure. As an auditor, we just need to check whether bank is pannitya illa. Okay. Fees and commissions earned by the bank over the period of time covered by the renegotiated or rescheduled extension of credit. Okay. Then test check the interest earned by the bank for the sample selected. What is the interest earned by the bank for? Just take a sample and just do the test checking like that, two things. Then reversal of income, like I told you, if something becomes an NPA, all the income that has been recorded and credited but not received till now, this directly MPA. So the income that has been recorded, that is credited but not received, we have to reverse it. That is here. Then on leased assets, what is simple? Then takeout finance. What do you mean by takeout finance? Takeout finance means you need, I'll give a situation. Loan will be first, you are this. First you receive a loan from this bank. And this loan is now taken over by another bank. That is takeout finance. You took a loan from ICICI and after 1 year HDFC came and took over that loan from ICICI. Now HDFC paid to ICICI that full amount. Now you have to pay to HDFC. That is takeout loan. And why it happens? It happens basically for this property development. Imagine I'm a contractor. I need to construct a mall in Chennai, like a very big mall. And the mall needs 1,000 crore rupees. So this is my requirement. 1,000 crore rupees I require. What happens? The problem is that mall requires 1,000 crore rupees. But the thing is, I don't have a really big credibility or something. So I approached SBI, asked SBI, bro, can you give me 1,000 crore rupees? SBI said, my requirement is that I need 1,000 crore rupees for 10 years minimum I need, or say not for 10 years, because for 20 years I need this 1,000 crore rupees. Like 20 years is a term of the loan. If 1,000 crore and 20 years I will repay and finish it. At the rate of my interest expectation is somewhere below 10%, 10% max. At this is my requirement. I need 1,000 crore to construct the mall for 20 years loan at 10% interest rate. I approached SBI for this. SBI told it is not possible because you don't have a proper credit worthiness. Our internal controls checked and you don't have credit worthiness. So it's not possible to give you loan. If you can give me any security, 1,000 crore worth security kodta, I can give you the loan. At this rate, I will give you the loan. So SBI told, now you don't have any security. You do one thing. Go to HDFC. Go to HDFC. What they do is, they will give, without even with the security, they will give the loan. But in a guarantee, they will give the loan. They have that kind of a spirit. But interest rate is jada. But 2 months you have to repay it, 2 years. So, but you do one thing, you do take a loan from HDFC. SBI will say like this, you go take a loan from HDFC and they will give you 1,000 crore loan, but their interest rate will be somewhere like around 15%. But sometimes 5 years only the maximum period they will give you. Because they are taking the risk, right? They are giving you loan without any security. They are trusting you and giving loan. So they need the reward. So their interest, everything will be high. You take, SBI will say, you take that loan, no problem. And immediately, as fast as possible, finish the construction. In 1 year, construction finish pannidum. Then I will come and take over that loan. Because construction finish pannidum, already mall is there. That mall, 1,000 crore mall is there. That SBI can take a security. So what happened? I approached the HDFC. HDFC gave me loan. HDFC gave me loan of 1,000 crore at the rate of 18% interest for 5 years tenure. This is a very, I cannot repay like this. But immediately for the first 1 year, so what happened? In the first year itself, somehow I kept apart some 100 crore rupee from this money to repay to HDFC, and 900 crore I finished off the shopping mall. So first year like construction done. So now asset is there, shopping mall is there. Now what will happen is that this SBI will talk to HDFC and SBI will take over this loan. In the loan will be taken over by SBI. SBI will pay HDFC all the remaining amount at this rate. Whatever amount I have paid, whatever the remaining, like 1,000 crore I paid 100 crores. The remaining 900 crores at the interest rate, SBI will pay to HDFC, and now SBI will take over my loan at this interest rate itself, first interest rate. And some extra fees, something I'll have to pay, but this is takeout finance. One bank or loan, where a bank take over control. Okay. This is takeout finance. So takeout loan is a method of financing where a loan is procured later is used to replace the initial loan. A loan procured later is used to replace initial loan. Like that, this bank will take over also. Both these ways, both the ways. Or you can say like, I have a loan first from this guy. So after 1 year, I took a loan from this guy, repaid to this guy. So now I have to pay to this guy. That way, that is also takeout finance. This happens in property development, long-term financing, all this. In case of takeout finance, if based on the record of recovery, the account is classified as NPA by lending bank, it should not recognize income unless it is realized from the borrower. Same things. Then objective is partial recoveries of NPA. Partial recoveries is important. Partial recovery means you can say this is bank, and this is a customer. The loan outstanding to bank, outstanding amount, NPA, it has already become NPA. Outstanding amount is a 10 lakh. 10 lakh last 6 months he is not paying. It is already an NPA. And what happened now? This guy suddenly comes and pay the bank 4 lakh rupee. 10 lakh 4 lakh. Entire NPA is not received. Entire NPA kadakile. Partial amount of NPA he received. Partial NPA he has received. Got it? Partial NPA he has received. Partial money he has received. That is partial recovery. Partial amount of NPA government bank has received. In that case, what to do? Normally, when the bank is giving the loan, there should be an agreement between these people. Or partial NPA like partial deposit where this 4 lakh will go? Because bro, interest component is there, principal component is there. 10 lakh outstanding. In the 10 lakh, we'll say 10 lakh is outstanding. 10 lakh some 6 lakh will be the principal amount. Sometimes the 4 lakh will be some interest. Normally 4 lakh on the 3 lakh, 2 lakh, but it will be interest. 10 lakh, this is the principal portion. So when I am paying 4 lakh, this 4 lakh, in the 4 lakh in the interest adjust panama, or will it get adjusted to principal? There should be a ratio to that. Normally banks, what they do is they'll adjust this 4 lakh to the interest component directly. So still outstanding 6 lakh. But the 4 lakh principal adjust pannitana, that will be much better. Future la atharam advance ini recover agada. Ini recur agada. So I don't have to think too much on that. Just understand. Normally for this settlement in the 4 lakh interest ku ponamo principal ku ponamo. For that there will be an agreement between the bank and the lender. Initial agreement la irukku. When you are repaying the money, the first 6 months the component will be going to interest more than to the principal. Like that agreement will be there. See whether there is an agreement like that. If there is an agreement like that, bank il andha madiri agreement irundha, see whether bank has followed that agreement. Money received partially, whether bank has entered based on that agreement. Or as an auditor, we are just checking bank idu correct ah pannite illa. Or because like a lender will not look at all these things. Agreementally sometimes it will be there that when our money is coming, it should be going to the principal. But bank avaroda advantage ki they may take it to the interest. In the Mari fraud bank will do. So as an auditor, you have to check whether bank has followed it correctly or not. Okay. In the absence of a clear agreement, if an agreement is there, then do accordingly. If an agreement is not there, it depends upon the accounting policy of the bank. Normally, starting an agreement irundal, both of them, this is how it will be treated. Then see, bank has to follow the agreement. As an auditor, I will just check whether bank agreement follow pannite illa. If the agreement is not there between them, like this kind of a writing clause is not there, then it depends upon what bank's accounting policy says. Then AS 9.1, then interest partial release, all these things. Memorandum account is easy, you really understand. Then income from investment, all these, it's are easy. Expenses, how to audit expenses, how to audit interest expenses, these points you have, these are easy. I'm not gonna touch upon there. This is audit of expenses is important. Since it's very easy, if you read it, you will get it. That is why I'm not focusing. Say interest has been provided on, see whether interest has been provided on all deposits, whether interest rates are accordance with the banking regulations, interest on savings account. It's simple. Inter-branch transfer la check pannunga. Then operating expenses, how to do the audit. Study and evaluate system of internal control authorization procedures, divergent trends, all these things, provision, contingency, disclosures. Easy. Now let's take a look at chapter number 11, that is ethics and terms of engagement. Okay, ethics and terms of audit engagements. Okay. So next we have is chapter number 11, audit, ethics and terms of audit engagements. It's simple. It's a very simple chapter. It's, I think after chapter number 6, this is the most easiest chapter because not anything, nothing technically is there that much. If you read it, you will get understanding. Ethics means what do you mean by ethics? What are the moral principles that you follow? That is basically called as ethics. That is, you don't cheat anyone. You don't get angry at anyone for any reason. You won't stab people behind the back. All these things are ethics. You won't lie to people. These are basic ethics. That is basic human qualities. But for an auditor, what are the ethics he need to follow? Basically, ethics means the moral principles which he need to follow. It comes from individual instinct, intrinsically. That is like inherent in the individual. Like that, whatever we do, it should come from inside. You cannot make a person ethical. No. Then it's a state of mind to act and perform in accordance with the moral principles. Now let me talk about auditors ethics, CA ethics. You found out a fraud in a company and you're planning to give a qualified or adverse opinion. The management comes and says, you bro, I'll give you 10 crore rupees or check, not 10 lakh rupees. Please don't give me a qualified opinion. Or you are planning to give a adverse opinion. He comes and says, you bro, please don't give adverse. Adverse will be negative for me. Please at least make it qualified. I'll give you 10 lakh if you can make it qualified. I'll give you 30 lakhs if you can make it unmodified. Like that. So the auditor has two options. Either 30 lakh rupees pocket le vaange ittu he can go. That is one option. But second option is his ethics. He is a chartered accountant. He studied 5 years because CA is one degree which you cannot take from with money. Money koduthu vaanga mudiyatha degree. If you have like any degree, for example, you take an MBA. Getting an MBA, like there are people fake universities, all this thing. Like for IIM, all this thing requires money. I mean, hard work. But I'm saying, just to get that MBA degree, you can get it from like a fake universities, all this thing. But CA, you cannot get that. You studied so hard. What is my ethics? Should I do it? No. That is his ethics. That is the ability to withstand any selfish motive or temptation. Okay, whatever it is. Need for process ethics, all these are easy. You'll get respect. Two things. What is principle-based approach? Rules-based approach. Principle-based approach means the things that are based on moral principles. Human being, two things is there. Just understand. You are driving a car. Two things are there. If it's a road where no rules, nothing is there. It's like a track or something, not like a track. In a normal road, two ways you can drive a car. Number one, you have to follow the government based rules that is written in the book. Indian road transport rules will be there. And you have to follow, like when you are turning right, you have to put the right indicator. When you see a red thing, you have like the traffic light, you have to stop. All these are rules put by the government, written in a book. You are following that rules. These rules are written by the someone else. When you are following those rules, it's called a rules based approach. In auditing also, when you are doing the auditing standards, all these things are written. Standards is written, ethics is written, you have to code of ethics, you have to follow all these things. This is written by our mother body. And following that rules is what we call rules based approach. Following that rules, ethically following that rules is called a rules based approach. But following the principle based approach means you need to do principle based plus rules based. Both need to be there. Principle based means you have to follow the moral principles. Even though it is written in the standard that you do, like something that may not be written in the standard as per the rules or something, but moral principles should be there. Right? You are a chartered accountant, you have some moral, your own principles. So those principles is what we call principle based approach. The ethics that is coming from your principles, which is not written in any book or anything, or personal values. Sometimes like we'll feel empathy towards the thing. All these are our our own principles. Okay, then rules based. Two based ethics are there. Principle based ethics means the essence of principle based ethics is that it requires compliance with the spirit of ethics, your own spirit. Exercise professional judgment in every situation. Professional knowledge, skill and expertise, it's professional judgment. Rules based approach means strictly follow the clearly established rules. Standards is mentioned, it strictly follow that. But this one is our own moral ethics. Okay, two things. What are the fundamental principles of moral ethics? Integrity, objectivity, a simple area. Why should I waste my time? Threats to independence also, it's easy. For someone self-interested means you are interested. You are interested for money. That client, you have an interest in that client for money. That is called self-interested. Self-interested occur when the auditing firm is a partner or a partner is associated could benefit from a financial interest in the client. You have self-interested. Imagine I'm planning to audit that company and I have self-interest threat with that company. Then please don't audit the company because your independence is gone. What is threats to independence? If you have these kinds of threats, don't audit the company because your independence is gone. Okay, you're not independent. If you have self-interest threat, you expect more money from the company, so you may give a fake opinion to that company. So all these are self-interest threat. Self-review threat means you are auditing the work which you itself have done. That is self-review threat. Imagine you were just hypothetical example. Last year you were a CA working in that company, and this year you started your own practice and you are going to audit that company. So whatever work you have done last year, that will be reviewed by you itself, right? What is the point in doing that? That is self-review threat. Like an internal auditor doing statutory audit, it's like that is self-review threat. Okay, then advocacy threat means you end up being so close to the client and you not close, you are actually supporting the client like an advocate. Whatever he is saying, you are supporting him like an ad. That threat coming from that is called advocacy threat. For example, a company, imagine your client, that company has shares, and you are going to some other of your friends and telling them, bro, I am the auditor of this company. This company has really good shares. Please buy it. No problem. It's a super company. You are saying like that. You are becoming an advocate for him like that. You are promoting that client too much. That is called advocacy threat. It occurs when the auditor promotes or is perceived to promote a client opinion to a point where you may feel that the objectivity is getting compromised. You are promoting him so much. When intimidation threat, when the client threatens you, client tells you, bro, you gave unmodified opinion. You gave adverse opinion. He says, if you please come and give me modified opinion. Okay, you gave him adverse opinion. He is threatening you. Give me unmodified opinion, else I'll kill you. Like that, else I'll kidnap your daughter. Like that he's saying. Like any kind of intimidation. Else I'll kick you. Else I am a very powerful person. What I'll do is I'll make all your clients move out from you. Like that. Threatening us. That is intimidation threat. If you have intimidation threat, don't accept the audit. Then familiarity threat. You are too close with the client and you will end up giving him some favor. That is familiarity threat. You are self-evident. That occurs when an auditor forms a relationship with the client where they end up being too sympathetic for the client's interest. A good lady, she's a client, she's a young entrepreneur. She comes to you. You are the young chartered accountant. what happens? And you started auditing, and during the auditing started, you became so familiar with the client, and you are just like a in I was there. Okay, you end up being so sympathetic to the girl. Girl comes to, sir, please don't give me a modified opinion. Let me give you, please give me an unmodified opinion, else my business will go. You are like, why not? Come with a coffee to me, then I'll give you unmodified opinion, unmodified. That is familiarity threat. You become too sympathetic to the client's interest. That is familiarity threat. Okay, what happens? Like a close relative of the audit team working in a senior position of the company, like friends, former relative, long association, giving gift or all this, familiarity become. Okay, then safeguards to independence. These are the guiding principles. This is very important. You read it, you will get it. These are the safeguards, means the things that you need to apply. For example, a fire is happening. What is the safeguard against a fire? Either you put that fire extinguisher or some water. So when water comes, the fire is gone. That is called a safeguard. So threat to independence is the fire. How to eliminate that threat? You apply safeguard. Got it? You'll never forget it, right? Okay, safeguard. To address this issue, the following guiding principles are to be applied. Okay, many things are there. You do one thing, independent things which you can read and understand. I'm not focusing. Professional skepticism means attitude of a questioning mind. Whatever you see, you should have that questioning mind. Don't leave anything without a doubt, like that. Have to have a questioning mind. Being alert to conditions which may indicate a misstatement due to fraud or error. Now let's go to directly to this one. Is 210 is easy. Now let's go to SQC1. That is an important thing. SQC1 and SA 220. What is SQC1? SQC1 and SA 220, both things are almost the same, but it is different. SQC1 means quality control for the end. These two standards are really important in inter and final level. Wherever you go, I am there. This one. There is in the movie dialogue. Wherever you go, I am there. In inter or final you go, SQC1 and SA 220 is there. Okay, so yeah, let's start. What is SQC1? Basically, it's a quality control for firms that perform audits and review. See, quality control for firms that perform audits and reviews also. What is review? We learned in chapter number 1. Reviews of historical financial information and other assurance and related services engagement. That is, this quality SQC1 is basically just a CA firm will be there. Imagine this is a CA. Oh, last time itself I've drawn the same image. Imagine this is a CA firm. This is a CA firm. In this CA firm, many work will be done, right? Many work they will be doing, right? Not only auditing. Once you become a chartered accountant, you are not only doing the auditing. You will be doing review will be done. I'll neatly write it. Bangi vande. Okay. This is, you will be doing the auditing. You will be doing the review. You may be doing some consulting. You may be doing some other works. Many works you may be doing. The first handwriting was even better, I guess. Okay. So whatever the hell it is. So this is there. This is in an audit firm. These many works you will be doing. So this standard SQC1 is a standard. These are certain rules that are set by our mother body ICA, and they are saying that you have to follow these rules to maintain quality for all the work that you are doing in a firm. When you are doing all these 4 or 5 works, you should have a quality in the work. Achumma, like we are giving an audit report, simply putting something and giving, that is not, quality should be there, proper format, proper structured, proper audit documentation, proper audit procedure structured, proper engagement team, proper following all the rules and regulations, compliance checking, all these things, properly conducting the meeting, communicating things properly to TCWG. That is a structured way to do the auditing. That is called quality of auditing. Some CA firms, if you join, in my personal life, I have joined multiple firms where I've seen in one firm superb quality audits I've seen, especially really good quality in a structured way people are doing it. But other firms I've seen that where no quality is there. Like something they'll sign and give to me. Sometimes audit report may contain spelling mistake. I've also seen things like that. Their quality is not there. But there are other firms which I've worked where even a small dot, if a small dot or a comma is not there, we will get fired for that, like scolded for that. That level of quality was there in one firm. In another firm, you do whatever you want, no problem. Just opinion word itself is needed there. Audit opinion. No. Quality. So maintaining, so ICA wants us to maintain the quality. So this standard is mentioned. In this standard, a lot of things are mentioned. You have to follow that. to maintain the quality of your CA firm. So this standard looks at the quality of the entire CA firm. That is our auditing work, review work, other work, consulting, how we treat the employees of human resource, whatever. Entire quality of the entire CA firm. That is why I draw this room, building, CA firm order quality. That is, this entire quality thing is what we call, if you look at the entire quality of this thing, that is what we call SQC1. And there is something called SA220, which looks at the quality of audits only, SA220. Whether audit pandradhile quality supra. That is, if audit report format correct, audit procedures proper, that they will check at SA220. But SQC1 audit order they will check, but at the same time, review like office proper policies, documentations proper, or whether in the review, how the documentation work is done, or whether the independence is checked in all these things. And consulting, whether a structured format is followed in the consulting when a client comes till the client gets the result. What is the structured format followed in the consulting in the office? All those things are quality control coming under SQC1. SA220, like when I said earlier, I only said about the audit things, right? For SQC1, all the controlling the quality of entire firm. SA220, you are controlling the quality of audit only, like how the audit was done, audit procedure proper, audit documentation proper, everything. Testing, everything, what is the test of controls, whether the engagement team discussion was there, whether the communication TCWG was there. All these things come under SA220. It's not SQC1. Earlier I said it when I forgot to add the other things also. But SQC1, similar things like this will come, plus you are controlling the entire quality. Okay, got the difference between both of these things, right? So what are the elements of system of quality control? SQC, leadership responsibility for quality within the firm. Who leads this quality? Basically the CEO of the company, basically the senior chartered accountant in that office. He leads the quality. He is the one responsible for maintaining the quality. He need to appoint people or give responsibilities to different articles or staff, telling them you have to follow like this. Then ethical requirements always. Let's look at this. Leadership responsibilities. Leadership responsibilities, let me see some important points I would have marked. Okay, for marathon. Quickly we are moving, right? So policies and procedures should require that the firm's chief executive officer, like CEO, in a company like that, CA firms will have the senior most person, or the managing partners have the ultimate responsibility for this. He need to make sure that the person assigned operational responsibilities for quality control. I am the senior in the CA office. I assign this responsibility to one article on senior staff in the office. So I need to make sure that the person assigned the operational responsibility, that is to that person, that article, quality control system has enough experience, ability, authority. He or she has the skill. That is the only thing that I need to ensure. Then what are the ethical requirements? Ethical requirements, independence, simple, basic things regarding whatever we learned till now, everything is there. Then any important points? Independence order. How independence is done in the office, that is important. That I'll just say. There are points like independence, how it is done in the office. Because guys, guys who are watching this till the end, I love you guys. You guys is the most dedicated guys. Like the last 7, 6, 8 hours or something, you are consistently watching this channel, right? You guys are really good. So if you loved this marathon, I would love to know your feedback on the comments. Yeah, and you can text me or whatever it is. I just want to know. And just if you're new to this channel, kindly consider subscribing to this channel. It is best to say this thing at the mid of the class. At least I have because I'm continuously doing this. Okay. Let's talk about ethical requirements. Ethical means independence things. What are the independent things? Observing the independence of all engagement is a basic requirement. SQC1, quality control. Independent I just need to check whether independence is happening properly. Not only audit, sometimes for review we need independence. We don't know. Whichever things where independence is required, you need to give it. Firm should establish policies and procedures designed to provide it with a reasonable assurance that firms' personnel maintain independence. And because in CA firms, sometimes some articles may be there. I am going to audit ABC Limited or Baiju. All the CAs may be independent. We may not be related to Baiju, but one article may be there who is a cousin of Baiju. So what happens? So that article may do some fraud. We suspect, right? So because of these reasons, we need to tell our articles, bro. Everyone should tell if there are any cases, everyone should only do an audit if you are independent. Like if you are related to someone, just please tell to us, I'll change you from this audit and I'll put another person, like that. So the awareness of independence things should be communicated to their staff. Yeah, that should be our policies and procedures should be relating to that. And such a policies and procedures should enable the firm to, that is this independence policies, to communicate its independence to the person. To all the articles you need to tell, bro, this is the thing. Whenever if you feel any issue threatened to independence, please tell to us. We'll change you and we'll put another article in that audit. No problem. Okay, like that. How independence is done, you tell. Then identify and evaluate the circumstances and relationship that creates threat to independence. Tell them all these things. And try to, if there is one article is related to the company, like he is not independent, or one auditor is related, then go on. You cannot audit. But if an article or one senior staff in the audit team is related to one client, in that case you have to eliminate, that is a threat. So you have to eliminate that threat by applying a safeguard. What is a safeguard? Take that article, throw him from that audit team, put another article in the audit team, go on, done. The audit team becomes independent. Articles, CAs definitely need to be independent. Articles, it's okay, like we can manage it like this. Okay, then eliminate him or apply safeguard. If nothing is possible, withdraw from the engagement. These things are easy, go through it. Then acceptance and continuance of client relationship and engagement. You need to check the integrity, competence and compliance. That is, evaluate the integrity of a client. It means last year or this year, you are a CA. Suddenly one client comes to you and tells you, sir, I want you to audit my books of accounts. Not only audit, here it is SQC one, not only audit, auditor, review, other anything, any work, consulting, whatever it is. You have to look at the integrity of the client, then only accept a client. Imagine a guy is a fraud. He's famous in one state for doing fraud. Now one person would have came to your mind, whichever state you are. One guy will be mainly there for a fraud, right? That guy came to you for asking for you for some work, consulting, auditing, whatever the hell it is. Before you accept to work from him, you have to look at the integrity of the client. Integrity means, is this guy, before accepting work from any person, just look at their integrity. Is this guy straightforward? Is this guy honest? Is this guy a fraud or not? So when I evaluated the integrity of that client sitting in front of me, he was a famous fraud from Kerala or Tamil Nadu. So his integrity is gone. I should not accept work from him. So first thing, before accepting any work, you have to look at the integrity. Second thing is competence. Competence means a work came to you. You have to audit many things. Like a very big company came to you. You are a normal CA. So you only have 3, 4, 5 articles. So your team is basically not competent to audit a bigger company. You don't have the required team member or size or skill or experience. Nothing is there. So that means your team is not competent. So if you are not competent, don't take the audit work of their client, because if you are a small company and you take a very big auditing and you are unable to do it properly, so entire CA's reputation is gone, right? So don't take it. Competence you have to see. Then compliance with ethical requirements, independence ellame super aanu check panna. So these are the basic things. Then this is how you will evaluate the integrity of a client. Look at the client's business reputation, nature of the client's operation, all these things, simple things. Then human resources, you need to establish policies and procedures that provide with a reasonable assurance that the sufficient personnel in your office has sufficient team member is there with the proper capability, competence and commitment to the ethical principles. Like you should have policies and procedure to make sure that you have a really good, competent, capable, all this kind of a team members like that. Okay. Simply means firm's policies and procedures should ensure that firm has competent staff. And I'll tell you why this happens, because lot of CA firms, if it's like a mid-size to below CA firms, what happens is if some of this, any articles come and like sir, can I join this firm? He'll say yes. No interview, nothing will be there. So what is happening? That article is not that competent. So when all the staff in the office majority of staff become these kind of people, they are not competent. The entire office becomes incompetent. Like skill hardworking nature. So that is a problem. But if you look at a mid-size to above size firm, to get a job there, either you need to pass an interview or test or something. They'll do some really good interviews, and only they'll take you. They look at your competence, not your work capability. Work no one knows when you're going for first year of articleship. They look at your communication skills, the way you present yourself. Are you able to control your voice modulations, all this when you call a client? Normally if you speak like this, but When you're calling a client, you should like, sir, I'm Sudarshan from this chartered accountancy firm, and I'm the one who's assigned to do your auditing. So can I have a visit to your office? You should be able to speak like this. Normally, when you may not be like that. So all these skills they will be assessing. So human resource. So if that is one thing. So as a CA firm, you should ensure quality when you take people and train them also. Be your staff articles. Be it a small CA firm or a big CA firm. Small CA firm that CA can train their articles. Give them really good quality, make them capability, competent, give them some Excel or some software training, all these things, make them better. Then engagement performance. That is how the company's audit CA is performing its work. Engagement means work, how that's doing the auditing review, everything. Performance, the consistency should be there, all these simple things. Then engagement quality control reviewer. That is engagement quality control review. Engagement quality control review. Okay, whatever it is, let's see. Engagement quality control review. What is engagement quality control review? That means engagement quality control review is mandatory for all the audits of listed entities. This is basically once you finish an engagement, this is SQC1, so not only auditing. Once you finish any work, one person will come, like you have an audit team. Imagine this is Deloitte. Deloitte has 1, 2, 3, 4, 5, 6, 7 audit like team, not only auditing, different departments, different teams will be there. And you are one team and you are doing, imagine auditing or any other work. Once you finish this work, someone who is from outside this team, who is not in this team, will come, some senior person will come, he will come and review the work that you have done. You may have a CA is there with you, and other 5 articles are there. You did some consulting or auditing or internal auditing, whatever it is. Once your work is done, one senior person from that firm itself, some senior partners or from that firm, he should be independent of this work. The work, he may not have done anything in the work. He should be independent of this work. That person coming, or someone from the outside, some senior person, some senior like nearby firms, like a senior chartered accountant or someone like that. Some senior person, either from your firm, someone who is very senior, who is not related to this work, who should be independent of this work. In the work, plus either that person or someone from the outside who is independent of this work, not independent of the firm, not independent of the client, independent of this work. They'll come, some senior person, come and check how you have done the work, whether the audit procedure was okay, documentation was okay, everything. If it was an audit, they'll check like that. If it's a review, they'll check like that. If it's a consulting, they'll check like that. Engagement quality control review. But there is audit specifically. See, engagement quality control review is mandatory for only all the audit of financial statement of listed entity. If you are having a listed entity or you are auditing a listed entity, this one is mandatory. See, plus in respect of other engagements other than auditing, other than auditing of listed entities, other engagements, firm should devise a criteria to determine cases requiring performance. Engagement quality control review. That is, normal audit of listed entity is mandatory. Other cases, audit, their CA firm can decide. That is, in case, engagement quality control review. That you are auditing a big company, that is not a listed company, but still it's a big company. For that company also, you need an engagement quality control review. That is, this other person comes and checks the entire work that you have done in that auditing. You are auditing Baiju. Okay, Baiju is a listed company. Baiju auditing is done. Once it is done, one senior partner from your firm who is independent of this work, this person would have not touched this work. He have not even given advice, nothing. He's some senior person or someone from the outside, where a CA firm and where other chartered accountant, they'll come, they'll just check what all the work the people have done. Here the work will be done by a CA and many people will be there. So entire work, CEO work, this engagement quality control reviewer will check. Okay, quality okay, that's it. Because what is the standard? Quality control standard. Quality okay, they'll check. Okay, that is quality control. And this things okay, you will get it. Then assembly of engagement audit file 60 days, retention 7 years, monitoring is SA220, same thing for auditing. Same thing, exactly what we learned in SQC1, same thing for auditing. Concepts, everything is the same. Just there, audit plus all the other work of the entire quality control of entire firm was there. SQC1. Here it is only auditing. Only auditing or mutton quality control. Checked by SA220. And SA is a standard on auditing. So when you are auditing, you have to follow SA220. SQC1 is not a standard on auditing. It's a standard on quality control. That is applicable for the entire firm. This one is when you are doing the auditing, you have to auditing time you have to follow this and go. Quality controller. You started the auditing today. 2 months ago auditing finish pandradhu. In this time you have to follow this standard and go. That is SA 220. Got it? Auditing time tomorrow when you are doing the audit, you have to know leadership responsibility, ethical requirement, client relationship, but adum okay, like it's like that. But at the end of the audit also, you will check the quality like that. So this auditing time the quality control. This is standard. This is SA and that is SQC. Keep it in mind. Okay. Then proper explain some time, but this one is exactly almost similar to the SQC one. So if you read, you will get it. Nothing complicated. Here also some small changes are other audit engagements listed entities and other audit engagements. The audit. So in audit engagement. See here other audit engagement. It is applicable for financial audit of financial statements of all the listed entity engagement quality control review as per SQC 1 SA 220 and other audit engagements only, because SA is applicable only for SA is a standard on auditing. So auditing is applicable. But here see, it was applicable or the audits of financial listed entity plus other engagements. Audit okay plus other engagements also. SQC 1 is applicable. SQC 1 is basically applicable for all the work you are doing. SA 220 is applicable only for the audit you are doing. Similar, sir. From a CA firm's perspective, SQC 1 is applicable for all the work you are doing. SA 220 is applicable for audits you are doing. But basically, bro, understand, please. Limit is there, okay. Only listed entities auditing. Audit of all the listed entities plus other audit engagement which a firm may decide. And then some peria auditor, like unlisted company, but it's like a very big company they are auditing. That case also they can use engagement quality control review. Just controlling the quality of engagement, just reviewing it. And here also auditing of all the financial events listed entities is mandatory plus other normal engagements. It is not mandatory, but CA firm can decide consulting they may decide internal audit sometimes like that they will decide. That's their case. So don't overthink on all this. Whatever is there in your book, you just read and go. That's it. Okay. Then so we come engagement partnership document. This matters, simple thing. So we come to an end of our marathon. 11 chapters done and dusted. So it's like I have finished my marathon from my side. I've done and dusted it. So to all those students who are actually listening it now, I believe you enjoyed the game, bro. It was a bit quick. I was also speaking quick because we need to get this over by this time and whatever time you are watching it, kudos to your examination which is coming very soon, because mostly when your examinations are very near, then only you'll be watching marathon, right? So hopefully I want you guys to clear your examination. Whatever happens in this attempt, all the best from my side. Even if you are watching it on exam day, tomorrow if your exam, whatever your situation, I don't know. Sometimes you may be watching it 1 month before exam or 1 day before exam, whatever it is. But still, the game is, now it's on your hand. Marathon is done. Now please go and do the self-study properly. Because marathon or revision lectures, everything by any faculty, for any subject, the game is on. You're doing taking the pain. Because looking at your book and studying, you're on in your room without anything. Marathon is just to understand the concept, and if you're traveling or something, just listen to it and go. So some concepts mind refresh. That is a good thing. And my marathon is specifically for that. You can use it like that, because if the concept which you forget, I have said 2, 3, 4 times. So if you listen to it when you are like sleeping and not sleeping, sleeping time, okay, you can do that. When if you're traveling or if you're walking, going for a walk, going in the gym, let's listen to it. So if you're hitting the gym 1 hour a day, exercise. From the time if you listen to it, in 10 days you revise the entire auditing once. 10 hours nearly, 7 hours, 8 hours, 8 hours, 10 hours, I don't know what is the time, whatever. So if you're listening 1 or 1.5 hours a day, for 8 days you got 1 revision. So 30 days you will get 3 revision from marathon. Anyways, you are wasting that time. So listen to auditing. So 1 full stretch marathon you sit and watch with your book, then it's your game. I always recommend doing the self-study mode, because self-study is the game. Sitting, because that is painful, bro, doing the self-study. Taking your book, looking and studying and recalling. That people are not willing to do. But you have to do that to pass. Okay. Marathon is just an add-on which you can use. Marathon or any lecture or any material, whatever it is. So I want you guys to somehow get this done once the examination is done. Even if you have not taken coaching from me, if you have watched this marathon, once the examination is done, and if you are, hopefully everyone should clear, everyone should get an exemption minimum. At least if you clear, if you get 41 to hire any amount in auditing, just send me a text on LinkedIn, WhatsApp, anywhere, because I would love to know. And your feedbacks, everything would matter a lot, and you can write it in the comment box if you enjoyed it a lot. So if you're new to the channel, kindly I would say subscribe to the page and give it a thumbs up and comment. That's it. So thank you guys. Done and dusted. Auditing is done. So now it's your game. You go and do your duty. Okay.